will be a session on the global outlook, and then we'll have a series of breakout sessions looking at particular regions of the world, and then also other issues which are new to us, but which have become a part of our core competencies. So a little bit different focus today, and then even tomorrow, yet a different focus, which gives you a sense of the variety of topics that the IIF covers. I want to thank my board, many of whom are here today, but most importantly, my chairman, Douglas Flint, whose great leadership has been so supportive of me and our staff and helped us here in London. And you can see our co-hosts here, HSBC, Standard Chartered, and Barclays, who've been very generous in their support, as well as all of our supporting members who are also arrayed up here. What a great time to be here in London. What an amazing financial center. For the IIF, it rivals New York as one of our main centers for membership. There are 160,000 people who work here for non-UK based institutions, 40,000 who hold non-UK passports. So it truly is one of the great international financial centers. And we're here today to celebrate the role that London plays in the global financial system and will continue to play in the future. But we come and we assemble here at a time of somewhat turbulence, a dynamic environment that offers risk. We're in the risk business, but also opportunity. Last week's EU parliamentary elections will make Brussels a more disputatious and complicated political arena. The ongoing political crisis in Ukraine, rising tensions with Moscow will also make it more interesting. Russia's turn to the east on the recent energy deal, and a G7 which will meet without Russia over the next 48 hours. Modi mania, we're hearing a lot about in India, enormous expectations of the world's largest democracy. Positive but tepid and uneven growth in the US, which is fueling an America which is becoming much more inward-looking. Slower growth in China, we saw statistics out again this morning, as President Xi tries to transform that massive economy into a different growth model than what has propelled them forward over the last 30 years. Fed tapering and the end of an era of cheap and abundant capital. Rapid technological change driven by mobile telephony, digitization, datification, and powerful communitization in a hyper-networked connected world. Deflation and deleveraging in Europe. We'll hear from the ECB in just a few hours how Mario Draghi and his colleagues in Frankfurt are going to respond to the deflationary pressures. And of course, elections here in the UK less than a year away, which will set the stage for policy deep into the 21st century, including whether the UK remains within the EU. We had a great discussion of that yesterday. But first, we have to decide what will the UK look like? What will the composition of the UK be with the Scottish independence vote in September? I don't have a dog in this fight. My ancestors left Scotland 250 years ago. But I do, probably avoiding incarceration. But whatever the decision, I do hope it's the right decision and that this marvelous country, this marvelous collection of different histories remain the powerful instrument that it is. In this dynamic environment, the IIF is focused on 4 R's. Last fall, I gave a speech that I talked about 3 R's. I've added an R. I may add more R's as the years progress. It's alphabet inflation, as someone said. Here are 4 R's: regulation, risk, responsibility, and revolution. Over the past 5 years, the regulatory reform process led by the G20 has produced groundbreaking changes. More capital, more liquidity, less leverage, recovery and resolution regimes, and stress-tested balance sheets that are tortured, contorted, pulsed through a variety of frightful, bone-crushing scenarios. If your balance sheet can survive these stress tests, it can survive anything. Again, we heard from the panel yesterday. As part of the regulatory process, the IIF has been front and center in these discussions. 3 areas that we continue to remain focused and engaged: preserving risk-weighted assets for bank capital standards, ending too big to fail, ensuring harmonized cross-border resolution. I'll come back to that in just a moment. And preserving avoiding regulatory fragmentation and remaining true to the spirit of the Pittsburgh Summit of the G20 a few years ago that said, this is a global crisis that requires a global solution. Unfortunately, many jurisdictions around the world didn't hear that and have now decided in a very cavalier fashion to move off and put in place their own set of rules and regulations. This fragmentation, balkanization is real, and it will make life more difficult, and I suspect will have great costs to growth. On Too Big to Fail, there were a couple speeches given here in London last week, and it's interesting because they continue to cite studies and statistics that talk about subsidies for large institutions. So let me just note that the most recent, and I think the most authoritative studies done by Oliver Wyman, which looks at data through the end of 2013. And it says the funding advantage continues to decline and has become statistically insignificant. There is no evidence that any spreads, however small that they are attributable to Too Big to Fail. And I just hope our policymakers, as they go out and give speeches, I realize it's always a political season somewhere, that they use appropriate facts to inform the points that they make. The second R is risk. From global country risk, our studies on Ukraine or China or Brazil or Chile, to operational risk at the firm level, we at the IIF endeavor to peer around the corner to identify trends that pose risks to our firms, whether at the global, macro, regional, sovereign, or the systemic level. In the past couple of months, I've been visiting central banks around the world, asking policymakers the question, how do you think about systemic risk in the post-crisis environment? There's a two-part answer. The first part of the answer is, well, we have new flow charts and task forces. We have working groups. They have a full array of the variety of different activities. The second part of the answer is, nothing has changed. And so we at the IIF can be a catalyst for helping the policymakers in the official sector think about what is systemic risk in the post-crisis environment. The third R, and a very important R, is responsibility. We at the IIF are reflecting and internalizing the numerous and diverse ways that our industry is helping people globally. We have added financial inclusion to our agenda and look forward to a panel later today on that topic. I might remind you that 2.5 billion adults, half the world's adult population, do not access formal financial services. There is a great win-win opportunity for us to lift millions of people out of poverty, lift them into the middle class, and create new markets for our member firms. As the Reverend Jesse Jackson says, capitalism without capital is just another ism. And we are the vehicle for putting capital in the hands of individuals and households and small and medium-sized enterprises. Without that, there is no growth, there is no prosperity, there is no middle class. During our board meeting yesterday, we heard from Barclays CEO Anthony Jenkins regarding the Banking Environment Initiative, which is an initiative that includes many of our firms, Lloyds, Deutsche Bank, Santander, Nomura, Westpac, that looks at ways to preserve the environment, to fund projects in a way that avoids deforestation, that funds projects that support sustainable growth globally. Swiss Re's work to support the launch of Africa's first ever natural disaster insurance pool, which will help protect the livelihoods of millions of people in environmentally vulnerable regions, especially as we become more and more concerned with climate change. JP Morgan's commitment for $100 million over 5 years to support the city of Detroit, Michigan. ICICI, which is working to expand access in India and has opened over 15 million financial inclusion accounts in more than 13,000 villages. This is just a few examples of the hundreds of ways in which our institutions are making a difference in lives every single day. As Sir Isaac Newton, who's buried across the street, said, "We build too many walls and not enough bridges. We in the industry are building bridges, but we need to build more." For those of you who didn't know, Sir Isaac Newton, at the end of his career, was also the warden and master of the Royal Mint and took the UK from a silver-based standard to the gold-based standard. So not only was he a great scientist and ended up being the head of the Royal Society, he was also one of their first central bankers. Our fourth R is revolution. And I'm referring here to the technological changes and the innovation that will enable and disrupt the way that our industry functions. creates opportunities, creates risks, enforces some current business models, but will provide new and different and more radical ones. Charles Darwin, who is also buried across the street, and Douglas quoted him yesterday, and I will again, is often thought to have said it's the survival of the fittest, but it's not at all. That's not what he said. He said it's not the strongest, it's not the most intelligent, it's that species which adapts that survives. It was actually Herbert Spencer, who is not buried across the street, who coined the phrase survival of the fittest. And if anyone before the end of the day can tell me where Herbert Spencer is buried and who's buried near him, there's a 10-pound note in it for you. But I think this idea of adaptation and innovation is one in which the industry is embracing and will even more so in the future. And our firms are on the cutting edge of innovation. I just took my senior leadership out for 4 days in Silicon Valley and San Francisco. Fabulous set of meetings with a whole host of 25-year-old CEOs of startup firms, some sitting in garages, others in large campuses. And many of our member firms, Standard Chartered, BBVA, Citigroup, have offices there. They call them labs or studios to designate them from the corporate headquarters. But our firms are at the cutting edge. But it's remarkable changes occurring, not only in Silicon Valley, not only in the West Coast, but globally. Later today, we'll hear from a number of technologists on some of these remarkable trends. Let me close by just talking a little bit about the IIF, your association. We continue to expand and diversify our membership. We've added 30 new firms in just the last 6 months. We've opened a new regional office in Dubai. Wolfgang Engel, who ran our membership office in Washington, has relocated to Dubai, and that's to service our 100-plus member firms in the MENA region in fast-growing Africa. We will soon open offices in Singapore, which will support our Beijing office so that we can provide services from North to South Asia and East to West. Since our annual membership meeting in October, where we broke numerous participation and attendance records, we have experienced 120,000 unique visitors to our website and 112,000 membership downloads just last year. As a membership organization, we are fully committed to serving you better. That means improving access to our economic research, our analysis, and providing better tools for you to do the analysis that you do. We're also developing new products. Our portfolio tracker is a hot seller, and improving some of our standard bearers, our capital flows report, capital markets monitor, and many of our coverage for new and interesting frontier markets. Our small but weary and dedicated regulatory team that are here today, I think, who work 24/7, have done a tremendous amount of work over the past year. In the last 5 months alone, we've had 40 different regulatory working groups, 200 conference calls, 30 different symposiums or colloquiums around the world, and written thousands and thousands of pages of comment letters back to the public sector. We are constantly engaged with the official sector, with the public sector, as they sort through different regulatory challenges. We will soon update and relaunch our website that will make it much more tablet and mobile responsive. We also have a new app that I hope you're using at this conference. We will use it throughout today and tomorrow to do polling to better understand your thinking. We will also just launched access on Bloomberg terminals, both for our publicly available information, but also information, our materials who are just designated for our members only. So we are very excited about our relationship with Bloomberg. And of course, our events like this one. This year, we've had events in Sydney, Singapore, Shanghai, Beijing, Madrid, Bahrain, Dubai, and Mexico City, Washington, D.C., and we'll be in Lagos, Nigeria in November. That's a lot of frequent flyer miles. Next year, our events will be in Istanbul, Doha, Jakarta, New York, Frankfurt, Lima, and Johannesburg. If that's not global, nothing is. And we are the leading edge of the global association for this industry. Let me again thank my sponsors and just speak to those of you who are firms that are going through tough times. I quote Winston Churchill, statues out in the lawn. And he said, if you're going through tough times, if you're going through hell, just keep going. Thank you very much and have a great time while you're here.
Tim, thank you very much. Certainly sets the tone for what's expected to be another day full of thought. I hope you had a good evening. It is a packed day ahead. Please do remember to check the agenda on the IIF website or the app for any timing changes that may have occurred. We'll go to our first panel discussion of the day. The global economy in the midst of transition, hopefully away from crisis and into recovery. Different parts of the world, though, are at different stages. So now you're going to hear a diverse mix of economists and policymakers who are going to discuss the challenges and risks to the global economy, as well as the opportunities that lie ahead. This panel is going to be moderated by Charles Collins, Managing Director and Chief Economist from the IIF. He'll be joined by Dr. Richard Clarida, Executive Vice President of PIMCO, Mr. Gavin Davies, Chairman of Fulcrum Asset Management, Mr. Jim McCormick, Managing Director and Head of Asset Allocation Research at Barclays, and Mr. Axel Weber, Chairman of UBS. Do enjoy.
Thank you. Well, thanks so much. Welcome this morning. We traditionally start the day off with a discussion of the global outlook as a good way to kickstart the day and make sure everyone is awake and paying full attention. Hopefully it's going to be a very interactive panel, and we're going to rely on you in the audience too to come in with some good questions. So please prepare yourselves to join the discussion. But I have to say that as I start this panel, I have a sense of déjà vu. I moderated a panel on the global outlook last October at our annual meetings. At that time, the global economy was sputtering, but we all had confidence that the global recovery would finally gain traction once we got into 2014. Well, here we are, midway through 2014, and the global economy is still sputtering. In fact, the first quarter of this year registered global growth of only 1.6%, one of the lowest rates of growth since the global financial crisis. Nevertheless, there's, I think, still a lot of hope that finally things are beginning to get going. Certainly, various business sentiment indicators are turning up. Some of the data is turning up, particularly in the advanced economies, less so in emerging market economies. And certainly financial markets seem to be in a very good mood. Strong risk appetite, equities are up. In the US, up 10%, in Europe, up 5%, up to in emerging markets. Volatility is very low. Rates are down, bond prices are up. I think widespread expectations that central banks are committed to being very supportive of the global recovery are helping this good mood. But what are the risks that, again, we could be disappointed? I think the key theme for the discussion here is, what is that we should be expecting going ahead? Are the projections that I think most observers, including ourselves, have that the global economy will indeed gain pace in the second half? Will those projections be realized, or will we again be disappointed? Will we begin to have to learn to live with a new reality that perhaps the global economy just is less dynamic than we would all like to think? So a great set of issues around that, and I think we perhaps start with Axel to get a view from Europe. I think everyone today in particular is thinking about Europe and the decision by the ECB, wide expectations that the ECB will provide more support for the Eurozone economy. Axel, how do you see Europe within the global economy? How do you see the progress being made towards the recovery in Europe? How concerned are you about very low rates of inflation? And what do you think the ECB should be doing today? And what do you expect them to do today?
It's many questions. So in general, I think things are improving, but I think we're very far off still a healthy and sustainable recovery. Metaphorically speaking, I would say 2 years ago in those panels, the Eurozone was in the mud up to its nose. It's now in the mud up to its neck, and accordingly large is the risk of setbacks having big effects. So I'm not at all sort of completely sure that everyone understands that whilst we're moving in the right direction, we're still very far off what actually other economies have achieved coming out of the crisis. If you look at what's ahead, Germany this year will grow at around 2%, France and Spain around 1%, and Italy will have a black zero. Actually, Italian GDP has shrunk over the last 10 years, and it's not even reached yet again post-crisis throughs. So if you look at the large economies, the current distance from pre-crisis peaks, in Germany, we're above pre-crisis peaks for 4%. The US is 6% above, so Germany has not been quite as strong coming out of the problems as the US has, but the total Eurozone is down minus 2%. If you look at Eurozone ex-Germany, it's minus 5%. If you look at Italy, it's minus 9%, and countries around the Eurozone, Portugal, Spain, and Finland, minus 7%. The Netherlands actually, quite surprisingly, minus 4%. So we're not yet at the point where we've actually reached the stage in terms of levels of GDP that we were at before the crisis. Accordingly, everyone feels not better off, but worse off than before the crisis. And if you look at unemployment rates, they've moved up from just under 8% to now 12%. They're coming down very, very slowly. Again, massive unemployment, in particular in some of the peripheral countries. And if you look at stock markets, so you don't look at income but wealth, only Germany has come with the stock market to new valuations are above pre-crisis peak. The US is actually in the same position. Europe's stock markets are still down from pre-crisis peak. So wherever you look, whether it's unemployment, whether it's income, whether it's wealth, a lot of people in Europe still feel that we're in a deep crisis. And whilst we're moving in the right direction, looking at where we actually stand in that, we're still in a very difficult situation where setbacks could have a big impact. And just on ending, I'd warn a bit against the expectation that the ECB can fix many of these issues. If you look at the Fed, when they announced their QE program, they put in a rate of unemployment. I don't think it's quite the right thing to do. So as a former central banker, that's not how I would frame monetary policy. But they named an unemployment rate of 6.5% as the one where they will stop expanding the balance sheet. And if you look in Europe, if the ECB were to put any such number in, it would be double-digit, because any not double-digit number would not be consistent with the kind of structural impediments we now see in the Eurozone. So even the fact that many in the market expect major action from the ECB, that will just help stabilize the cyclical position. They cannot change the structural, and I think the ball there is firmly in the courts of governments, and I haven't seen sufficient action on the side of governments to deal with structural issues, unemployment, labor market, pension and other issues. Those are the things we need to deal with, and we need to deal with it in a very difficult starting position that is coming out of a crisis.
Thanks, Axel. Rich, you've just flown across the Atlantic. What's your view on the US economy? Very weak first quarter, largely attributed to temporary factors. Do you think the US economy is going to come steaming back in the second quarter and through the year? Or how much impetus is there in the US economy? What are you worried about in terms of achieving a better growth record ahead?
Well, you know, for each of the last 5 years coming out of the Great Recession, the U.S. economy at the end of each year has grown with a 2 handle, 2.1, 2.4, and I don't want to be boring, but 2014 is going to be another 2% handle. We're in a new world, and in a world where we've got to get used to robust growth in the U.S. economy being a 2% growth rate. As Axel said correctly, there's still an output gap, conservatively estimated 3 or 4% of GDP, maybe 6 or 7, but there's still an output gap relative to pre-crisis trends. Interestingly enough, the CBO only this year has acknowledged that there is at least if you define permanent as 10 years, and I think practically in economics that's fine, that the CBO is now acknowledging that there will be a permanent hit to the level of U.S. GDP from the financial crisis. They've revised down their idea of the level of potential output in the U.S. pretty substantially. So another 2% year for the U.S., obviously Q1 impacted by bad weather, and Q2 will be stronger, but the average of Q1 and Q2 is going to be 2%. We may get 2.5, closer to 3 in the second half, but the 4 quarters, that's the world in which we're in the U.S. And I think just to broaden it, if you go back to 2009 and 2010 and the first year or two recovering from the crisis. We had a very sharp snapback in growth in the emerging economies. And the wisdom then was in a new normal world, you've got robust EM growth, and then the rich countries will lag behind. I think the biggest development in the last several years has been not only the slowdown in recorded growth in prominent EM economies, but also the slowdown in estimated potential growth rates as well. So to conclude, 2% isn't outstanding. It looks disappointing compared to pre-crisis trends, but that's sort of the world that we're in the U.S. Right now, and I think for the foreseeable future. And obviously that will factor into Fed deliberations down the road.
Gavin, you're based here in London. Be interested to hear your views on the UK economy, perhaps the strongest performer last year and this year, surprising many of the pundits, certainly surprising my former colleagues at the IMF. Perhaps you could give your thoughts on the UK, and if you have any thoughts also, want to comment on US or Europe that you've heard from Axel and Rich, that would also be interesting.
Charles, I think the UK is an interesting warning that economists can be spectacularly wrong in their forecasts. Everybody in the audience knows that. They don't need to be reminded. But if we were sitting here a year ago, we would have been very gloomy, uniformly gloomy, about the United Kingdom. There were still 3 people on the MPC voting for more quantitative easing 12 months ago. And it appeared like we were stuck a little bit in the trap that Axel was talking about in Southern Europe, where growth was close to impossible. We didn't know how to generate growth. And many economists were becoming very pessimistic about the policy mix, saying that if the government was going to continue tightening budgetary policy, then there was nothing monetary policy could do to stimulate the economy. And almost at the moment of peak pessimism, the economy suddenly moved into really a rampant period of growth. Our figures in the UK they tend to be very misleading, our GDP numbers, especially early in a recovery phase where we miss a good deal of, apparently, the recovery. But I think we've seen growth properly measured at about a 5% rate in the last 12 months, real growth at about 5%. Now, why did it happen, and what does it tell us about the future? I think it happened primarily because there was a heck of a lot of pent-up demand in the system. Consumers had postponed purchases of consumer durables, and households had not been moving home at anything like the normal trend rate that they do. So I think only a relatively small change in psychology produced a big surge in pent-up demand, and actually showed that monetary policy, if it's aggressively easy for long enough, can generate a strong rebound in activity. Now, it's been a very British rebound in activity. So it's been housing dominated, it's been London dominated. It's broadening now, I think, outside of London into other parts of the United Kingdom. But it's still, if I were looking at this with a German hat on, Axel, I'm sure I would think it was unhealthy in the sense of, it's not a trade and investment generated recovery, and we have to admit that. But it's better than nothing, folks. It's better to have 5% growth, which you're concerned about how you can rebalance it and how you can control the potential inflationary consequences, than worry that you were stuck in a recession forever. I think one of the things that Britain is now going to run into is a great issue that Rich and Axel have both talked about, which is, where is potential output in our economies today? The Bank of England at the moment says that we're about 1 to 1.5% below potential. So we have really only a small amount of additional scope for growth. That assumes that potential has come down an incredibly long way since the financial crash. Probably we've lost, on that kind of assumption, we may have lost 7 or 8 percentage points of potential output, not actual output, in the wake of the great financial crash. And there are similar estimates for the United States and even bigger estimates for Southern Europe, not for Germany, but for Southern Europe. And I think central banks and policymakers generally have to decide what they're going to do about this. Are they going to accept these much reduced potential ceilings on the economy and accept that we've permanently lost 7 or 8 percentage points of GDP per annum ad infinitum, and we're growing less too, by the way. It's not just that the ceilings come down, it's growing less rapidly from here. Or are they going to push up against that ceiling and try to get closer to the long-term trends that these economies were on, prior to 2007, much of which may have been bogus. I mean, in the UK and in Spain, we can obviously see clear examples why the 2007 levels of output were not sustainable. But how much are they going to push up against that sort of theoretical limit? Are they going to accept that we have, as a result of the calamities of 2008 and before, have we permanently really made these losses? And I think the UK is the first one. It's going to bump into the ceiling first, and we'll see how the central bank responds. They're going to respond, I think, by trying to delay rate hikes. I don't think there's a majority on the MPC for rate hikes, but I do think there's a majority for considerable early action on regulation of the financial system to try and dampen the housing market. And that could well be a lesson which other central banks are about to follow.
Right. I'd like to come back to that issue, but perhaps go first to Jim for market perspective on the overall environment and the consistency between this very strong risk appetite, strong upward movement in equities, and at the same time, declining rates, low vols. To what extent is that reflecting a view that central banks are going to be totally supportive and pushing the envelope, as Gavin suggested? To what extent is it reflecting a greater confidence in the underlying strength of the fundamentals of the economy? How do you see the relationship between the market and the underlying economy? Are there tensions there, or are they in sync?
Yeah, obviously it's a very interesting time for financial markets, and I suppose there's a lot of markers you can point to. I typically look at 4. So firstly, asset market volatility is at or near record lows. You look at forward exchange, for instance, and we're back at that 6-month period in 2007, right before things started kicking off. So record lows there. U.S. equity markets, as was already said, are back at the highs, and if you think about it from a valuation perspective, Shiller PE levels are back in the mid-20s, when PE, the E part of PE, is also at record highs. U.S. credit spreads have returned very close to the lows, and just thinking about what Axel said about Europe, Italian and Spanish bond spreads to Germany are back to where we were around the time that the Greeks had their first package. And I think remarkably, in the last few months, Portugal has been able to go back to the market. Greece has done a syndicated deal, and again, a year ago, it was unthinkable that could happen. So we're in extraordinary times, and the worrying thing is these things, especially the level of volatilities, don't tend to last. Now, to be fair, Gavin and I had this discussion before the session. It's never great advice to say volatility is low and therefore you need to do something. You have to have a framework around when things will change or what will change it. Is it being driven by central bank policy? Almost surely central banks have something to do with it. We've had unprecedented policy easing in the last 6 years. With all the talk of Fed tapering, the fact is it's still happening. So tapering is just less easing as opposed to real tightening. As we know, the ECB is going to announce probably something today. It would be a very big surprise if they did not. And the BOJ has set the standard in terms of quantitative easing. If they keep going at this pace, which all suggestions are they will, their balance sheet will be around 60% of GDP by the end of this year. So it's central banks are part of it. Can it last? Sure, and certainly our advice, at least for the first half of this year, was to stay the course, that we don't see any real obstacles to asset prices continuing to do relatively well. But really, this can last under one very important condition, in my view, which is inflation in large developed economies needs to remain well behaved. And what I mean by behaved is it has to stay in the sweet spot of not going into deflation or not beginning to see a pickup in inflation. So you think about it from the point of view of the US and Europe. For the Fed, the difference between a 1% core PCE and a 2% core PCE is enormous, given that policy is extraordinarily loose. And we've been at 1% core PCE for a very long time, and that's allowed the Fed to look at the market and say, we don't need to do anything, and say that very credibly. And in Europe, I sort of phrase it as we're in the deflation sweet spot, that we're not quite there. And everyone knows that as we head toward it, the ECB is going to act. So for asset prices, it's been great for bonds and great for equities and great for Europe across the board. So kind of long story short, I don't think it's a mystery in terms of why we're here. Macro volatility has been low. There's been a lot of central bank liquidity out there. So it's a good environment for markets. And if you want to ask yourself what will change that, I think the key variable here is inflation. And I look at the US, we should hope as a room that the recent pickup in core PCE, which no one seems to be talking about, is a head fake, that it's not going to be sustained. And in Europe, we got to hope that the ECB is able to avert the deflationary risks that are clearly picking up.
Thanks, Jim. I'll come back to you, Axel, on this issue of what central banks can do, what they should be doing. In your initial remarks, you, I think, suggested that we shouldn't expect too much from the ECB today, and that a lot of the problems in Europe are structural problems that are not susceptible to monetary policy. One set of issues relates to the continued segmentation of financial markets across Europe, and in particular the fact that borrowers in periphery countries continue to face substantially higher interest rates than they do in the core. To what extent is this a problem related to issues that the central bank can address? Are there instruments that the central bank could use to deal with that issue, or is this, again, something that needs to be left to governments?
Well, so that's one of the reasons why I started with the growth figures. I'd be very surprised if a corporation in a shrinking economy would face the same borrowing cost as one corporation in an economy that grows at 2%. It's just very unlikely that this is the case, independent of whether you're part of a monetary union or not. And the divergence you've seen in Europe is largely structural. Go back to, and Gavin mentioned that, and it was also mentioned by Rick, that the issue about the long-term structural either unemployment rate or output gaps. If you look at Europe, you can actually start counting in terms of years lost. In Germany, since we're past the pre-crisis sort of levels of output, it was like a setback for 3 years. But we will never recover the differential to had this crisis never occurred and actually growing out of the crisis. So there's some persistent loss in output. And at some point, when you actually pass past levels, that doesn't influence the mood as negatively as it does. And I think part of the recovery story in the UK comes around that once you've actually left levels from before the crisis behind you, people feel better off, even though it took some years to feel better off. Look at Italy. Italy output is shrinking. And so even if you take a potential growth rate and put that at zero, at the moment, the output gap continues to increase. So that will be a long, long period of time. We're already 6 years behind the crisis. Actually, Italy has not yet reached the through that they fell to with a pretty big drop when the crisis occurred. So it'll take a long time for the mood and the sentiment to occur. And that's where I think the big issues is. Central banks can do things. If I look at my list, what the ECB can do, there's a mixture of, I would say, orthodox and unorthodox measures that they're talking about. And if you look at the whole discussion about, take 5 issues. If the ECB really wants to increase the size of its balance sheet, and people believe that the size of the balance sheet matters for interest rates because it helps, and that was how the Fed portrayed it, to push interest rate virtually into a negative territory, then basically the ECB should have stopped the early retirement of long-term refinancing operations more than a year ago, because the ECB's balance sheet started shrinking already a year ago, whilst the Fed's balance sheet has actually increased, and in terms of per GDP has now surpassed that of the ECB. Prices are tending to be more flat now in Europe, and I don't think that's going to go away, because there is a big lag of demand, and the whole issue of the output gap is, with current output gaps in the euro area, there is no demand-driven increase in prices, and at the moment that is what I think is really explaining the low level of inflation. But the ECB could do a number of other things. They could basically eliminate reserve ratios, in which case they would put, and they've reduced it from 2 to 1%. If they eliminate it, there's 110 billion of excess reserves that then would be excess reserves, because they're now minimum required reserves, and the ECB would push that back into the market if at the same time deposit rates go into negative territory. They could stop absorbing 165 billion of S&P-related liquidity that they currently absorb in a weekly operation. They're in full allotment mode, so there is not really a limit to liquidity that is provided, so the whole absorption sort of might be looked at differently in a full allotment environment. And if you add up all these things, excess reserves 90 billion, minimum reserve requirements 110, 165, the ECB could easily, if they had a small purchase program, say for asset-backed securities, which could be reminiscent of a standard program that we did for covered bonds earlier on, they could buy, the market is around 100 billion, even if they were to buy half of that market, the ECB could have an impact of 400 billion additional liquidity in the market. But I can tell you, the one thing that will not happen is banks will not use that additional liquidity not deposited with the ECB anymore to start going out and start lending, because they're shrinking their balance sheet. They're facing an asset quality review and a stress test. Banks at this point in time will not increase credit to the economy. It's like pushing on a string, and a lot of the things the ECB can do is alleviate balance sheets of banks. Yes, that's right, but that is not necessarily in a bank-based system already ensure that the banks will actually then go out and do their job and lend to the real economy. So I think most of what the market wants to see is the market wants to sell some assets to somebody that's willing to buy them, and if that be the ECB, so be it. The market, in my view, is wrong if people believe that these actions would lead to a strong impact on the real economy. It will improve the mood, but it will not improve the real economy.
There's a follow-up there. Do you think if the ECB lowers the interest it offers on its deposits to below zero, would that have any impact on bank behavior and their willingness to lend?
Yes, they stop depositing at the ECB because they don't know how their risk management systems can keep with a negative rate there. So what will happen is excess reserves at the ECB will disappear. They will go into cash or other forms of very short-term liquidity, but they will not start lending to corporates at any big amount. So I think this is, again, we reached the point where this is more like pushing on a string and doesn't really impact on the real economy at this stage.
Rich, coming back to you, I'd be interested to hear any thoughts you may have on Europe and what you think the ECB should do, but also if you could talk a little bit about the US situation and how you see spare capacity, and in particular the slack in the labor market. I think the Fed retains the view quite strongly that there is very substantial slack in the labor market. It may have reduced its estimate of potential somewhat, but I think it still believes in large slack in the labor market, providing plenty of scope to keep interest rates lower for longer. Do you think there are risks that, in fact, labor markets may turn out to be somewhat tighter than the Fed has convinced the markets to believe, which could lead to some repricing at some point?
Yeah, of course, there are always risks. My sense of the Yellen Fed is that, and this is based upon Yellen's comments, she spoke a lot more when she was vice chair than she has as chair, but for her comments as vice chair, I think that the Yellen Fed, the core of the Yellen Fed, believes that there's more excess capacity in the economy relative to some of the measures that would define the NAIRU at 6 and basically say it's eliminated. I think Yellen's also in the camp that thinks a lot of the labor force decline is discouraged workers and can potentially rebound, but they're pragmatic. They're not stubborn. And I think so long as core inflation, as was mentioned, is below 2, the bias at the Fed will be to re-energize the economy. I, for example, don't think that the core of the Yellen Fed thinks that wage increases are a bad idea. And we've had declines in real wages for 6 years. At some point, workers can get a real wage increase. So long as that's not passed through inflation expectations or higher core inflation, I don't see the core of the central bank leaning against that. I think the key point for the audience, and I think both Gavin and Axel said it well, is that there are a lot of uncertainties now. Central banks do have some cushion in that the major economies, including the UK, now have inflation, especially in the US and Europe, well below the desired level. So there's some room to maneuver there. And I think what we lose sight of sometimes in discussions about the complexities of potential output is, yes, potential output is hard to measure, but if you're mismeasuring it, you'll get a pretty prompt signal, which is that your inflation measures are going to move above where you would like them. And so I think the Yellen Fed will be looking at inflation. If inflation is rising but below 2%, I don't think they're going to be worried too much about mismeasuring potential output. The problem in the bad old days, when some of us started our careers in the 1970s, is that the Fed kept estimating, we know, based upon the green books, a huge output gap that wasn't there, but there was also 9% core inflation. They could have looked at the inflation numbers then as well. So I think that right now the cushion that central banks have is that inflation's below target, and as we progress, we'll learn more about the output gap. But remember, the Fed at full strength has 19 participants, 12 of whom vote, and there are some more hawkish district bank presidents who see the issue the other way. But I think the focus will be on aligning what we see in the labor and the goods market with what we see in the inflation data.
Gavin, I'd be interested in any comments you may have on either Axel or Rich's thoughts.
The inflation issue that Rich raises is very critical, and I think it comes down to which risk do you want to run, actually, Rich.
Yeah.
I think there is a heck of a lot more debate under the surface in the Fed than is currently apparent. I think what has happened in the Fed this year is, after quite a battle last year between the doves and the hawks about tapering, they kind of punched themselves to an agreement that they would taper this year, and it's been almost set in stone. I mean, I think to change the pace of tapering the balance sheet purchases would take a really big deviation, either on inflation or on growth, or a massive bubble in the financial system or something. Absent that, they've kind of agreed to just do this, get it done. They're going to have to do it sooner or later, and they appear to agree on it. They're unanimous on it. But I do not think they are unanimous by any means on what to do next.
Agreed.
And I don't think they're unanimous on whether to raise rates in 2015. And I think there is still quite a strong dovish view centered around the chair. I think Stanley Fischer may be in that, but with some tinges in the other direction. Bill Dudley is, President Williams from San Francisco is, and there are a few others who actually haven't really in their hearts accepted the need to tighten rates at all next year. And I think this could become a real big battle. And in their hearts, I think they believe that they should be taking risks by pushing output as far as they can towards its old trend line, not the peak, Axel, because they're above it, but to its old trend line. And they know they're taking some inflation risks. I mean, President Williams has said directly that he thinks inflation should run above 2% for a period of time in order to try and push the growth rate higher and the unemployment rate lower. So that is alive and well and kicking, and I'm not really sure how this is going to be settled, but I wouldn't be surprised if the Fed again next year turns out to be on the dovish end of what people expect, because I think the doves are still basically in control, and they've been silent this year, really. The thing I'd like to maybe ask Axel is this, Axel. You were, I mean, you know, you're the best person in the world to ask this, so I'll never have a chance to do it again, probably. If the euro area does indeed face a very prolonged period of inflation below the objective, I'm not saying deflation, but a very prolonged period of 1% or below inflation, do you think the Bundesbank now would accept a sort of more plain vanilla quantitative easing by the ECB, as understood in America? Or do you think that is still really something that the Bundesbank would not accept?
Well, it's really for my successor to decide.
Yes,
so,
I know, but I'd like to know what you think.
I spent 3 years outside central banking by trying to not comment too much in detail on decisions that are actually taken. But, you know, I talked about options, and I think there are options. I would make 2 points just to bring 2 issues back that you mentioned. The first one is, in my view, the issue of the old trend line is one that even in the US you would put a question mark to, in my view.
Yeah.
Because if you look at the US, the one feature that you clearly see is that labor force participation rate has been trending negative. And in Europe, actually labor force participation rate has stayed constant throughout the post-crisis. So I would make the point, and I've seen some figures, that actually whilst European and US unemployment rates shot to 10% in 2009, the Fed's policy might have helped that, adjusted for participation rate, US unemployment rates virtually stayed at 10%. Yeah. That's the figure, whilst European unemployment has moved up to 12. I don't think the central bank has played a big role except sort of facilitating and smoothing the exit in the participation rate to really push the economy back to the old trend line. And in many recessions in the past, if you look at GDP over a long horizon, once you've had such a big crisis, and this was the big crisis, biggest crisis in post-war history, there's not a big tendency of GDP to resume the old trend line, but actually to grow at the same pace at a new trend line that is substantially, not 100%, but substantially below the old trend line. I think that's exactly what we're seeing in Europe. In Europe, it was always a new trend line. We called it hysteresis. Unemployment after a crisis did not reverse back to the levels it was at before. And if you don't actually increase the labor force, it's very to the old labor force levels, then I think it's very hard to see that. So my view is the ECB will understand that there are more difficult problems. I wouldn't rule out that they try and do targeted programs to alleviate certain market segments, like an ABS purchase program or a covered bond program. But I agreed to a covered bond program in 2009. It was standard monetary policy because there was an illiquid market segment and you're trying to liquidate that market. As the central bank goes in as the ultimate buyer, it increases the attractiveness of that market segment for the penultimate buyer and for others to go into that market. So I wouldn't exclude something like that, but I wouldn't see it as a big discontinuity because the Bundesbank was at the core of driving exactly such programs over the 2008-9 period when we said we do need a program for covered bonds because that's something where banks and actually where we can help the market. So the only issue in Europe is sovereign bond purchases. Because there is no European issuance at the level of the euro area, it always has a selective single government winner-loser type of dimension. You fund some governments whose bonds you buy and others you don't. And I don't think that which I see occasionally, an average program where you buy the GDP or capital ratio weighted average of European bonds would be something that would reduce spreads. If you look at the issuance in the European market, it could actually be spread augmenting. It would mostly profit the German bonds market. And if anything the ECB wants to do, it's probably not giving a funding line to the German government, because bond rates are already very low, and I don't think they need artificial demand to drive them lower. So you have to really watch it. If you compare the US and Europe, Europe does not have that single entity issuance at the European level. Everyone's working towards that. But actually to think that we get there in the point just after the crisis is very unlikely. Long term, we'll get there. I'm pretty sure that now common funding instruments are no longer ruled out by European policymakers. But there'll be music in the future. It's not an option at the moment, at least not a sizable option in my view.
Rich.
I just wanted to reinforce Axel's excellent point. He reminded you, but it's indeed in 2009 there was a very, very prompt and important program in covered bonds. I think the challenge as an outsider looking in it is that you don't have the securitization markets in Euro that you do. And the challenge, as Axel said, is exactly right. If you do a capital key or GDP weighted program, what you end up doing is buying a lot of bonds in a market where there's relatively little gross issuance. And so what that does, if anything, is it potentially could widen spreads in Europe at the sovereign end. And the challenge in Europe is that the segmentations, not so much now in the sovereign market or in the corporate bond market, the segmentations in the SME lending. So a small company in Spain pays about a 300 basis point higher borrowing rate than an otherwise identical small company in Germany. And I think the challenge is coming up with a program that could alleviate that impairment to the transmission mechanism on the continent where you don't have the securitization market. But just going in on a capital key or GDP weighted basis in a world where already sovereign spreads have come down dramatically and absolute borrowing costs in Europe now are historically low, is not going to really do a lot at the margin.
Tomorrow we're going to have another chance to come back to these issues of the European economy and what more can be done. But I wanted to shift gears a little bit before we open up to the audience questions. We haven't talked about emerging markets at all so far. We haven't mentioned Japan either. We're going to have a lot of sessions later on today where we're going to have a chance to get into depth on those. But I just ask each of the panelists, what are the main issues that you worry about? What are the downside risks that you worry about that come from outside US and Europe, whether housing slump in China or increased conflict in Ukraine and Russia or something else? Maybe no one has thought of it up to this point. I don't know. Jim, you want to kick off on that theme?
Yeah, let me make, I guess, a comment on emerging markets and one on Japan. So I'm going to probably be contrarian and say that I think on emerging markets the downside risks are very well known. And if anything, in China, for instance, if you look at 2 years ago, the market saw it unthinkable that China could have a 7% growth rate, even at the time where you can see the long-term economics changing. So the market has been very slow to recognize the risks around China, and as often happens, once it starts to see it, it starts to overshoot. And so we ran a survey on where people saw China's growth rate in 2014, just after the government printed its 7.5% target, and I was struck by the survey showing 85% of 1,000 investors saw China growing at or below the 7.5% target set by China. And I'm not saying that's wrong. I'm just saying it's a very different picture than it was a couple of years ago, when we should remember that as a market participant, risk premia in emerging markets over the second half of last year shot up quite significantly. So there's a reasonable amount of risk premia to compensate you for a reasonable amount of macro risk. And on Japan, it's the story that went away. So no one wants to talk about Japan anymore, and you can look at that and see it in the Nikkei. You can see it in the exchange rate. Nothing's moved over the past 6 months. And I suppose our message is that that's that makes a lot of sense, because you look at the first 6 months of this year in Japan, and we had a big tax hike in front of us that was creating anxieties, because the last time Japan did it, things went pretty badly. There was nothing new on the policy front, either fiscal or monetary. We had a significant decline in U.S. Treasury rates, which was not expected, which at least secondarily probably had an impact on the Japan story. And you sort of had no marginal investor. The early investors in Japan, which were non-Japanese, were pulling out, and the Japanese weren't in there yet. And when I look forward to the next 6, 12, 18 months, all of those things should start becoming a lot more interesting. And I think in terms of Japan, the way I look at it is that no matter how you view the story, you have a country that has successfully exited deflation for the first time in 15 to 20 years. And from an investor point of view, what you need to understand is that the massive Japanese financial balance sheet is basically positioned for deflation. It's an economy significantly overweight fixed income, significantly underweight of equity, and at some point that will need to change if the Japanese investor is going to be able to earn a return similar to what they were able to earn in the last 15 to 20 years.
Gavin, you want to come in on
Yeah,
where you see the risks?
I think when we look at the financial markets now, we all have a feeling of somewhat unease. I mean, Jim has said everything's expensive, and volatility in the markets is low. So it's actually quite cheap to insure yourself against a bad outcome if you choose to do that, which I think is advisable. But I think we also need to try to identify, if we can, what would the shocks be, or what would the changes in the environment be that might be the harbinger of a much worse outcome. And for me, there are, four, and I'll just briefly mention them. The first is that the markets do it to themselves, like they did in 2007-8. They just become so exuberant that even a minor touch on the brakes by the central banks, creates a huge deleveraging in the system and a much worse outcome. I actually don't think we're very close to that, and the reason I don't think that is that there isn't much leverage in the system, as far as I can see. And I think that's a very big difference with previous bubble peaks. So I don't think we're there yet. The second would be inflation. Jim's talked about this. If we see inflation in the United States doing what it's done in the last 2 months, over the next 3 or 4 months, we're into a different Federal Reserve. And I think, that clearly would worry me. The third is that the China hard landing in property, which I think they are having actually, turns into a much worse outcome for the Chinese economy as a whole. The arithmetic that I've done on this, I find it actually hard to see how China has a hit from property that's anywhere near as big as what happened to the US in 2005, etc. The US hit was probably worth, with all of the financial consequences, 10% of GDP or something like that. The worst I can come up with in China is about 4% of Chinese GDP, which as a global shock is not very nice, but it would be spread over 2 or 3 years, and I don't think it's of the same order as what happened in the Western system. But it's certainly a worry, and I'm worried I could be wrong and it could be worse. And then the last one is that Europe slowly morphs into Japan, and that actually we're wrong, Axel, and monetary policy should be a lot easier or something, or maybe the euro should be a lot lower. And we don't have the same weapons available to us in the euro area that Japan utilized 2 years ago, basically devaluing the currency through quantitative easing, but essentially devaluing. And therefore we just get trapped in a low inflation, high unemployment trap, which we then can't get out of. I think we're nearer to that than some people think. If we were in that position, I think the ECB and others would do different things, but that would certainly be a worry for me.
You know, Axel, are you worried that Europe is about to morph into Japan, and what else are you worried about?
Well, there are risks in Europe, and I said, you know, things are improving, things are going in a better direction, but we still have a lot of risk out there. The big issue I still see is whatever these measures are that central banks would take outside domestic reforms in some of the countries that are hit, in particular in the periphery, but including Italy and France. Any such policy measure at the European level is going to profit Germany over proportionally, whether it's a weaker euro, whether it is a program by the ECB that would sort of be across the euro area. Any of these things are basically going to profit the most flexible economy in Europe most. And that is going to increase the tension between core and periphery. The core has actually been shrinking. If you look at the last GDP numbers, it's not just peripheral countries. Even the Netherlands and some of the countries like Finland have not done that well. So the core of the problems in Europe is more, in my view, structural. And if you look at what Japan is doing, forget about the first and second arrow. Nobody's getting excited about that anymore, as it was just said. The real issue is, will the third arrow be a bullseye or will it miss? And if it misses, there is no long-term hope that they would come out of these situations. So again, fiscal and monetary can help you buy the time to get the fundamental reforms doing. But even in Japan, getting out of this trap, out of the situation, requires a more flexible labor market. It requires immigration. It requires a lot of things that were to be done. And that's where I'm on Europe. In the general direction, I think what we shouldn't forget, and I see more potential ahead for repercussions and nervousness in the market. In the long term, we're all coupled to the dollar and to the treasury rates. If you look at 10-year treasuries, when the US debate was about tapering, it immediately had an impact on the most dollar-reliant fragile 5 countries that had double deficits, fiscal deficits, and current account deficits. It was just said, I think quite rightly, and I agree with both Rick and with Gavin, the US has agreed on how to run off the balance sheet in terms of additional purchase and when to end that. There is no agreement about rates. You can actually see that in the dispersion of the committee members, how that has increased if in the answers on 2 years, 3 years out, how that's going to go. We need in financial markets, as long as that uncertainty is there, and some of the hawks want to start early but go slower, and some of the more dovish members say, let's push it out and start later, and we promise to go faster if needed. The whole driver is going to be the inflation rate by the end of the year in the US. I fully agree to that. And in our projections, actually, inflation in the US will surpass 2% by the end of the year. Then we are talking a different set of policies. And if that comes in and some interest rate tightening is priced in a more front-loaded fashion than it is now, which I think is likely to happen, this will have another round of impacts on emerging markets, on the Fragile Five, and on the economy in general. So I don't think we're in a situation where you can say, that the problems are behind us. There will be more, in my view, repercussions and fallout in the economy. Every US tightening cycle has been associated with repercussions in the global economy. I don't have the hope it will be different this time around. So I really fear that at this point in time, we really need to focus on the fragilities in the markets and not on the segments that run well.
Jim, you want to come in?
And just, I think, when I think about risks, I often try to focus on what we don't know already. I get the impression through all of the investors that I speak to that they understand the concern about inflation. They understand the concern that if U.S. rates start going up, it could be very disruptive to financial markets. But the common view is that the U.S. will be fine. It will affect the rest of the world much more in relative terms. And if you look at the real story of financial markets in the last 2 to 3 years, it's been basically the U.S. and Germany taking off relative to the rest. So from a valuation perspective, I feel very nervous with this view that U.S. financial markets will relatively fare better if the Fed starts raising rates. And again, when I think about concerns, no one seems concerned enough anymore around peripheral European debt. And if you look at peripheral European debt and the cycles of stress, they were always preceded, or at least coincided with, disappointment in growth. So we've had 2 years where Europe's been on the mend. We've gone from very weak growth to modest but better growth. And there's telltale signs that we've seen the top in that. So I'm not saying we're moving into a recession in Europe, but we're basically reaching the point that it will be hard to go further. And that could be a disappointment for a market that sees all the risks in China, all the risks in emerging markets, and no risks in places like the US and peripheral debt in Europe.
Richard, I ask you to come in, and then I'm going to open it up to the floor, so please
I'll
think
be
of your
quick, as I know
questions.
there's floor Q&A, but just two quick points. First on EM, I think the thing that Jim mentioned exactly right, relative to where we were 14 months ago before Bernanke's May 22nd testimony, there was very little cushion built in a lot of emerging market, whether you're looking at equities or spreads. And that's been restored through repricing. And I think what was significant about last year in EM is not only did you get the repricing, but you had a material markdown of potential growth prospects at arm's length by the IMF and others. Now, we know those are tricky, but that was sort of last year was basically the double whammy of hints of a Fed rate hike cycle and a marking down of potential growth. And I think a lot of that's already in there. On China, the size of the shadow banking system is material, depending on how you measure it, 1 to 2 trillion US dollars. But that's with a country with 4 or 5 trillion in foreign exchange reserves. So China has the wallet to deal with the problem. Really, the question is going to be on execution. On the Fed, I think the key point is tapering's a done deal. It's happening. I think with regard to the rate hike cycle, you know, what I've said and others have been saying now is that, and you're actually starting to see, Dudley has mentioned this recently, John Williams at the San Francisco Fed, the next big communication challenge for the Yellen Fed is going to be not on when the rate hike cycle begins, because I think they'll have to do that. The new challenge they'll have is communicating the destination. So right now the blue dots are saying ultimately in the year 2019, which would be the second year of Yellen's second term, they want to get to a 4% funds rate. They're never going to get to a 4% funds rate. That's looking through the rearview mirror. And the reason for that is that the neutral real rate in the U.S. economy, I think, for the Fed is going to be materially lower. It's not going to be 2% from an old Taylor rule. It'll probably be less than 1%. And so I think as the Fed begins to hike, they'll have the double challenge of when that first hike is and communicating the destination. But it's certainly they're not going back to 4, and they're probably not even going to go back to 3. But that's for another session.
Thanks, Rich. Okay, I'm going to open up to the audience up there in the front. Bring the microphone, and please state who you are and keep your questions succinct.
Yeah, Tom Harris from Standard Chartered. I have to say, for a session on the global outlook, this has been a remarkably narrow discussion on Europe and the United States. Apart from your last question, we've had no mention of 50% of global output. We've had no mention of Africa, India, Latin America, and indeed we've only discussed China in terms of risks for Europe and the United States. So in an attempt to sort of try and rebalance this a bit, could I ask 2 questions? The first is that a statistic that's not been quoted has been the very sharp reduction in cross-border capital flows over the last few years. And latest figures are out now. Admittedly, much of that is to do with southern periphery in Europe, but there are many people who believe that the impact of the regulatory agenda coming out of Basel is to significantly reduce capital availability for cross-border trade and investment flows on a global basis. Comments, please. The second is to pick up a point that Gavin Davis just touched on briefly in his introductory remarks and then didn't come back to. The discussion has been almost entirely in terms of monetary policy, quantitative easing. But Gavin also referred to the possibility of macroprudential action, particularly in the UK context. To what extent can the European and American central banks learn lessons from the Asian central banks in terms of macroprudential action to prick bubbles?
Those are two very meaty questions. Maybe get a couple more speakers to pose questions and then throw it all back to the panel. And I should just remind you that there'll be a lot more discussion throughout the day, including covering all the EMs and a discussion covering the prospects for capital flows. So we'll have plenty of time through the day to address all of these points. But a couple more questions and then I'll go back to the panel. Who else would like to? Over there? Yep.
Hello, David Mackey from JP Morgan. I'd just like to sort of probe the panel's pessimism about the euro area. I was very struck by Gavin's comment that at the point of maximum pessimism in the UK just over a year ago, when many people were talking about triple-dip recession, the economy then takes off, and the official GDP data say we've been growing at 3-ish, and Gavin thinks we've been growing at 5. And I'm just wondering whether the panel thinks that this may actually be something that surprises us in the euro area over the coming 12 to 18 months.
Thank you. One last question from the audience. Up here in the middle.
My name is Bartje Schotman from ING. Could you give us a view of how you think that the structural reforms that were mentioned that need to be done in Europe are actually going to take on? Are you optimistic or pessimistic that governments will start implementing those?
Okay, thanks very much. Why don't we go along the panel, give each of you a chance to respond to whichever of those questions you'd like to respond to. Rich.
Okay, since I guess we're going geometrically, so let me talk a bit on structural reform and talk a bit on macroprudential. On structural reform, and Axel and I were just discussing this in the speakers room, and I'm no expert, but it's my impression as a macro person looking at 30 years of experience, is that the structural reforms that in retrospect we say were successful and that were really important, say the German structural reforms a decade ago, they're the ones that initially had some front-loaded pain. A lot of political opposition. In the case of Germany, one could argue it cost Schroeder his job. And so the challenge we face with structural reforms is that the ones that work long-term create a lot of opposition and probably create a year or so where you have some negative GDP hits. And so the challenge we'll face in an austerity world is, can you put in place a reform that over a decade will work, that will have some upfront pain both politically and in the economic data? And to me, that's a very big question mark. I don't know. With regards to macroprudential, very well put. The huge challenge going forward for policymakers is that we all agree that the old model in which central banks targeted inflation with the policy rate is one that paid too little attention to the financial system. But the challenge is that although we all agree in principle that macroprudential is a good idea, we don't agree what it is, what it should look like. So my analogy with macroprudential is that we're all in favor of it, sort of like mom and apple pie, but we all have a different mother. And so until we agree on what macroprudential look like, it's more of a concept than a constructive guideline for policymakers. And quite frankly, they and we are all going to learn as we go along on that.
Thanks, Rich. Gavin.
Was it Tom from Standard Chartered? Tom, I think the 2 points you make are spot on. I mean, number one, mea culpa, how could we spend this amount of time not talking about the rest of the world? I mean, it's not a fair, it doesn't represent anything about the risks or the opportunities in the world economy, but it's just that there's a lot to talk about in Europe and the US. On the question of whether whether our central bankers can learn a lot from the Asian controls, macroprudential controls, I'm not so convinced. I'm actually more with Rich on this. I think that this whole macro-pru thing, which is motherhood and apple pie right now, is going to be a heck of a lot harder than people think. And actually, if you look at the experience in Asia, as the capital inflows in the last 10 years have become enormous, the central banks have really struggled actually to control the credit consequences of that. They've tried, and they've done a lot of new and different imaginative things. But I think a lot of this has leaked into credit. And I think, a big worry that I have about the emerging world as a whole is that many parts of it are in the midst of a credit bubble, and they don't have the control mechanisms that China has to bring it under control. And that's why I'm skeptical at the moment about some parts of the emerging world, compared to what I would have been in the past. The central banks are doing a lot on macro-pru now. Their conferences are full of it. But actually, it's a little bit like reading monetary economics in 1965. Friedman has spoken. The money supply is connected to the price level. Everything else is a complete, unknown. The links are unknown. The quantities are unknown. And I think it's a little like that now in macro-pru. We're going to go through 5 years of trying this. And I think we'll learn from previous mistakes. But the basic lesson from past macroprudential attempts is they haven't worked for very long and they haven't worked very well. So we have to do better than we've done in the past.
Thanks, Jim.
I'm going to partially answer a few of the questions. So firstly, I think the question on global capital flows is a very interesting one, because one of the standout market stories of the last 2 or 3 years is that in a supposedly really market-friendly environment, the Fragile Five were falling. And it was supposedly an environment where emerging markets were seeing unprecedented capital inflows. And yet those that were running the largest current account deficits weren't seeing the type of euphoria that you had seen in the past. And I think the drop in capital flows is probably a two-part story. Neither of them will likely go away anytime soon. One is the regulatory process, which is making banking systems much more domestically oriented, and the other is just a recognition that the banking system that lends the most to emerging markets by a fairly wide margin is the Eurozone banking system, and that banking system is under pressure to delever and will continue to be under pressure to delever for a long period of time. In terms of the questions on are we too pessimistic on the Eurozone and do we think we'll get structural reform, I'll sort of answer those together in the sense that Germany in the last 10 years is very unique in that it reformed without intense pressure from financial markets. If you look at the Eurozone in the last 4 or 5 years, most of the time that you've gotten structural reform, it's been with the gun to your head in terms of the market forcing it to happen. So in places like France and Italy, where you really need significant further reform, it's hard to see it happening with French bond spreads to Germany at 50 basis points and nominal yields at all-time lows, and Italy moving back to 100. So I think there's sort of a sequence of events that you're going to need to see more pressure to get that reform process moving faster and further.
Axel.
Well, let me take selectively some of the questions as well. On the macroprudential and whether the established world has learned some lessons from Asia, I would say yes, they have, because Asia didn't have a crisis this time around. This was a US crisis, it was an industrial country crisis, it was a banking crisis at the core of the most advanced economies, and it didn't have the same fallout in Asia. But what Europe is doing, look at what Asia did after the Asian crisis. They stabilized their banking system, they go for higher capital ratio, they were less dependent on maturity mismatch, they basically tidied up their foreign dollar currency funding reliance. So all of this has happened, and it's happened with a delay now in the banks. Most of the reforms that we're seeing in the banking around macro and microprudential is actually trying to learn the lessons of the last crisis, and it was a different crisis than the emerging market crisis. So I do not share the view that Europe and the established world is not learning the right lessons. It was a different crisis and different lessons to be learned. On the pessimism about the EU, look, I'm not pessimistic about Germany. Germany is doing great. Actually, in Germany, the growth trajectory is one where actually we are preceding and we're coming above our pre-2007 trajectory for growth. So we're actually catching up with some of the slow output growth we've seen in the early 2000s. And so depends where you look at, there is room for optimism. But if you talk about lessons learned, I think we're slowly getting to the point where many peripheral countries are starting to understand that they need to do similar reforms like the ones we've seen in Germany. And that's been a hard process. It's been difficult to get that language. As long as many countries funded at the same rate as the Bunds, there was no message from the markets. Actually, that was completely over-optimistic and too euphoric given the fundamentals in these countries. The market simply priced that wrong. Now the market looks at more differential pricing, and I think things are getting better. The point I'd like to emphasize most is the one that Rich made on reforms. It takes years to have effects. It usually has short-term, front-loaded cost, and the gains are only long-term. And Rich and I grew up in a sort of economic environment where you always learn to try and think about first best, second best, third best. And very often, if you're trying from a second best situation to go to a first best, you end up third best. And that's sort of what policymakers, that's a typical trap policymakers fall into. I was an advisor on the German government Council of Economic Advisors when Schröder did the reforms. He did a lot of reforms. It cost him his job. Well, there are casualties to history, but it did the right thing for Germany. And many policymakers have to take that long-term view. I can tell you what the usual problems are in policymaking. The best thing to do is do growth-enhancing reforms in the good times. But there's never the pressure, so they never happen. That would be first best. The second best is don't dismiss the need for reforms and not do them in bad times. It's second best, clearly, but actually, you know what third best is? Hope for better times to come so you can do reforms. And that's what I see too much around Europe, the hope that we wait for better times to do the reforms. That's not going to work because as many of these things are structural, the good times, the new good times are very far off. And therefore, there is a risk that we look too much at monetary and fiscal policy, which can buy time and basically paste over some short-term problems. We're not doing the right things. If those countries with 25% unemployment rate and 50% youth unemployment rate don't fix the youth unemployment problem, the young people will not wait for their politicians to get it and turn their countries around. They'll go where the jobs are. And the jobs are increasingly in the northern part of the countries. They're in Asia. They're going where the jobs are. They're not waiting for their country to turn around. If you take that young generation out of those countries, they will be stuck in a long-term trap because the most talented of the economy are actually contributing to growth somewhere else. It's a fatal assignment. It's a fatal situation. And I'm very concerned that Europe is going down that road, and policymakers fear the anger of pensioners and short-term voters much more than actually fearing that the young are walking out on them. That's a real big problem in Europe.
Well, thanks so much to all of our panelists. We could keep this conversation going probably all morning. Unfortunately, the time clock is now flashing red, so our time is up. But I think it's been a really rich discussion, and I'd like to thank our panelists for their excellent contributions. Thank you very much.
What a good start to the day. It's time to open up the IIF app if you have it on your smartphone or Blackberries, whatever. We're going to ask you a question. Before we do, while you're opening that up, I'll just introduce the next panel session. We're going to focus on technology's role in shaping the future of financial services and how they can help enable new products, new services, expand access to markets, and of course disrupt traditional business models. Hoping now for a wide-ranging discussion of topics such as mobile banking, new payment technologies, digital currency, and of course technology's role in expanding access to capital. Leads quite nicely into the question we're going to ask you next, the polling question. How great an impact do you think technology will have on your firm over the next 5 years? A great impact, some impact, or not a lot at all? I think from initial assessment we can see that no one is underestimating the power of technology in the coming years. Great. I think great impact is roughly winning. Well, quite obviously winning, really. Let me introduce our next panel. First of all, let me invite Jonathan Rosenthal, banking editor of The Economist. He's going to be moderating this session. Welcome. Also with him is Mr. Simon Smiles, Chief Investment Officer of UBS, Mr. Nick Shalek, partner of Ribbit Capital and advisor to Coinbase, and Mr. Derek White, Chief Design Officer of Barclays.
Thank you. Before we even start, I just want to say how very excited I am to be involved in this particular session, and no disrespect to the previous panelists or the previous speakers, but I hate to say it, there's only so much macro brew that one can take in a day. We're going to be talking about some of the fun stuff. Let's treat this not quite as light entertainment, because I want you to be thinking and engaging. But this is not macro brew. This is technology. This is Bitcoin. This is the disruptive influences that are going to be affecting your businesses. And I really want to encourage all of you to be, as I say, put your thinking caps on. We're going to do this as interactively as possible. The second reason I'm so excited is just because of the quality of the speakers we've got on this panel. This is a great panel. Two of the people on here have the very rare distinction of both being either 40 or under. That's the giveaway on that is that they're in the IIF Future Leaders. In fact, I'm sure you're under 40 as well, dare I ask. All of you are, I'm the only one who's not. But you also have that rare distinction of not just being young, but also having been around in that dark, prehistory days of ugly websites and early internet. Derek, who's with Barclays now, was involved in Wingspan. Anyone remember that? It was going to change. It was going to change the way we banked. The change has been a bit slower in coming than we may have expected then, or you may have hoped then. But we can talk about that. Simon was working on the sell side as an analyst, also in the early days of in the internet, and looking at how it was transforming businesses. He's now switched sides, is on the buy side, working for a large asset manager and assessing the impact on his business as well as the investments that his clients are going to be making. And Nick is, gosh, what do we call you? The gamekeeper, the poacher, I'm not quite sure. Nick is both involved in advising Coinbase, a Bitcoin firm that we're going to talk about, as well as involved in VC and investing. But I think before we even sort of dive into some of the detail, I'm going to hand over to Simon, because could you set the stage for us a little bit, both having sort of acted on the sell side as an analyst looking at internet industries and how they're transforming book selling, travel, all of those sorts of things, and now being on the other side in finance. And I guess the tough question is, how many industries has the internet touched that it hasn't totally transformed?
Well, I think there's a number of industries it hasn't necessarily totally transformed. Healthcare, the legal profession, and I guess to date, the banking profession, where you need a trusted advisor. It's not to say that going forward that completely isolates the industry, obviously, from the threats that digital provides. But with the brands that we have, with the clients that we have, with the data we have, the idea that we can embrace change, we can actually use digital to move to a better client experience, mass-tailored solutions. We can use digital to cut costs, as long as one's willing to adopt and adapt to this digital change. There's no reason to suggest that finance will necessarily go the way of a bookseller or a music retailer. Yeah. If we move on, Derek, I guess if you'd have been working for a bookseller 10 years ago, you might have given a vaguely similar answer that we've just had. You would have said it's all about the customer experience. People like to come in, they like to browse the books, they like to talk to us, we've got a relationship with our customers. Why is your institution different? Why are you not terrified?
I think when fundamentally, technology is transforming financial services. We have to recognize that. We're beyond the cusp of that. Looking at it purely as internet, I think, is a little bit binary. We have to look at not just internet, but digital and truly mobile. Because fundamentally, humans are engaging on either a DIY level, where they want to do things themselves, or they want to be able to engage with a human in some way, shape, or form. Increasingly, that's going to move into a space where there is artificial intelligence, where we'll get into avatars at some point. But that's really future. That's where we're headed. And if you look at how technology is transforming financial services, how it has already transformed other industries, back in the early 90s, the first financial services marketing on the web was on July 6, 1996, when a human or a paper-based transaction was converted into a digital transaction with the AOL credit card and First USA Bank online. On day one, that was 60,000 accounts on day one. The institution recognized that's transformational. That wave, that internet wave that started then, that led then to the creation of Wingspan, the creation of internet standalone banks, both captive internally as well as venture-funded initiatives, is seeing a revival in the mobile world. And mobile is creating, just taking experiences and designing a loan application that can be done in 30 seconds in a moment of convenience, or 90 seconds when you're sitting at your armchair at home watching the game. That fundamentally changes the engagement model that we have with our customers, our clients, and our colleagues. And I think we have to embrace that.
I'm going to follow up on that, which is just, you work for a large institution. It's got kind of legacy systems. I'm sure it's got a spaghetti of computers that don't talk to each other. You've got a bunch of people who are probably still saying to you, what is this Twitter thing, and how does compliance work? How does one actually try to embrace change in an organization that is so profoundly affected by technology, yet, and I'm sure, and correct me if I'm wrong, is probably in some respects deeply resistant to the kind of change that it brings?
Yeah, the amazing thing is, though, it's a human behavioral element. In many instances, people are intimidated by things they don't understand or don't know. And we've worked closely with our colleagues and our customers to help them understand and break down those barriers so that technology can be more easily adopted. But we take approach internally that if you look at how we're disrupting ourselves, how we're seeking to disrupt the industry, it's really a startup approach. From a mentality standpoint, in looking at if we were to create, and when we embarked on the creation of Barclays Ping It, which is our mobile money platform that started as a simple person-to-person mobile money service, it was only designed to do 4 things. Today, it's an entirely different platform. We're creating open APIs, and we now have companies that will be creating businesses off of that service itself. And when we started that process, the initial plan, and I'm sure many that are sitting in the audience today can relate to this, an executive or a team says they'd like to implement something, and the initial plan comes back, and it's 2.5 years to get something implemented. Well, that just isn't going to work. So we recognized we needed to change the way we worked and work like a startup. So we sat down, and there's some basic principles that we adopted. I myself, having worked in startups before, we just said we had to act like a startup. So when we attack any problem, any challenge, or the creation of anything new internally now, we look at it and say, recognizing all the brilliance and the greatness that we have in our institution today, if we were to start from scratch, like a startup, how would a startup do this? And that then started with Barclays Ping It. When we took a 2.5-year plan, collapsed it to 7 months, from concept to execution, took it to the market, the organization saw that. It created belief again in the organization that has had massive cultural transformation to where now we have approximately 40 of these mini startups in Barclays that we call hoppers, that we're running, that are little bonfires in the organization that are culturally transforming the place.
That sounds really interesting. We're going to come back to that, but I'm going to bring you in because you're involved in kind of deploying capital into startups. I mean, I guess in theory, you could have, gone the conventional, sort of, asset manager route and said, well, actually, we think big institutions, the incumbents are going to rule the earth as they have for the past 50 years. You've chosen not to. I mean, let's talk a bit about what you see as the challenge facing the incumbents and the opportunity that the startups have got.
Yeah, absolutely. So our firm, Ribbit Capital, focuses on investing entirely in the financial services space, trying to find entrepreneurs who are looking to disrupt all of you in the audience. Some of them work with you, but a lot of them these days are trying to go and build direct relationships with the consumers using exactly the types of channels that Derek's talking about, especially the mobile channel. And I think it's an enormous mistake to view the financial services industry as insulated from the type of disruption and innovation that we've seen in the internet and media and other spaces over the last 20 years. And some of that is the customer is used to a new type of technology, and especially when we talk about customers who come from Generation Y or below. And they're not worried about what happened to their bank's capital balance in 2008. They're not worried about anti-money laundering. They're worried about, why can I make a Skype call from here to Nairobi for free, but it still takes me 10% and 10 days to send 100 quid to that. So the customer is starting to look for services where they can get them, and there's an opportunity for entrepreneurs, and the literally thousands of entrepreneurs who we see every year now who have sort of Target painted on the back of banks. They see an opportunity to come in post-2008 at a time when banks' brands are tarnished, when they're slowed down by regulatory and compliance hurdles, when they're not able to innovate as quickly in some of the ways that Derek's talking about around the customer experience. These entrepreneurs are seeing all that, and they're saying there's an opportunity now to go and build a relationship with not thousands, but millions of customers in a very short period of time. And from our perspective as investors, we're looking at those entrepreneurs, and we think they have the ability to build the sort of next generation of brands, the next Barclays or Capital Ones or Charles Schwab's or who it might be.
I can virtually guarantee you that probably 50, if not more, % of the people sitting in this audience right now are going, are thinking yada, yada, yada. He's saying this is going to transform my business, but actually this is all about a trusted relationship. It's about the solidity of my brand. It's about the fact that when people hand over their money, they want to hand their money to someone who looked after their parents' money.
Let me respond first, and then maybe you guys can rebut. I'll give you an example. I'm here in part working with one of our companies, Coinbase, that I work closely as an advisor with. This is a company that was started 2 years ago that's in the digital currency space. They're the leading Bitcoin company in the world. A little less than a year ago, they had 10,000 customers. Today, they have 1.3 million customers. Those are customers who have turned over literally hundreds of millions of dollars of payment volume per month and are trusting those funds to Coinbase, a brand that they've gotten to know over the internet and by word of mouth. So the customer today learns to trust brands that they interact with on the web and on mobile, and and have the right kind of experience with, and where they can go and read on the internet that this is a trustworthy company that's responsible in terms of holding my funds. I think it's a mistake to assume that because an institution's been around for hundreds of years, it'll necessarily be as successful as it is today in 10 years.
Before I bring in the other guys on this, I'm just going to, the old saying about, sort of internet dating, no one knows whether you're good looking on the internet, is, surely that's true in your business. People went to Mt. Gox, which, as we remember, this was an institution that was set up to kind of, handle trading cards, if, unless I'm mistaken, gave it real money, real value, and that value and money is gone. What's happened to the sorts of business, to Coinbase and other kind of internet-only institutions what are customers doing in those relationships when they see that another supposedly trusted brand has disappeared overnight?
They're continuing to trust. They're asking the hard question, but I think Mt. Gox is an example. When you have an early nascent technology, there are lots of people who are hobbyists and come to be involved in that technology, but aren't serious about compliance, about regulation, about securing that trust and building that brand. I think it would be a major mistake to look at Mt. Gox and equate that to the types of entrepreneurs who are innovating in the Bitcoin space and other parts of the financial services world. The Coinbase team, for example, is a team with a very seasoned chief compliance officer and compliance team, a very seasoned security and fraud analytics team. They're quite serious, and in the wake of Mt. Gox, the answer is Coinbase got many more customers who started to say, you know what, we made the wrong bet on this other company. Now we're going to go to the trusted brand that has a history of operating very successfully in the space.
Simon, yeah, please.
I mean, my comment was about trusted advisor and where we play a role with our clients. We're talking here about peer-to-peer transactions. I'm not sure that necessarily matches with what I was talking about, because that is quite a commoditized service, and I appreciate the benefits. If you look at the ability of technology to actually help entrench the traditional industry's role as an advisor, I think there are a range of areas that can work. You look at the rise of the internet, so we're talking about all of these industries like the music industry and the book industry. Initially, you had incredible disaggregation. You had an increasing amount of choice. You had the long tail of the internet. Every time something could be provided via an online service, no longer had storage costs, you suddenly had demand, small amount of demand as the tail went out and out and out. This is all well and good, and it showed the incredible choice that consumers want. However, at some point, the universe becomes so large that you actually need re-intermediation. You need someone to help you navigate this choice. And I think there are parallels to our industry. So you look at the music industry, to Spotify and iTunes, where there's a community which helps navigate this incredible universe of potential choice. You look to our industry, there is increasing appetite for more and more different types of investments. Having a trusted advisor who can help navigate and link this world of investments, which people are increasingly becoming aware of, to what actually makes sense for them, potentially plays a role. You look at the ability for us to entrench our existing client relationships as a trusted advisor. Technology is an incredible benefit. Derek mentioned mobile applications, iPad applications, video streaming, emails, phone conversations, actually creating an ecosystem around our clients, embracing the digital change, and again, locking in this role as a trusted advisor. I see potentially significant advantages. I don't think it necessarily just has to be a threat, if you will.
I think that's absolutely right, and I would say it's true of Bitcoin. It's also true of a number of other spaces, but it really requires a kind of thought and organizational structure that I think is very different than what you would typically see at large institutions, whether they're banks or in other spaces. So I'll give you an anecdote. I was talking to a very successful payments entrepreneur, under 30 years old in Silicon Valley, but has over 1 million customers, merchants that they're serving. And I asked him, who do you think your customer is? And he said, they're not born yet. This is his way of thinking, is about what's the next generation of customers really want, and what do they expect, to Derek's point. They expect to be on their mobile phone and be able to fill out a loan application. In fact, press a button, have you find all the information about them, underwrite that loan, and then let them know whether they're going to get that loan instantly. We've seen some of that innovation here in the UK with Wonga, I know, a very controversial company, but a very successful company around innovating on user experience. We see it here in the UK also with a company we're invested in, Funding Circle, in the small business space. And I think that is going to happen more and more across the financial services world. I can share some more examples, but I'll hold off for now.
Can I chime in, just try and connect a couple of thoughts and threads here? I'm going to go back to a couple of points. But one is, it was cited yesterday, the statistic that 40% of millennials now would prefer to bank or have more trust banking with a technology company than a bank. You contrast that with the population of in the high street banks, where one of the most powerful insights in retail banking is recognition that customers may not necessarily love their bank, but they love their branch. And there's a big part of the population that still craves and needs that human element, that human interaction. But we've got those two parts of the population and the blends in between. So how do you design your future business that delivers both? And the marriage of technology and the creation and the design of the technology is what enables amazing experiences. Because on our mobile banking applications, we have multiple customers in their 90s, and our oldest customer is 103. And these are customers that go to their coffee shop, and when they're sitting there having a coffee, they still may go to the branch, but they're learning. They're learning, and we've hired what we call digital eagles that we've placed in branches to help break down that barrier. And the synergistic effect is that you're educating colleagues on what technology is. We're educating them on how we built it, but then they are educating their customers and clients. And there's a beautiful marriage that happens when that education comes together. There's a bond that is created that deepens that relationship pretty deeply. The second thing, just tying on another point, is we're moving from a closed system to open systems. And I think every financial institution now has to decide how prepared they are to play in the evolution of digital from closed to open systems. Here in the United Kingdom, the government has opened data and created open APIs for any financial institution, any business to plug into their APIs, allowing businesses to be created off of essentially government data. That's a rich goldmine for the creation of businesses. Now, banks then have to decide how open we are in that evolution, because traditionally we have had a view on innovation, and we view that there's kind of three ways of doing innovation. The first, there's the three types that Clayton Christensen talks about, but there's three ways of doing innovation. One is you can buy it in, like I was bought into Barclays in the creation of an internet bank. Like Bank Simple was bought into BBVA. The second is to organically do it. And that's really hard. You've got to have the right people that are creators, that know how to create and do that at pace. And then the third way is to partner in the ecosystem. And that's where we've created an accelerator and escalator to bring partners in the ecosystem, to not sponsor it, but to be actually in the ecosystem working with startups where these emerging technologies are happening. And how do you partner with them, not to just watch and observe, but to be part of that fabric that helps create and partner in the creation of future technologies? And the last point I'll make is that the artificial barriers between businesses, institutional and consumer, have melted. And the recognition, if we as financial institutions don't want to be the Sony sitting by and having all of the assets internally and watch the equivalent of iTunes created in our backyard, we have to find ways to take institutional capabilities, put them the right capabilities, don't get me wrong on this, the right capabilities into the hands of a consumer in the right way. Because there's incredible depth that sits in the institutional capabilities that can be leveraged, and vice versa across the businesses.
Yeah. I'm going to put a challenge to you guys, and the reason that I put this challenge is partly because it's a question that I don't yet have a clear answer to, and it's admittedly a relatively narrow question, which is just kind of, what is the future of the branch in banking? But this is still kind of core to the way most customers currently interact with their banks. And the challenge comes from John Stump of Wells Fargo, which I'm sure many of you will know is the one of the most respected institutions in terms of cross-sell and customer engagement. And when I spoke to him, admittedly 2 years ago now, about the future of the branch, I said to him, what happens to the branch? And he said, well, Wells Fargo's got a great internet banking platform, a great mobile banking platform, and I have no reason to doubt that. And along the coasts where they are active, they get a lot of new customers coming in to branches and using their internet banking. But in places where they don't have a physical presence, and he cited Chicago at the time, they don't really have any branches. The number of new customers that they're onboarding was about 250 a year. And I find that an amazing challenge, because it does say, if one of the top brands in banking in the US with this amazing platform is unable to onboard customers in places where it doesn't have physical branches, what does that tell us about the kind of great digital transformation? I mean, maybe I'll put it to you first.
I'd say that line of thinking is at risk of being highly misguided, because you're looking at an organization that has traditionally been in the business of marketing to customers through branches. There are many examples of internet-first companies to get back to this question of how would we build this, how would we market this if we were to start it today? Often the answer is very different. So Credit Karma is an example of a company in the US, a financial services business that's fundamentally a mobile business, and in less than 5 years has amassed over 25 million customers who get their credit and personal financial advice through this application, a lot of them on their smartphone. And it is more likely to me that Credit Karma will be providing banking services to consumers in the future than it is that banks that are still focused on branches. So I guess succinctly, my view is that in the future, branches are irrelevant. They're relevant now for some period of time in transition, but we have to, the industry has to be where the customer is, and the customer today is increasingly on mobile. And again, this is the young customer who is looking for, it's not just the young customer, but predominantly young customer, who is looking for the kind of convenience that they experience in other parts of their lives. So
I think an interesting, I don't think branches will go away. There's such a human element to financial services. There will always be an element to human financial services where we seek conversations with somebody about our own personal financial lives at a consumer level. The institutional and wealth side, increasingly so. So the challenge is, how do we design our future businesses to take into that human element while leveraging the technology? Because there's all kinds of great stories. While there are great stories like Credit Karma where they have married technology with the experience and gotten the adoption, there are also, especially within traditional banks, brilliant yet horrible examples of billions of pounds spent on technology that has not been adopted by consumers. And that is simply by investing billions of pounds a year in systems and technology that isn't designed around where the end user is. And I think that's something that must be addressed. And that our future is truly centered around the end user and looking to that end user.
Can I pick up on the personal point? We spend a lot of time talking about retail banking, branches, peer-to-peer. And to Derek's point, if you've got higher touch operations, investment banking, to a lesser extent asset management, wealth management, is it more about evolution rather than revolution? By which I mean Kickstarter, incredibly successful crowdfunding. It's raised over $1 billion, but you compare that to the size of the institutional investment banking market, it's still incredibly small. It's not to say that's a trend that won't necessarily continue, but it's been a lot less all-conquering, if you will, than some of the other companies we've talked about. Asset management, there clearly does seem to be a very strong drive towards more passive rather than active management. Perhaps you could argue that's about technology, greater preponderance of information, a perception, if not a reality, that financial markets may indeed be more efficient, and hence 80% of flows going to passive funds now. In wealth management, we are trying to engage the clients in different ways. We're trying to also highly customize in a cost-effective way the products we're delivering. We can now go through every client's portfolios on a daily basis and work out discrepancies from every recommendation we have across our organization. Technology allows that, but we deliver that to clients to try and entrench this client experience. So I guess the question, if I could go back, looking at these disruptive technologies, is it a lot more about the retail where potentially there's a destructive creation, and in the investment banking, wealth management, asset management, it's more about, again, this evolution rather than revolution?
And at least on the point that you talked to now about the evolutionary change, I mean, if we sort of divide that down the middle into the kind of, I suppose, kind of retail client-facing bit, the sort of wealth management or asset management side of things versus the capital markets, which of those do you look at and say are likely to be most impacted by technology in the coming years, and perhaps in a revolutionary rather than evolutionary way?
I was trying to flip that question around, but as it were, I think in wealth management where I work, it feels a lot more evolutionary. We have to keep up with these technological advancements, but with the depth of relationship with the client base, if we do change the user experience and make it more mobile, make it more adaptable, make it more relevant for the next generation of our clients, I struggle to see why we necessarily have to completely lose them. If we don't go along with this and we don't adapt the way we provide the solutions, the risk is clearly there. On the asset management side, again, it's about delivering value, it's about delivering service. I struggle a little bit to see that technology and these new disruptive technologies completely destroy the asset management industry. Personally, I see them greater risk as we've been discussing in retail.
I don't think that I don't think that the technologies necessarily destroy anything. One thing that's certain is that the importance of brand, the importance of understanding and underwriting risks, what banks have traditionally been set up to do, that will be just as important in 10 years. The question is, will banks and other existing financial institutions do a good job of understanding what the customer wants and building customer experiences that they care about? I think the risk of looking at something as evolutionary in technology, in technological change, or in how industries shift, it always feels evolutionary while it's happening. It felt evolutionary probably if you look at the internet, if you were the FT or the New York Times, it felt evolutionary from 1993 to 1999 while this was slowly happening. Some customers, early adopters, were starting to read the news on the internet. It only feels revolutionary when you look back at it 10 or 15 years later. And I think that's what we see as happening in the financial services world, is that the banking industry or banks will wake up in 5 to 10 years and they'll have felt like they were doing things, they'll have felt like they were investing in technology, but suddenly they'll wake up and say, where is my customer? And that customer will be served by an entrepreneur who went out and built a service, often using the banking infrastructure, but that service captured some need that consumer had more effectively than their traditional banking partners. I think that's why it is important to look for innovation, not just within the bank, but outside of the bank. And one reason why I would highlight why Bitcoin is an interesting thing to think about is because a lot of entrepreneurs are frustrated by the closed system that they see in the banking world. The history of financial services entrepreneurship is littered with entrepreneurs who have failed because they spent the first year and a half or 2 years of 3 years of their company's life sitting in bank lobbies trying to get approval to do something. And that's why when tens of thousands of engineers in Silicon Valley or all around the world really are excited about Bitcoin today, part of what they're excited about is that it's this open platform that they can access immediately and start to build things that solve their problems or their friends' problems right away.
I'm going to come back to Bitcoin in a minute. I just want to carry down this path of the innovator's dilemma just for another minute. But before we even do that, I'm going to ask the audience to start kind of preparing your thoughts, comments, agreements, disagreements, questions, because I'm going to come to you in a minute as well. And in particular, I noticed that 1/5 of you think the technology will only transform your business by a little bit. I forget the exact term in that. It was a lot, nothing, and a little, and 20% of you said a little. I'd love to hear from the 20% of you who think that this is all just guff. But before we do that, innovator's dilemma. I mean, both of you have spoken about the fact that there is a considerable portion of your customers who like the branch, who branches aren't going to go away because people still want to come in. They're high touch. You've spoken about in asset management, wealth management, people still need that trusted advisor. The question is, in continuing to provide that, are you locking yourself into a cost base that is ultimately serving a diminishing proportion of your customers, either kind of high net worth, ultra net worth? That's great. They're always going to want the great advice. And in the branch, it's going to be sort of people over, I don't know what, pick an age, 50 or 60, who still like to come in and have a cup of tea with their branch manager. But in 10 years' time, those people are going to be gone, or in asset management and wealth management, the market will have moved on, and you've missed out on massive growth. And I just wonder how you deal with maintaining the cost base of this high-touch, wonderful experience while still trying to move down. Derek?
I can describe the way we view it, and it's fundamentally looking at your cost base as having two primary components to it. One is the run the engine component to ensure that you have the safe, secure, trusted environment for your customers and clients. But then also, how do you reposition your cost base for investment into the creation of your future enterprise? And the shifting of that from run into creation is what will determine your ability to survive in the future. And if you look at the percentage of what is invested into truly transformational creation, which is, again, if you look at this, the disruption's going to come from startups that have a clean slate. When we started an internet bank in 2000, we started from scratch, had no legacy, had no systems, and we could start from scratch. We didn't have the benefit of the deep historical relationships that we had embedded in our brand and history that Barclays has today. So how do you marry those two together, and how do you start to shift from your run base into your creation base, as we refer to it, while keeping that mindset of creation as a startup would?
But can I ask you to pause? Just, in the US, branch transactions, or in-branch transactions, are probably falling at an annual rate of about 10% a year now. And admittedly, a lot of that is checks going out of the system, which weren't quite in the system in the same way here. What's happening in the UK, and how do you manage a branch network? Politically, you can't close the 50% of branches that you probably would like to or need to close over the next 10 years. So how do you manage that massive cost structure while still providing the mobile, the internet, the everything else, the telephone that you've invested in for the last 20 years that are just letting your customers talk to you more often?
So I'd prefer to put a spin on it that massive cost structure is creating enormous value for us as an organization on a branch-by-branch basis by the deep relationships that we have with the customers. And so we have to look at how do we add value to our customers in a way that historically, when the branch was the center of the local communities, and that branch manager created an environment that was truly trusted. How do we get to that with the customer? How do we get to the point where it's not transactional? How do you create an experience and leverage that physical presence in a way that extends beyond just the traditional transactional environment that we operate in? And there's some very exciting things that we're doing to ensure that we do that and leverage that as a valuable asset, not look at it just as a anchor of cost for us.
I mean, we've come down to retail banking again, but many people in the room, there's a whole range of different financial services, and most people's companies don't even have a preponderance in retail. And I'm not sure that if one goes down the mass-tailored route, you necessarily have to have an inconsistency between wanting to reduce costs and also providing a better client experience. Technology allows us potentially to do both. So not only hit people in different ways or connect with clients in different ways, but deliver increasingly tailored advice on the wealth management side, on the asset management side in particular, but I guess also on the retail side. You go back way ago, the T-model Ford, you could have any color you wanted as long as you chose black. Clients, though, want choice. They want to be able to customize. The problem is, traditionally, it's involved a lot more cost to deliver that customized service. Technology, again, provides the opportunity to do both. So we talked yesterday, Anthony talked about a highly tailored institutional research service. There's investment into that platform, but then the client experience dramatically improves, and compared with the additional time that each of the very expensive research salespeople used to have to spend talking to their institutional clients, you cut down and you potentially creating efficiencies on an operating basis going forward. Yeah. I mentioned earlier this idea of being able to go through every one of our private clients' portfolios, work out deviations from all of the investment recommendations making across thousands of stocks, bonds, etc., and then have that delivered to the client on a daily basis. Well, there's not only a better client experience, there's also offsetting cost implications. The client advisor isn't having to do all of that work themselves, having to call the client, etc. So you get this right, you can win on the cost side and potentially on the revenue side and the client experience side.
Yeah, just to piggyback off of that, the one thing that we've seen out of that specific example on the institutional side of converting research reports that were flat yet digital into a dynamic consumable media and data platform is that it's in changing the entire engagement model to much more of a shared glass experience now between our customers and our colleagues. And that not only that, it's taking what was historically locked within the confines of the computers that we had in our offices. That now is also being taken home, and we see our clients using this, consuming that research at home and on weekends and in moments of convenience in a way that's deepening that relationship beyond what we'd expected.
Just to push back, although it's not to disagree specifically with what you're saying, but just I think there is a temptation within existing organizations to look for sustaining innovations, the term I'm borrowing from Clay Christensen, who you mentioned before, which is to say our existing customer base wants more customization, they want more technology, so let's give it to them. And I think that's very important, and it can help you reduce costs, and it can help you increase efficiencies and serve your existing customers better. In the longer term, there is a danger in that, in missing out on the entirely new opportunity, the completely different way of thinking, which often starts with what seems like a fringe or an edge use case, a small set of customers who you might say, those aren't my customers, but actually in 10 years, in 20 years, those are your customers. So to put this in a stark way, there might be, you know, by most estimates, we have around 1.5 billion bank accounts in the world, maybe 2 billion at most. If you look at fixed landlines, if you think about the telecom world, fixed landlines never got much over 1 billion fixed landlines, and that took almost a little more than 100 years. In the last 20 years, we've now gotten to 6 billion mobile phones. In a few years, that'll be 6 billion internet-connected smartphones around the world. Is it more likely that the existing banking infrastructure and existing way of banking customers is how you reach that next 4 or 4.5 billion customers, or is it going to require an entirely new and different approach that doesn't come from saying, hey, how do we make our existing product set a little more customized or a little more technology-led? I think that's where I would certainly encourage the approach that says, how do we have a part of our organization that's completely separate from what we do today, and then also support entrepreneurs outside of our organization to go and build entirely new and disruptive approaches, both to how we acquire customers and how we serve them.
I wholeheartedly agree with that, and that's the only way we were able to create Ping It, our product today, and recognizing the revenue lines that we have from traditional payment methods, yet creating a platform that is instant, that is free, and 100% safe and secure. I agree with the approach that there should be an element that is carved off, given right to operate in a unique way to test the boundaries. But then you get to the conundrum of, do you bring it in-house? Do you spin it off? And that's a great challenge to have to address in the maturity of innovation in any organization.
Derek, just for the people in this audience who are not necessarily familiar with the UK banking market, can you just give us a quick 2-minute, what is Ping It, and why is it more than just PayPal? Or?
Yeah, sure. So if you're from the United States, there's a program, a model, Venmo, but that isn't what Ping It is. So Ping It started with the concept of, if we could move money, and recognizing the wave that was coming with mobile, if we sat down and we asked ourselves, wouldn't it be cool if people could move money simply using a mobile phone number? So step out of this. You don't have to know bank account information, but all you need to know is someone's mobile phone number. And with that as our starting point, how do you then create a business that you can build off of simply moving money? So I described the process we went through. When we launched, we had a grand vision for what this could become, essentially the iTunes equivalent of what payments in the payment space. But we chose to launch with it to only be able to do 4 things. And the only 4 things that it did at launch, and I can tell you our CEO, Anthony Jenkins, will tell you that we got every penny of investment that we invested into Ping It on day 1 from simply the PR that we got from this. And that was, it only did 4 things, but it was the simplicity of the model that made it such a success. And that is the ability to register for a mobile money service on a mobile device. And the security nut that needed to be cracked in order to be able to do that was significant. The second thing was to be able to see your money, to be able to send your money, and to be able to receive money. That was the simplicity of it. But we didn't stop there. That was release number 1. Release number 2 came 4 weeks later, and we've had 20 releases and over 100,000 feedback and design guidance from our colleague or our customers as they give us direction as to what they want to see this platform evolve into. What we didn't realize that started as a person-to-person payment service was that our corporate business, again, breaking through those barriers that need to melt with those organizational barriers that need to melt, we didn't recognize that 20% of our future corporate customers would come to the bank solely because we had Ping It. And why do they come? Because we've been able to take flat print media. So if you take a magazine article or you're standing at the bus stop sign, and we're able to convert that from flat print media that simply creates awareness of product, we do a real-time inventory check. So you're standing at the bus stop sign, you're sitting here reading a magazine. We simply, our corporate client simply inserts a QR code onto that or some kind of technology code onto that we can simply snap the equivalent of a picture into the application itself, ping it. We do a real-time inventory check with our merchant or corporate partner, verify that they have that merchandise available, and we ship that James Bond movie immediately, if they want the physical one, or the sweater or whatever it is, immediately to their home because we have their address, we're trusted, it's a payment platform, it's a benefit to the merchant, it's a benefit to the customer, and it creates an entirely new mobile commerce platform for us that started with simply an evolution of a person-to-person payment service. And it's evolved into an international remittance platform now, where you can send money to countries in Africa at a fraction of the cost that was referenced earlier. And we're just getting, we've had 20 releases, but we feel like we're really just getting started on this platform. And it's changing the way our customers interact with us, where Friday night is Ping It night. And if you go out to dinner with friends or you go out to have drinks, the question is no longer, do you have cash or do you have a card? The question is, do you have coverage? Because all you need is someone's mobile phone number to ping them money, and that's our #1 use case today, but it's evolving rapidly, and we're incredibly excited about where it's headed.
I'm going to go to the audience here, so can I, and please wave, I'm staring into the light here, so if there are any questions, comments, agreements, disagreements, please, there we go. In the corner over here, please.
Thanks very much. Peter Deans, Bank of Queensland from Australia. I've actually got 2 questions. To Derek on his 40 startups, which I think was a great story to hear. How has Barclays reconciled what must be obvious tension within the organisation to keep the people in the lobby for 12 months, given rigour around projects, compliance, the natural desire of large institutions to want to control? And then the second one, a more general question. From a risk, security, reputation perspective, what does the panel think about how far cloud applications and technologies can go within banks in the future?
I'm going to take a few questions if there are any others, and then we can come back to answer. So, okay, another one over here, and any other hands? Okay, so one here, then one here, and one over there. Was there one here? Yeah.
Monish from IFC. It was interesting to hear that the real challenge is how do you get to the next 4 billion customers, right? Not to transform experience of merely the existing ones. So question to the panel is, chances are that the next 4 billion customers, if one were to go by the experience of the telecom mobile revolution that was referred to, are somewhere in many of the developing markets around the world, Africa, South Asia, etc. Question is, how do banks, if they are the right channel, or some of the more startup technologies and ventures, reach out to those markets? Where is the capital going to come from? Who are the entrepreneurs? Are they sitting in those markets or are they here? But that to me is the big story of the next 10, 15 years. So look forward to your comments on that.
Great. Somewhere in the middle. There we go. Thank you.
The presumption of the discussion so far has been that all innovations in finance are coming from Silicon Valley or the UK. And I want to challenge that a bit. I mean, the mobile telephony example, M-Pesa in Kenya was started 2007. Yeah. So clearly, Africa is a trendsetter. And if you look at where the favorable demographics are, they're in Africa, they're in South Asia. That's where adaptability of technology is going to become much easier for these young people. So just wanted the panel to focus a little bit more on other parts of the world where innovation is happening. And related to this is the issue of financial regulation. Now, however disruptive Silicon Valley is going to be, I think they'll have to reckon with the likes of the Department of Justice and the Federal Reserve, who will impose the same level of standards on anti-money laundering and sanctions compliance. So just wanted a little bit of reality check from the panel on this front. Thank you.
Great. There was another one on the far side.
I'm over here. I'm in the corner.
Okay, thank you.
Hi, I'm from the Asian Development Bank, and I'm very interested in this because we actually work with a lot of countries, and I'd have to agree with my colleague who said previously the M-Pesa system, they've been doing it for a while. The Philippines have been doing it for a while. They can transfer money from fast food restaurants and things like that. I mean, we've been doing it. But one of the things that I'm very concerned with as a consumer, but also more systemically, I love the ease of doing this, but I'm also afraid of the vulnerability of having this information out there, the security information. And that scorpion sting is quite a big one. I mean, when I've had people who have spent 2 years trying to sort out their finances after their information has been taken. So the more we give you this information and make our lives easy, really, where are we on the other side of this also? How do we balance this, especially in emerging markets? Thank you.
Great, thanks. In the middle, and then, so two in the middle, please, the back.
Yeah, thank you. Matthias Wittenberg, HSH, Nordbank in Germany. I've got a question for Derek here. I see on your CV, which is part of the wonderful app for this venue, that you've been to Africa quite a while, and therefore I'm not surprised that you invented Ping, because as you know, what Ping is doing and the innovation you just described to us is absolutely bread and butter in Africa throughout. Every reader of the Financial Times this morning knows that 30% of Kenya's GDP is transferred this way. So I'm not blaming you or any of us for being that late, but the question really is why apparently it took it that long to establish systems like this into Europe, and do you think that Ping or equivalent systems will get anywhere near to the relevance they play in other markets? Thank you.
Good question.
Good morning. My name is Piotr Smarlicki, and I come from Polish Financial Supervisory Authority. And I'd like to ask the question about the risks which are coming from the using of new technologies, how to prevent them, how to mitigate them, and what are the panel's views on the cooperation between regulators and financial institutions in this area. Thank you.
Great, thank you. I'm going to turn it back to the panel and give you each a chance to perhaps we can just try and sort of chunk these and address them. But clearly, you know, the next 4 billion emerging markets, Africa, Asia, you know, where is the innovation going to come from, and how do we reach those people? Regulatory backlash as well as regulators' concerns about security, impact of the cloud. And I'm sure I've missed out one or two, so those of you who have been taking better notes, fire away. Do you want to?
I'll start by saying I agree 100% that this is not innovation that's limited to Silicon Valley or to London. I think this is innovation that is already happening in many parts of the world where the consumers, where there isn't as much of the same existing financial services infrastructure. So our fund Ribbit actually invests all over the world, and it's precisely for this reason that we think the real opportunity, whether it's for startups or banks or other financial institutions over the next 10 years, is in the internationalization or the globalization of financial markets, combined with the existence of new channels for reaching customers. So whether the entrepreneur is in Palo Alto or Mumbai or Nairobi or Singapore, that entrepreneur has access to global markets. And that's the opportunity. The chief challenge is to do this within the existing financial framework. And we only invest in companies who are very serious about anti-money laundering, compliance, about the reality of the world that we live in today and the very real and existing concerns of regulators in the existing financial infrastructure. But just because there's a need for compliance doesn't mean that the way that you meet that need can't be rethought. And what we see great entrepreneurs doing is starting from scratch and saying, okay, we need to assess this risk. We need to make sure we know our customers. How do we do that entirely online? How do we do that entirely on mobile? How do we work with regulators and with our forward-thinking bank partners to be as effective as possible at delivering the customer the experience they want, which is seamless, but also satisfying the requirements, the very real requirements of regulators. So I do think the next great financial services company, or the incumbent who makes a jump and grows 10x from where they are today, they're as likely to be in Palo Alto as they are in Mumbai, but they will serve customers all over the world.
I agree with that. One of the statistics I look at, if we look at where the next $4 billion is coming from, comes down to toothbrushes. And that there are now more mobile phones in the world than there are toothbrushes. And if you look at the impact that that's having on our individual daily lives, that's pretty significant on a global scale. The second point is, I wholeheartedly agree there's probably been too much discussion around the US, the UK, and the mature economies, but fully recognize the markets around the world where there are great innovation and innovation ecosystems happening. We have embraced that within Barclays through a fintech accelerator that we've set up with Techstars here in London. And just to give you a sense of where that innovation is coming from, we had 350 applicants for this fintech accelerator from 48 countries. And out of the 11 finalists that we have selected that will be announced next week, I think there are 6 different countries represented where we are bringing entrepreneurs from around the globe to work on the future of fintech with us here in London. So fully recognize that, and recognize that that there are these emerging technologies around the world that if we can simply grab those technologies and leverage those into our businesses, that's where the future sits.
There was also 1 or 2 questions. I know you covered some of this earlier in your discussion, but sort of a pointed question to you: How do you deal with keeping these kind of startups in the lobby? How do you kind of deal with the kind of cultural?
Yeah, I can only speak to the way that we've done it and the way we've been successful in doing it, and that is when you create something that that creates belief. And for us, Ping It was a significant move internally along the innovation, reawakening innovation within Barclays, and creating that belief, and then it creates pull in the organization, and the question is asked, how did you do that? And we didn't have a manual, we didn't have a process, we just did it because it needed to be done. And there's 3 core principles that I'm happy to share as to how we do it that sit at the fundamental core of how we run our hoppers. And before anybody in the organization can actually enter a hopper or a startup with Barclays, we send them through a cleansing process. They have to be cleansed of everything that says this is the way things have been done in the past. And they have to look at it from a truly startup lens and say, if we're going to create this, what does it actually mean? The 3 core principles that we base our hoppers around, our startups around, though, are design thinking, end user, human-centered design, whether it's on the institutional side or on the consumer side, it doesn't matter. It's a human that's ultimately consuming this in some way, shape, or form. The second is co-location. In Silicon Valley, again, sorry to tie back to that, but in startup land, they refer to it as 2 pizza teams. And that no successful change happens with a team that you can feed with more than 2 pizzas. It starts with 2 pizza teams. In large organizations like ours, it's very easy to have 27 people sitting around a table talking about their top priority that they've been working on for 3 months to assess the risks, to do the business case, to evaluate things. And then they sit there and say, how do we do this? Elon Musk was asked in 2013 TED what his greatest fear was. He responded by saying, can we learn as fast as the world is changing? If you're employed at Facebook, which is almost more difficult, I think, to get into Stanford than Stanford now, you have to have physically posted your first hack or prototype within 24 or 48 hours. If you use a prototype in this new technology world as a manifestation of what we refer to as a learning cycle, it is a way for people to bring minds together, not review Word documents, but see what the end user is actually going to experience. The Facebooks and technology companies of the world are getting 200 learning cycles a year if they're pumping out prototypes in 24 to 48 hours. If you take the internal meeting of 27 people, 3 months to have a meeting, and maybe 3 more months to get a prototype, they're turning 2 prototypes, 2 learning cycles, 4 learning cycles a year. So the last point then is how we do it, is agile methodology. You bring those 3 components together, and that's our way of working as to how we've been successful in creating it. And now we have a little hopper land where we have all of our startups in a common space feeding off of the energy together, where they starts with a physical table and people sitting together.
Simon?
I can't compete with Ping It Friday or cleansing, sorry.
We're out of time. This panel has been great. The conversation has been great. I have failed in one of my tasks, which I wanted to give Nick a moment to talk about Bitcoin, both as a kind of crazy gold bug kind of cryptocurrency, but also because of the technology that underlies it. We don't have time for that. I know that a lot of the people in this audience, partly because I've spoken to some of you, are quite dismissive. What I would suggest is you find Nick over coffee and get him to explain it to you, because I'm afraid I failed in my task of bringing it onto this agenda. But apart from that, I've certainly gained a great deal from this, and I'd like to ask you to join me in a hearty thanks to our panelists.
Well, that certainly was interesting. You can see from the panels at the side some of the tweets that are being tweeted using the hashtag IIF London. Please do feel free to join in the conversation on Twitter. We're seeing some really interesting remarks being made, so thank you for all of those who have engaged on social media. Our next speaker is going to give his perspectives, particularly in relation to his role as president of the Eurogroup, on the recent developments in the euro area and the challenges that have been involved in delivering sustainable economic growth. Please do welcome to the stage the Honourable Jeroen Dijsselbloem and Tim Adams, with whom he will be in conversation with.
Thank you. Please. Thank you, Mr. Minister. It's great to have you here. Do you have 2 pizza teams at the Finance Ministry?
We actually have a lot of 2 pizza teams.
All right, great.
On different issues.
I'm going to institute 2 pizza rule at my staff. Look, we don't have a lot of time. Let's kick right into the hot issues. The EU parliamentary elections, a little over a week ago, variety of different views about the meaning, the takeaway. Some see it as a benign, the new entrants will be mainstreamed away over time. The democracy at work, this is a good thing. Others say no. In fact, it'll be more gridlock out of Brussels. This is a sign that there's something unhealthy going on in the body politic across the continent. How do you read the elections?
First of all, it's very hard to draw simple conclusions from these elections. In some countries, the anti-Europe parties did very well. In my country, actually, the largest party that came out of the election was a very pro-European, explicitly pro-European party. But the trend is there are more critical parties or groups now in the EP, in the European Parliament. The only sensible conclusion to draw really is that the results from our crisis policies have not been strong enough as yet. And we're looking at a very high unemployment, so people are very disappointed about the results so far. And they have some reason for that. Of course, it varies per country, but in some countries, certainly the unemployment is unacceptably high. My main worry would be that politicians throughout Europe, from this election result, will draw the conclusion, let's do less. Let's draw back, let's take the pressure off the reform agenda, let's take more time. And I don't think we have that time. So that's my greatest concern, that instead of stepping up our pace, stepping up our ambition, and working together closer, we'll have a contrary sort of reaction. That's my greatest concern. That's wherever I speak now, I say, look, if you want to deliver more results, you'll have to pick up pace on a different number of issues throughout Europe, instead of lowering the energy.
And when you talk about the pace of reform, needed reforms, what do you put at the top of the list of reforms? What needs to be done? What's the most urgent?
Well, the most urgent one is, of course, the banks, your sector, which is taking place as we speak over the course of this year, the implementation and the start of the banking union. But then, if you look across Europe, there are a couple of issues that are valid in almost all the Eurozone countries at least. Service markets, where there's still a lot of potential in opening those up. The functioning of labor market could still be much more flexibilized in different countries. The tax wedge, the tax pressure on the labor throughout the Eurozone, I think only Ireland is an exemption there, but all the other countries have a too high, compared to OECD average, a too high tax wedge, holding back the use of labor in our economies. So there are a number of issues which are across the board important and that we could work on together. And there are issues that are very specific per country. The functioning of government, of different public services in a number of countries needs to be brought up. Business climate in some countries is still much too, low or non-inviting, if you want, for investors to come in. So there's a lot of work to be done. And I think that we should step up the pace rather than sit back.
What's next on your list on banking union, greater banking integration, and how soon will we get to full mutualization of debt and what we would think of, at least from a U.S. perspective, of a deposit insurance system that truly mutualizes the various liabilities?
I think the key point now is to go through the process of asset quality review and stress testing, make sure that's credible, that it's done thoroughly, and I'm quite optimistic when I see that the European banks are, but you know this better than I do, are going ahead of the outcome of that process, going to markets, dealing with their balance sheets, not waiting for the outcome of the ECB. And that will be very helpful in getting the banks into shape and also hopefully to get the credit flowing again throughout Europe. There's a number of issues still to work on. A deposit guarantee system is one, but the relative importance of it has become less, I think, because of the approach that we've taken in the banking union, in which we make sure that the risks coming from the banking sector, the risks of going into another banking crisis, are strongly pushed back. And it has to do with capital ratios, with building up buffers in banks, but also when there are troubles, using the principle of bail-in, which I strongly believe in order to protect not only the taxpayers, but also the deposit holders in the banks. There are a number of issues still to deal with. There is still an international discussion going on about MREL buffers or GLAC. There is still a discussion to be completed on the leverage ratio, which is still moving in the US, in Europe, in the UK. So I think it would be very wise to find international common ground on those issues as well. So it's not finished, but we've done a lot of work I've been in this job for a year and a half. When I started, the first decisions on the banking union had just been taken. So in that year and a half, we have done massive work on legislation, putting all the building blocks in place. And now it's a matter of implementation, which is going to be tough, I think, but we'll have to wait and see.
You mentioned many of the reforms that many of them were launched under the G20, starting in Pittsburgh several years ago. Mark Carney, governor of the Bank of England, but also the head of the FSB, has said, along with the Australians who are chairing the G20, that we're going to wrap up most of the major work streams by the Brisbane Summit in November. Do you think that's achievable? And if it's not, what do you think's left on the table with respect to banking reform as 2014 turns into 2015?
Well, I just mentioned a couple of issues that still have to be resolved and which are key in being able to deal with banks, certainly if they are in a resolution phase. MREL, GLAC, but also, of course, the leverage ratio is still unresolved. But I think the main building blocks are there. So he's probably right. Most work has been done. There is an interesting debate still going on about shadow banking, right. Where I think there is a difference of opinion whether shadow banking in general is a good idea or not. I think it actually has a lot of interesting potential, a lot of different forms that are interesting for economy, and there are some that entail risks, and we should deal with those. So shadow banking is probably still going to be an issue in the next couple of years.
You mentioned the ECB. Obviously, the audience and everyone else is waiting for announcements later today. I was actually in London, I guess it was 2 years ago, when Mario said, I'll do whatever it takes. In fact, I was at a little coffee shop just down the street here. That had a profound impact on markets, perception and confidence. Can he pull off, I'll do whatever it takes, part 2 today? How do you see today's comments, and have we created high of expectations of what the ECB is going to yield today?
Well, if you read some of the comments in today's newspapers or the last couple of days, yes, the expectations have risen very high, and I don't think that is a healthy thing to expect so much from central bankers and to expect so much from monetary policy. My point always is that I come from a Dutch tradition in which the central bank is very independent and we comment as little as possible. But sure, some of the measures they can take will help, but let's not get the expectation up too high. And certainly, it cannot take away the responsibility that we, politicians, at national and European level have to do what we should do, deal with the right policies, deal with the reforms that are necessary. And a lot of work still has to be done. And I'm always a little nervous when politicians start looking at the central bank as too much. Thinking, well, you can solve my problem.
So you think there's too much pressure on Draghi and his colleagues to solve problems that are structural in nature?
Exactly. I think that the ECB has played an important role and will continue to do so, and Mario Draghi is doing a fantastic job. But it cannot take away the responsibility that we, politicians, ministers of finance in Europe have to get our economies back on the road. And it has to do with budgetary fiscal policy, it has to do with macroeconomic changes that are necessary, it has to do with investment policies. So let's not think that they're going to solve it for us, because right. that is not possible.
Moving back to the G20, one of the themes throughout the G20 process is more of an international, globally harmonious approach, a consistency globally. Do you worry about fragmentation with respect to regulation and the way in which various jurisdictions are approaching policy?
I think we're coming into a phase now, after the financial crisis, a lot of new regulation has been designed and put in place, understandably, and rightfully so. But we're now coming into a phase that we should maybe look back and compare ourselves in what we've done in this region to what's been done in the US, what's been done in Asia, to see whether we can now work on standardization and harmonization in the international field. I think that will be a logic step in the next phase after so much new regulation has been put in place.
Wonderful. We had Chancellor Osborne here yesterday, some discussion about the elections, the local elections recently, looking to 2015 May, the parliamentary elections here. Also, we have the Scottish elections in September. I know you don't want to opine on Scottish elections, but from the continent, how do you think about the UK's role in the EU, and how do you think about interacting with the Prime Minister, who needs to bring something back with respect to how this country interacts with the rest of Europe?
I'm a strong believer that the UK needs to stay in the European Union. That is a common interest. It certainly is an interest for the Netherlands. We've always had strong trade relationships with the UK. We've always been very much in favor of the UK's participation. That's one point. The second point is that I think that the UK should, which it was in the Tony Blair time, be also in the lead in Europe, instead of just looking at Europe as, let's make sure that they don't get in our way, which is a defensive approach. So I'd like the UK to be, once again, at the front of participation in all our meetings, in our policy making, etc. I think that will be very good and healthy. Third of all, whether the UK is going to have a referendum and what the conditions for that referendum should be in terms of treaty change, it's not up to me. It is up to British politicians to decide on that. But they have to realize that changing treaties in Brussels is not done by one country.
Right.
And it's going to be a very tough process. Very different interests will be put on the table. And I'm not sure that the outcome of that will be to the liking of the Prime Minister in England, in the UK. So it's not like I'm going to Brussels and say, okay, give me a treaty change, because otherwise I'm leaving. It doesn't work that way. Of course, the British Prime Minister knows that, so he's taking a risk. So I'd say, take a different approach. That will be my line. Stay in the EU and get in the front seat if necessary, or if you have that ambition, that will be very welcome.
Wonderful. One of the issues is governance, EU governance. And I remember I went to the farewell event for Jean-Claude Trichet, and one thing really struck me as I was sitting in the audience, the speakers were the President of the Parliament, the President of the Commission, President of the Council, President of the Eurogroup, President of the European Investment Bank, all there to celebrate the President of the ECB. Are there too many presidents in Europe, and how would you see that reform evolve, including your own role?
Right. There's a funny thing about Brussels. I've been intensively involved only for a year and a half, and so I still look at it with some bewilderment. My analysis will be, yes, it's very complex. Yes, we have a lot of institutions, which doesn't make it always easier. And yet, even to my surprise, it does work. Take the banking union. In a year and a half, we put, with 28 countries, at least a main part of the legislation is harmonization for 28 countries. The banking union, on top of that, is for 18 plus countries. And in a year and a half, we designed a banking union which was very complex. And I've actually been part of that process, and looking back at it, it has surprised me that we were able to do it. And there was a lot of skepticism in advance. You'll never get it done before the elections, and we did. So I see your point. Yes, it's very complex. How many presidents do you want? I could live with one, actually, but I don't think we'll get there very soon. And even though it's complex, we have gotten a lot of things done. Of course, the pressure was on. The crisis put the pressure and the urgency there. But I don't think we've, what's the American expression? We haven't wasted the crisis. Never waste a good crisis.
Well, bringing up the U.S., there has been an enormous focus on a transatlantic trade deal. Yep. President Obama talks frequently about it being a priority. How does the EU parliamentary elections impact the possible negotiations of that deal? And should financial services be a part of those negotiations?
On your last question, yes. On your first questions, it's hard to tell. It has to do with the point I made before. There could be two reactions to this election. Let's do less or let's do more. And my line would be let's do more. And I think one of the, we cannot be complacent with a growth percentage of 1.5% in Europe or in the Eurozone. If we want to bring down unemployment, we certainly need stronger growth. And then if you look at where are the opportunities for this growth for Europe, one of them is international trade. And I'm absolutely sure that there is growth potential if we get some of these trade agreements done. Another one is the functioning of the internal market, services, but also energy. And so there are a couple of main potential growth drivers, if you will, that we can use. But I guess it takes courageous politicians after this election to say, look, we have to move forward and not stand still.
I'll ask one more question, then we'll just open it to the audience for a couple of quick questions. One of the best-selling books in the U.S. right now is the Thomas Piketty book, Capitalism, Modern Capitalism, 21st Century. How do you think about the narrative with respect to rising inequality, and what do you think the solution is? Is it higher taxes? Is it other reforms that maybe you've talked about? But A, do you think it's a problem, and B, in your current role, what do you think the solutions are?
I'm struck by the fact that the number of people that have an explicit opinion about Piketty is probably larger than the number of readers, actual readers of the book.
Right.
And I haven't read it yet, so I have to be careful here. But I know for a fact that if you want to increase the reward on labor, which is my biggest concern in Europe, then the key issue is once again the tax wedge in Europe. If we could bring that down, partly you could do that by expenditure cuts, sure, opening up your budget. Possibly there will be enough economic growth to allow for some tax reductions, or else you will have to look at shifting the tax pressure to other areas. And then, of course, the obvious examples are always capital or the environment. So that is up to national politicians to decide. In the Netherlands, we've already done a lot in terms of green taxing. But we will, in our budget from next year already, open up fiscal space to allow for tax reduction on labor. So I think that is, even without having read Piketty's book, I would very much promote bringing down the tax wage on labor in Europe. It will bring down the cost of labor. It could strengthen the purchasing power of consumers. Right. Consumer consumption could be brought up. And it will certainly help the functioning of our labor markets throughout Europe.
I need to get you to Washington and give that same set of remarks, because I think we're moving in the opposite direction. And I agree with everything you just said. Why don't we open it up to Kyle Koch-Vaser? Let's see, do we have some microphones? Please.
Kyle Koch-Vaser, Deutsche Bank. Mr. Minister, as I was able to experience, witness myself in the past in the Eurogroup, your country, your predecessors have always been rightly particularly demanding in the way the common framework works, the Stability and Growth Pact, the discipline of joint surveillance. How satisfied are you, both as a Dutch minister but also in your capacity as chairman, with the workings of the post-crisis strengthened framework, the package and all the rest? Where do you think it works particularly well? Where do you think there's a need for further improvement, and where are some problems? And perhaps particularly in respect of two things. One, the link between, in the reviews of countries, of the fiscal and the structural reform, where improvements were tried. And secondly, frankly, in the persistent problem that some countries, and I don't want to mention some, but in France is one example actually, where you have initially, and we had this in the past, optimistic growth assumptions, ambitious fiscal targets, and invariably, in the end, slippage, and sorry, we couldn't quite make it. So there is still this tendency, and I don't want to single out any particular country, but I think it's persistent still in the system of this lack of realism. And your predecessors certainly pointed to that many times in the Eurogroup.
Thank you, Kyle.
I think the strengthened mechanisms of the Growth and Stability Pact have proven to be quite effective. Even though some people, that's more a matter of substance, don't agree with the fiscal approach.
Right.
but the mechanisms have proven to be quite effective, especially on the side of what is called the corrective arm. So if you have a larger deficit than -3, you're in the corrective arm and the pressure is put on. And that is proven to be very effective as a mechanism. The majority of countries are now below that -3. A lot of work has been done. It actually works in the Eurogroup. The pressure is on in a combination between the Eurogroup and the Commission. And we scrutinize each other's budgets and sometimes have to ask countries to do more. But the next phase is that once you're below the -3, you go to what's called the preventive arm. And then it becomes more complex, funnily enough. The first case was Austria. Austria put forward a draft budget plan, and they are way below the -3. I mean, this is one of the better performing Euro countries. And yet they, because in that arm it becomes very complex with structural deficits, and you have to reach your midterm objective. So I'm a little worried about the design of the preventive arm, and most countries are going to that arm. It would be very interesting to look at the design and to build in the importance of structural reforms. To give you an example, Italy is in that part of the pact. They are in the preventive arm. Their deficit is quite low, but they have a high debt. And the new government, the Renzi government, is saying, well, we want to do a major reform agenda, but how is that rewarded in the fiscal policy? So I think a key issue at the moment is how we can build in, reward structural reforms into the fiscal pact, especially in this preventive arm. If you're on the wrong side of the line, if you're still in the corrective arm, then you basically have to shape up. That's my opinion.
Shape up, he says. Please, right here.
My name is Stilpon Nestor. Minister, you mentioned that even to your own surprise, you found that things actually do work in Europe and decisions are being made. Still, the political context seems to suggest that people do not get the institutional complexity in Brussels, yes. And even some of the more sophisticated commentators would argue that a lot of the objectives are lost in the give and take, in the institutional bargaining process. Do you see any prospects for institutional change in Europe in the medium term? And if you do, what do you think is the most important issue to tackle in this institutional context?
I think there will, as you know, there is already quite a long debate about the economic governance on the Eurozone. So I'm sure that is over the next couple of months in the talks about the Commission and the Council and the jobs, that this will actually be part of that discussion. France, for one, has been a long-time advocate for having a permanent president on the Eurogroup. My point would always there be, you only really need a permanent president if you want to have stronger economic governance. Because otherwise, what's the guy going to do, to put it mildly? And I will be interested to talk about that, see how we can strengthen that economic governance. I've mentioned a number of issues which I think the internal market and some of the policies which are now predominantly national should be coordinated, and we could work together in getting the competitiveness of Europe at a higher level. So I think that will be the key issue, economic governance of the Eurozone. And if we have an agreement on that, how we could strengthen that, then the permanent president could be a part of that. But that will be the right order in my mind.
Perfect. Yes, way in the back.
My name is Hannah Scobie from European Economics and Financial Center. President, I would like to convey a message from a number of financial institutions in London, in the city. We advise a number of them, and the key message is that compliance has gone over the top. It's really time-consuming and very counterproductive at the moment. And what you find is that all the staff have to spend enormous amount of time on compliance issues. And it doesn't end, and this department is growing beyond belief. And the people that are employed are not familiar with the expertise of different groups. So I'd like you to take a step back from the regulations that have been put and really review it. Maybe at the time it was good to put a lot of regulations, but it is truly counterproductive, and I'd like to hear your opinion.
Right, thanks. Actually, in the Netherlands, we have exactly the same debate, and we now said that, you know, coming out of this phase in which a lot of new regulation was put in place, we should look back, as we talked about just now. One of the things that we should look back at is exactly your point, how much time-consuming red tape we've introduced, and is it all functional? Is it needed and necessary? So I would agree with that. I think that it would actually be wise to look back every now and then, certainly after you've put so much in place, to evaluate that after a couple of years and to see whether it can be done more simple and effective. My impression is, this is what I hear from bankers, but you could tell me differently, that the pressure is even more coming from the US than from European regulation. Also, if you look at the fines that the US is now putting on banks, and this is a debate which is going on as we speak, I think that would certainly create a lot of nervousness because those fines are, in my mind, over-excessive. I think they're at a much too high level. They're not helping at all. But your issue is right. I do think we should look back after a couple of years and see whether we can make it more simple.
I can believe. Let's get this one. This will be the last question.
Thank you. Thank you very much. Nicolas Duhamel from BPC Group, France, based in France. My first point, don't you think that Europe could be really threatened by over-regulation? For instance, is it useful to create a 55 billion euros of resolution fund while it's not existing in the United States, for instance? And now that we have a bail-in process at the level of 8% of the balance sheet, in which you are really you think it's really useful, and now we could have a GLAC, and I don't know exactly how it will combine with MREL. And the second point, Minister, as you had a very active role in the Cyprus crisis, what's your personal opinion on the resolution process proposed by the Commission to manage a resolution crisis from an institutional point of view?
If I understand the questions correctly, you're basically asking, do you think that the banking union has been well designed? And I would say yes. Yes, it has been well designed. When the whole process of banking unions in Europe started, when banks had to be bailed out by countries who basically couldn't bear the burden. And it actually started with a debate on direct banking recap. Now this instrument has actually been completed now and yesterday approved by the Finnish Parliament, so it looks like we can go ahead. But that was the trigger of the whole banking union discussion. And at the start, the main issue was how can we break the link between the banks and the sovereigns? And the approach was that we should take the public burden away from national countries and try to lift it to a European level. But in the process of designing the banking union, we've completely changed the way of thinking. And we've turned it around and said, if we fundamentally want to make the financial sector a healthy, economically sound sector again, then we have to make sure that risks are priced. And the best way to do that is to make sure that investors not only go away with the profits in the good times, but also carry losses in bad times. And there was a shift from the public side to the private side. So in the beginning of the process, it was about moving the burden from national public side to European public side, but at the end of the process, we've shifted the burden from national public side to private side within the banks. And part of that is not just the bail-in is key, but also having a resolution fund being built up by the sector. Some will say that the 55 or 53 billion is not enough, but it is a target level, and if money is drawn from that, it will have to be put back in by levies and ex-post levies. So yes, I do think that the fund is necessary as an extra buffer on top of all the other measures that have been taken to make sure that the bill is paid, if necessary, by the sector itself or by the investors. So that is the point of the resolution fund, to protect governments, to protect the taxpayer, and fundamentally to get sound economic principles where risks are concerned in resolution phase back into the sector. I strongly support that. I hope that in general terms answers your question. Whether I think the resolution mechanism institutionally is well designed, we the ministers had an agreement first, and it was very complex. I'll be quite open. It was complex. It wasn't credible enough in terms of, will there be a decision? Will it be well timed? Will funds be available, etc.? I did the negotiations with the European Parliament, and in those negotiations on these issues, we improved it. We set deadlines in the decision-making process. We made it decision-making procedures easier and more simple. We allowed for the resolution fund to have a credit facility so that it would also be financially credible in the building up phase. On those three issues, we improved it, and I think we should now simply start by building it up, and hopefully we won't be using it too soon. But if so, there is money there, and there is a credit facility to back it up.
Mr. Minister, you mentioned the judgments coming out of the U.S. regarding some institutions. I think you described it as maybe excessive. Are you worried that this is a phase that we're going to have to endure for some period of time? And if it does worry you, how do you and your colleagues communicate that with your counterparts in the U.S.?
I always ask my counterparts in the U.S. how long it took them to build the system of the Fed. And it took them, I think, I'm not sure, I'm not going to answer the question, but just asking the question is making a point. We are in Europe in the last period, after the war, we've built up a completely new government, in a sense, completely new institutions, and we're adding to that, and we're changing that, and we're making it stronger as we go along. Can you make a perfect design and put it in place in one when you're talking about 28 countries? No, you cannot. So this is how Europe works. Yes, it's complex. I don't think that all the complexity is a problem. To give you an example, some of what we do is done at a communitarian level, and the Commission and the Parliament is in the lead, and some of what we do is intergovernmental, between countries. The banking union is actually an interesting example there. And even that functions. Even though it's complex, it works. Am I open to simplifying things? Absolutely. And in the future, I'm sure we will. But it's quite a historic thing we're doing in Europe. I think it's sometimes you have to step back and look at it from a distance and say, wow, I don't know how these guys do it, but they get it done, So,
toughest question yet. Who do you like in the World Cup?
Who do I like in the World Cup?
Yes.
Well, the Netherlands is in the World Cup, so there you go.
Who's on record? Thank you very much, Mr. Minister. Thank you.
Thank you.
Good job.
That was certainly very enlightening. I'll remind you again to please feel free to comment on Twitter using the hashtag IIF London. Your comments are coming through thick and fast. We're really enjoying seeing them and getting your opinions of how the sessions are going. So to prepare you for the next panel, since the financial crisis, we've seen cross-border capital flows falling significantly as a percent of recipient countries' GDP. I know that capital flows was a subject that some of you really wanted us to look at. Particularly banking flow, that's declined most noticeably due to banks' efforts to deleverage. This is seeming to continue, albeit with some signs of relaxation. Portfolio flows, they've been volatile. They've raised many policy challenges for emerging market countries in particular. So this next panel discussion is going to look at what mature and emerging market countries can do to promote more stability, more stable patterns of cross-border capital flows. To chair this is Hung Trang, Managing Director of the IIF. Please welcome him to the stage. And our panelists for this session are Mr. Jaime Caruana, General Manager for the Bank for International Settlements, Mr. Larry Hathaway, Chief Economist, UBS, Mr. Gene Frieder, Global Strategist, More Capital Management, and Mr. Daniel Pinto, Chief Executive Officer, Corporate and Investment Bank, JP Morgan Chase.
Well, thank you very much for that introduction, and thank you for the panelists who agreed to join us on this session. I think from the very exciting session on technology and future of finance, we come down to earth a little bit, but I think that this topic, capital flows, is no less important. I would like just to say a few words to set the stage, and then we will ask the panelists to share their views and perspective on the different issues. We have many things to cover, and at the end, we again welcome questions, intervention from the audience. Basically, three key points. One, even though international private capital flow to emerging market countries have been quite resilient and stable in the past few years, between 1 trillion to 1.2 trillion per year. If you measure it as a percent of EM GDP, it falls significantly from a peak of 8% of GDP in 2007 to 3.6% this year, and we estimate next year. That means, in a way, international flow matters much less to EM countries. Is that a good thing? Is that a bad thing? That's something that we need to explore. Is the trend to be reversed in the future or not? Secondly, we talk about international capital flow from the mature countries to the emerging market countries. But we really have not paid sufficient attention to the fact that since the beginning of the 2000s, the flow from the emerging market countries back to the rest of the world has been much larger by the tune of $200, $300 billion a year, simply because these countries have been collectively running a current account surplus vis-a-vis the rest of the world. The trend is continuing even though the surplus is smaller, but that is something that we need to pay attention to. And the last point is that until recently, the outflow from emerging market countries have been recycled through the central banks of these countries via reserve accumulation. 2/3 of the outflow was accounted for by central banks. Now it's the opposite. 2/3 of the outflow in recent years have been done by private sector institutions in emerging market countries. And therefore, the kind of asset allocation will change, and that will have an impact on the whole pattern of flow. So with that as a background, I would like to begin first by asking Daniel Pinto, who is CEO of the Corporate and Investment Banking for JP Morgan, and who sits on our board of directors of the IIF. From your vantage point, Daniel, looking at business and orders, both from the borrowing side and the investor side, what is your view and insight about development of capital flow and demand and supply of capital in recent quarters and months, and what are the factors you think may have had some contribution to these changes?
Thank you. So when I look at emerging markets, so clearly it's been some outflows in the last year or so. We think that probably around $150 billion between fixed income and equities have left the asset class, mainly equities, around 50 or 60 in fixed income. But obviously there was some repricing, and that repricing was correctly. But when I look at from my business, or from the business point of view, what is the real long-term strategy and outcome? I see the opportunity in emerging markets being great, and a small blip when we are going through a period of normalization of interest rates pretty much everywhere in the world. after we went through a massive quantitative easing in many places, is it doesn't derail my view of the long-term trend. What I see is emerging markets are going to grow faster than the developed world. I see that financial assets in emerging markets will grow even faster. Today, they're probably 170% of the GDP. When you compare with the developed world, it's probably more than 400. So that trend will create business. And also, when I look at, I've been all my life involved in emerging markets. As you can see from my accent, I'm not English, I'm from Argentina. And the progress that this country has made is humongous in terms of fiscal policy, monetary policy, debt management, and some of them gradually they are really encouraging more and more structural changes, Mexico being at the top of the list over these days in that front. So the opportunity is there, and the liquidity of the market in order to get in and out, it may not be perfect, but it's by far better than it was a while ago. So I am quite encouraging on the opportunity to keep looking at how the progress is being made, how structural reforms are being imposed in those countries, how the internal markets, capital markets develop, and that will give more confidence from investors around the world, local investors, and companies to keep investing in those markets. So in my view, the long-term trade hasn't been derailed at all for whatever happened in the last 12 months.
Well, great. I think you touched upon several themes which I would like to come back in the second and third round of discussion. But let's me move on to Jean Frida, Senior Global Strategist for More Capital. Again, from your perspective as a buy-side institution, talking to investors, pension fund, insurance companies, do you see the same trend that Daniel referred to, long-term trend of allocation to EM assets?
I think I would say that over the last year since the taper tantrum, there's obviously been a reevaluation to a certain extent, or at least a rethinking of how much of this is a long-term structural trend as distinct from a search for yield, and to what extent the fallout from the QE policies in the developed economies has created imbalances within the emerging economies that still need to be worked out. And I think from that perspective, the last 6 months has really seen, let's say, a falling back into the search for yield, where it's very difficult. I would say that whereas the consensus theme in the market is differentiate on the basis of fundamentals, if you actually look at performance, it's really differentiated as a function of yield. And I think that's a little bit discouraging and a little bit worrying. I would also say that I do think there is a real leverage problem that's developed in a number of large emerging market economies. And in the context of a shift away from unconventional monetary policy in the US, that has to create some real concerns in terms of how investors rethink those positions. I think if anything, to Daniel's point, there are many good things that have happened in the emerging markets, and you don't want to destroy those structural benefits by a period of market illiquidity and capital outflow that creates quite a bit of collateral damage. I would just add on the positioning side, I would say that there's a real distinction right now between the hedge fund part of the world and the real money part of the world. Again, the real money part of the world of the investing community has been drawn back into emerging markets more recently, if anything, just because volatility is low and the yield is high. And the macro hedge fund community finds value or valuations to be a real issue. And I think the question that I always ask is, how can we put valuations on local currency bond markets or equity markets if we don't really know what kind of real interest rates are the normal, call it the new normal, once the Fed normalizes policy?
Well, thank you very much. Again, you also highlight several interesting themes that we will come back. But Larry Hathaway, Chief Economist of UBS, from an economist's point of view, how do you see the change and the volatility of flow in recent quarters reacting to changes in economic financial circumstances, including central bank policy making, and vice versa?
Right. Maybe I'll take the opportunity to step back for a moment and talk about the decline in the flows that has been alluded to before. Probably important just to put it in some context. The flows that preceded the financial crisis were very, very large, in part because imbalances were huge. And the whittling down of those imbalances means the cross-border flows have probably been diminished for that reason. We can obviously layer into it other changes in terms of regulatory changes. I'd probably also say it wouldn't come as a great surprise although difficult to measure, if we didn't believe that there was some degree of home country bias that has increased as a result of maybe more risk-averse sort of attitudes amongst investors that have also led to that diminution. Now, if we think about the flows themselves, it's a really important topic because, as some recent research has shown, some 60-odd% of EM crises, be they banking crises or sudden stops, currency crises, they were preceded by very large-scale capital inflows. And that's even true in about 40% of the instances of those occurrences in the developed markets. So these are really important topics. But I think another aspect of this that probably we need to consider before we just come to central banks in a moment is the composition of those flows. The riskiest bits are undoubtedly the debt ones, and what David just said is true, that there's been a lot of debt buildup in the EM complex in recent years. And around, obviously, the changed expectations of the Fed that took place last spring and summer, there was, I think, a realization that some of the valuations were stretched relative, perhaps, to the underlying both growth as well as, let's say, credit fundamentals of many parts of the EM complex, both in the external debt sense and also in the domestic debt sense. So against that sort of a backdrop, I suppose we should, in the near term, be concerned about what central banks may do, whether the Federal Reserve will follow its tapering policy with short-term interest rates because of those vulnerabilities that I still think exist in parts of the EM complex. But we should also perhaps be thinking proactively about how EM countries can make the capital flows that they probably do want to enjoy, the inflows, a more stable variety. And there I would imagine that part of the sort of prescriptive side of the analysis is focusing on the structural reforms that were mentioned about Mexico a moment ago, that everyone is hopeful to see, for example, in India, because structural reforms are more likely to galvanize foreign direct investment, which is a preferable, I think, form of a capital inflow for the long-term sustainability of the economy in question.
Yeah, thank you very much. And last but not least, Jaime Caruana, General Manager of the BAS and former Chairman of Basel Committee and Governor of Bank of Spain. So with the regulatory policymakers' perspective, how would you see the changes in capital flow in recent quarters? And again, from a macro-prudential point of view, is there anything that you would like to highlight and bring to the attention of the audience?
Thank you. It will not be regulatory, it will be more macroprudential. On this occasion, I will not talk about regulations. So I think I would like to describe some challenges and some questions of something that has been happening and that a colleague of mine, Hyun Shin, has described as the second stage of global liquidity or the newest stage of global liquidity. And I would like to describe that and what are the questions that this brings. Basically, there has been a significant differences in the flows, the patterns of flow cross-border before the crisis and after the crisis. Before the crisis, the pattern was basically having global banking at the center of the flows. The transmission of financial conditions was basically the banking capital flows, and a good part was interbank capital flows. And the global factor that could explain co-movements in financial conditions internationally was leverage of these global financial institutions. So that was the old phase. Then it came the crisis, and during a couple of years there was a very strong process of the leveraging in the banks, in advanced economies, and then it comes after 2010, the new phase of global liquidity. And the new phase of global liquidity, the dynamism of the liquidity and the transmission is not in the banking side, it's more on the capital market side. And in particularly, the debt issuance by corporates in emerging markets that has increased significantly. So the big players here are now more on the buy side, those that buy these the asset managers that are global and are buying these new securities issued by the emerging markets. And the transmission is in part through the search of yield. There are many reasons why you should buy these securities. It's good fundamentals, but there is also this clearly this search for yield in periods of low volatility and low rates, and this has been happening. And the factor in this second phase of liquidity that explains some of the co-movements is the declines on risk premia. Risk premia have been compressed significantly. Term premia has been negative. That's you pay for take term risk, and this is an important sector and an important part of the story. Of course, at this point of time, perhaps it's good to again recognize that still monetary policy at a global level, or financial policy at a global level, is that the overall liquidity continues to be very, very accommodative, and that the stocks of debt have continued to increase globally when you take into consideration private and public, and you take into consideration the G20. So from that perspective, if you, at the backdrop of still increasing levels of debt, it's good to ask what could be the risks or what could be the challenges that this new phase of liquidity is bringing. And I think this is something that is in exploratory side or research side, is not more than that, but I think it's an important element. And I think there is an intriguing question, which is we have been looking a lot on leverage as the source of risk, leverage associated with financial institutions, basically, or with corporates or with some instruments, but basically leverage from that perspective. But now we perhaps have to look at other mechanisms that would bring some of the amplification, similar amplification that brings leverage in the capital markets. So it's leverage-like movements that could occur in capital markets, but not coming from leveraged institutions, but from non-leveraged institutions, such as asset management companies, investment companies. And in that sense, we are looking into the, what could be mechanisms that could trigger this kind of leverage, or this kind of rapid movements, even non-linear movements, abrupt changes in markets. And I think we have seen, and there has been some analysis in terms, for example, of what would be the incentives of some of the asset managers coming from the fear to fall into the comparator analysis of performance of asset managers in the short run. Even if they are investing in the long run, they don't want to fall too, and they can trigger more rapid behavior. The issue of concentration of risk in some specific sector or asset classes, and this, and there are quite a lot of mechanisms. One of them would be the search for yield when, for example, the considerations in terms of what are the potential scenarios are too narrow. If you are really looking for yield and concentrating only a very narrow scenarios in terms of the outcome of distribution, potential outcomes, you will end up with pricing it very expensively, and therefore this could, any deviation could be moving capital flows. So again, this is something that we are thinking. There is anecdotal evidence that we should continue to look at that. But I think my conclusion would be that we should be thinking in the future not only the traditional leverage in financial institutions, but also this kind of leverage-like behavior in capital markets that could come from incentives in asset managers or from the way that this search for yield is happening.
Well, I think that if I can bring together several themes of the point that our panelists just raised, from the long-term sustained allocation to emerging market asset class, to the observation that maybe in recent months that there could be a little bit of froth in terms of search for yield, And Jaime's concern about potential for non-linear correction with positions in different assets, particularly EM corporate debt, which has been increasing significantly in recent quarters. On the back of this is secondary market liquidity, because good, well-functioning capital markets need liquid secondary market so that investor can trade in and out without disrupting the price environment. But research that we have done using 4 key metrics show that secondary market liquidity for EM, sovereign and corporate bonds really deteriorated noticeably in recent years in terms of the trading volume of EM securities, particularly as a percent of a very strongly growing outstanding volume of securities. The inventories that dealers, banks and market makers are carrying to facilitate market making, to the bid-ask spread, which increased 4 times, 2007, 2 basis points on average, now 8 basis points. And last but not least, anecdotal evidences from institutions like the hedge fund, saying that it is now taking longer, more difficult, and not easy to complete transaction, and the size of transaction is smaller than before. So all of that means when the correction comes, which kind of behind some of the remarks that we have heard here, if you have a less than liquid or deteriorating liquidity in the secondary market, the correction may be magnified, may be amplified, and could be something that ought to be looked at. So, Jean, from your buy-side perspective, again, do you think that is a fair description?
Yeah, I think it's a very fair description. I think, let's call it on both sides of the fence, we have concerns about these market structure issues. And the way I would describe it is there's almost a liquidity paradox, where in a world full of liquidity, you actually have these bouts of severe illiquidity. And you can see in parts of the system how these larger and larger pools of assets under management, now something like $87 trillion globally, end up getting pushed into more and more illiquid parts of the market. But these are funds, the real money funds in particular, these are funds that offer daily liquidity, no matter what the liquidity of the underlying asset in which they invest. So we actually broke down for the corporate emerging market bond index how many of the bonds actually trade, by quartiles, bonds that trade on a given number of days in the month. So 25% of the bonds only trade on 20% of the days in any given month. They don't trade very often, and that means they're reliant on algorithmic pricing, which can jump around. Basically, you have a lot of run risk effectively built into your pricing mechanisms and your liquidity mechanisms.
Daniel, from...
Clearly, if I look at the corporate space in emerging markets, I think that the total amount of issuance is around 1.3 to 1.5 trillion.
Yeah.
And the total amount that is indexed to and 100% dedicated emerging market corporate is $64 billion. So there is a huge amount that is also part of some other indexes, but it's owned by crossover and another type of investors. And it's also a fact that for unit of risk, in this as a class as in any other, the banks have to have more capital than they used to have before the crisis. But I think that we need to be careful of correlating the holdings of banks on bonds and that as a representation of liquidity, because that would, to an extent, create some of the problems in the past, because the whole world was long certain assets and the banks were as long as everyone else. And as a market maker, when you are trying to provide liquidity, the worst position that you could be is to have a lot of it. So therefore, you're fighting your positions at the time that you're trying to provide liquidity to clients. So banks are a lot more nimble today in terms of positioning. You can see that. And obviously, there is more capital needed in order to provide liquidity. But the fact that they have less risk will allow all of us to be more effective in the way that we provide liquidity to clients and when it's necessary. The other point, in terms of the size of the corporate bond market in emerging markets. So like in every asset class, I think that probably the liquidity is marginally better than if you compare with US high grade or something like that. So therefore, when you go into those markets, you need to really be more careful than in any other that you're buying the positions because of the right fundamentals and the right credit, and you're getting the right spread for the marginal liquidity that you're taking. If I look at out of the SEMBI index, the 80% is high grade and 20% is high yield, and high grade and high yield offer a bit over 100 basis points spread over the equivalent risk in the developed world. So, and I think that with time, the liquidity of that market today is probably better than it was, and as soon as the asset class grows, you will have more and more liquidity coming.
Larry?
Yeah, might take a slightly more cautious tone here on some of this market-making liquidity. Liquidity that we certainly observe now when there has been a thirst for yield, when the appetite has been there, the demand has been there, is surely going to be a different type of liquidity than in those episodes when there are more sellers than buyers, as it were. If we take a look at, say, corporate credit also in a different sense in the U.S., the corporate credit market has, roughly speaking, doubled in terms of its issuance from the crisis levels, but dealer inventories are less than 20% of what they were before. Yet perhaps the banks are going to be more nimble, perhaps they're not going to be quite as pro-cyclical, but I'm not sure that we've actually run the stress test on that one in terms of markets, and the cost of holding that inventory is pretty high. Number of institutions have essentially become more or less agency players there, taking orders and matching them rather than actually taking the risk because of the cost of that risk in its various dimensions. And so I must say, I'm not sure we know yet whether that's going to be an issue, but it certainly is one that we have thought about. We ourselves, by the way, have tried to model, let's say, portfolio construction not on the basis of standard measures of risk, i.e. volatility, but looking at returns in the context of liquidity as best we can try to approximate that. And all I can say is that from our perspective, the optimal portfolio for both the emerging market debt, but also some of the other credit types of structures that I mentioned before, looks vastly different when you incorporate some degree of potential illiquidity than it does on the basis of observed prices and observed volatility.
Thank you very much for that. Jaime, you want to add something to this?
Yes, I think, well, first, lack of liquidity, I would say, fits very well with the story that there could be significant jumps in pricing and significant jumps in term premia. But what I would be concerned really in terms of liquidity, and of course more liquidity is better, but what I would be concerned is the illusion of liquidity. The fact that you think that there is liquidity because in good times there is plenty of liquidity, and then when it is some stress, there is no liquidity. And then you find that all the liquidity that you were expecting was not there. So to the extent that people is better aware that there is less liquidity and they factor in this when they purchase these securities, I think that would be part of the solution to some extent. Right. And not to trust all the liquidity that exists when times are really good.
Right. So just to follow this train of thoughts, the key here is to preventive medicine to make sure that the disorderly correction may be keep under control and so on, so that we don't need to fight really is liquidity illusion or not. But following that train of thought, you mentioned decline in term risk premia and credit risk premia, basically the criteria that former Fed Governor Jeremy Stein highlighted in one of his speeches as a benchmark for him to follow the situation of potential risk to financial stability. And his own conclusion before he stepped down from the Fed board is that he would advocate following a less than accommodative monetary policy if those two risk metrics are abnormally low because it harbors potential risk in the future. So he is one of the few central bankers publicly say that he wants to take financial stability concerns and put it into the monetary policy making process and come out with a clear-cut conclusion. Do you agree with former Governor Stein?
Well, we have been, the BIs have been arguing for that for a long time. So we think that the financial stability is a concern that should be taken into consideration when you do monetary policy. In fact, we argue that it cannot be separated.
Any comments from any of our panelists?
Well, I mean, from my side, I would say that, various central banks, of course, are getting different mandates now to think about these issues, primarily, I suppose, here, the Bank of England. But that does make it possible for them to have a broader toolkit to perhaps both analyze but also then deal with some of these issues. In other words, if we think about, say, quantitative easing and you think about the transmission mechanism, surely one of the principal ones is actually to push people into assets that they might not otherwise own, changing, therefore, returns, but also the cost of capital considerations that might drive more activity, which is presumably the aim of the central banks as they try to lift economies away from recession towards fuller employment and price stability. But in the context of doing so, you can, of course, exacerbate underlying financial risks that might come home to roost later. It seems to me that through perhaps better supervision, better regulation, but perhaps other policy instruments, you may be able to somewhat simultaneously address those issues. Now, again, it's untested waters. Mistakes will be made. People will not perhaps correctly diagnose the issue or apply the right remedy. But if one sort of thinks, for example, about the Swiss National Bank, on the one hand, pursuing a monetary policy which has a very strong exchange rate component to it, which keeps interest rates obviously at extraordinarily low levels. On the other hand, confronted with one form of financial risk, which is a booming property market, well, they've got macroprudential tools to at least slow some of that down. So I think the broadening of the toolkit of the policymakers can allow us to think at least about ways to address this that wouldn't have been possible before the financial crisis.
Well, good. Let me look at some slightly different issues. Several of the panelists have highlighted the fact that growth in emerging markets, or at least some of them, are still stronger than in the mature economies, and some of them do have a very decent and even ambitious structural reform program in place. In other words, have you seen these kind of effort being recognized and rewarded by investors? Is there a differentiation among investors in terms of flow pricing into different emerging markets, depending on the fundamental, the policy quality, the reform effort in those countries? Any
I think that there is a lot of differentiation. You can see how countries, when they've been perceived to be addressing their reform agenda and have a solid fiscal and monetary policy, they really have sustainable inflows, not just capital, not just portfolio inflows, also foreign direct investment and inflows into the real economy. And countries that they haven't done that, they really obviously face issues with growth and really to finance the future growth. So it's very, very crucial, and that's what really is important. Like what Mexico is doing over these days is exactly the right way to go about. So they have, after many, many years of struggling with reform, they are now addressing, and probably the reform of the most important sector in their economy, the energy sector, that if they manage to land it, and it looks like the intention, the political intention is there, the amount of capital that is going to go to the country is really quite substantial, and the sustainability of that capital in the long run will be substantial. This is not people buying CETES and selling it a week after. So I think that there are the changes on the political space in India and Korea give them also the opportunity for that. So but when you look at the trends more and more, I think that these situations will happen. Even in places like Venezuela or Argentina, places like that kind of miss the train in the last 10, 12 years, at some point they're going to really looking at what it could have been, and really the next political leadership will really take the effort to put their country in a better place to take advantage of what others are taking today.
Could I just add? I agree with a lot of what Daniel said, but I would say that I see Mexico as more of an island in an ocean in terms of reforms. Hopefully, India will make a larger landmass in terms of that reform process, and signs are encouraging there. But I would say that the era of easy liquidity has made it very easy for countries not to do much in the way of reforms. And we're still seeing the impact of this global rebalancing shift on revenue bases, on policy mixes. We're seeing the impact in terms of pressure on different central banks to do things that they might not otherwise do, which I think is probably another important point to the earlier discussion on macroprudential, in thinking about the kind of pressures that maybe emerging market central banks come under, that some developed country central banks don't come under. I would add one other point, though, which I think goes back to the liquidity discussion, which is we still don't really have a well-agreed template of how to deal with a world where there are large quantities of capital flows sloshing around, almost to a point where you flip a switch on and off. And I find interesting the distinction between countries that have been less interventionist in terms of the way their markets have developed relative to those who've been more interventionist. Arguably, out of good reason, the argument has been you lean against the wind, you build reserves, you have self-insurance, you're more protected. But if you take two extreme examples, at least in terms of investor sentiment, Mexico, which everybody loves because it's reforming, and South Africa, which is not so in favor. And both of them have been hit by the shock in different ways. Their exchange rates have depreciated a lot, their bond markets have sold off. But there's been no problem of illiquidity. There's been no problem of excessive external indebtedness of the corporate sector. Somehow their willingness to allow their currencies to float and allow their bond markets to develop naturally has actually created a safety mechanism that I think is still needs to be developed much more fully in a number of other big emerging markets.
South capital flow. I said in my brief remarks that the emerging market countries as a group send out more capital flow than the capital flow coming in. And more of that flow is being recycled out by private sector entities in emerging market countries. Albeit some of them are state-owned entities, but nevertheless, they do look at it from a commercial point of view in making international investment. From your perspective, do you see any difference in the behavior, asset allocation pattern among these emerging market, private sector, institutional investors and entities compared to the mature market entities?
Well, I mean, first of all, in terms of just the flows, EM, DM, we have to remember that EM, and for that matter, DM as well, but they're quite heterogeneous, right? And the big sort of outflows from the poor, as it were, the less well-to-do, to the advanced economies were, in their day, largely concentrated in China, and to a large extent as well in the oil patch, and not so considerable elsewhere. And of course, in the last 5 years, the emergence of relatively large current account deficits in many parts of the EM complex has obviously meant that they've attracted those flows. Unfortunately, in my view, too great a reliance on debt capital flows, short-term debt flows, rather than either long-term FDI or even, to some extent, equity portfolio flows, something, by the way, we haven't really discussed here, but would have been generally negative for EM countries over the most of the last 3 to 4 years. And so from that perspective, I think you have to introduce that to be talking about those sort of, let's say, north-south types of flows. And of course, within the North, there's been a structural shift as well. The closing of the big deficits in the periphery of Europe and the continued large surplus of Germany has produced now a capital exporter in the form of Europe that wasn't there before either. Japan's external surpluses are diminished and the U.S. external deficits are somewhat smaller. So I think net, there has been a fairly interesting change there. You could argue some of it's cyclical because of depressed demand and activity in a few of the advanced economies, but there does seem to be something that's also perhaps more longer lasting in terms of that story. Then lastly, in terms of the recycling from those EM countries that still do provide net capital to the rest of the world, well, there's still a fair amount of it that's running through central banks. First quarter reserve accumulation in China was pretty robust. Sovereign wealth funds, of course, have sprung up and continue, obviously, to be a big part of, let's say, foreign investment activities. Yes, there's a bit of an opening of a capital account story. Again, you can see parts of that in China, but portfolio flows have been relatively modest. Cross-border M&A from EM into DM is also relatively small compared to the kind of DM type of M&A activity.
Right. Any other comments from? Okay, I think at this point, perhaps I would like to open up for questions, comments, intervention from you, from the audience. Any question to any of the panelists? Yeah, in the back, please.
Thank you. My name is Carlos Gustavo Cano from Banco de la República, Director of Banco de la República, which is the Central Bank of Colombia. I would like to ask Mr. Caruana, what do you think about capital controls as a macroprudential measure in emerging economies, provided the conditions that are mentioned by Jonathan Ostrich from the International Monetary Fund are fulfilled? That means GDP, a real GDP approaching potential, an adequate level of international reserves, and overvalue local currency. As you know, we applied those measures in Colombia between May 2007 and October 2008. In our view, with good results. We follow, of course, a floating rate of exchange regime, and we had a good experience in that event. As a very exceptional and transitory measure. What do you think about that, Mr. Caruana?
I think you provide the answer to your question. It has to be transitory and exceptional, and in those cases, if this is because you are doing other things and gives you the time to do the fundamental other things that needs to be done, I think then probably is necessary. What I would like is to differentiate that from macroprudential. I think this is not called macroprudential. It shouldn't be called macroprudential. This is capital controls. And again, I think the new theories that can be used from time to time, but I think you put it very well. It worked because it was temporary, but because it was exceptional. And this may work. But I think that the important thing is that behind these capital controls, there should be something else that should be done, that at the end, you don't need the capital controls. If you think that the capital controls are going to solve the problem, probably you will end up, as we have learned in other countries, that the flows will change the nomination, it will enter in a different way, but you will not be able to control the whole situation. So as a temporary measure, I think there are good experiences, as yours.
Any observation from private sector?
Go ahead,
No,
please.
go.
Just to make one, I mean, when we've gone through, obviously, this enormous change in the regulatory environment post-financial crisis across a number of countries, one could say that really all we've imposed is significant costs, if you like, taxes on the role that finance plays in the system, particularly bank-centered finance. And that, of course, will, over time, mean that there's less leverage, that there's probably less movement in some sense of capital flow within an economy and maybe even between them. Yet we somehow, so far, have left the international capital flow side of it out of that equation. And if one steps back and says that essentially things, say that Hyman Minsky said, that stability creates instability, so good performance in a country like Colombia or some of the others that we've mentioned attracts destabilizing, what are ultimately destabilizing capital inflows. Perhaps some sand in those gears is also warranted. I'll throw it out there rhetorically as a question, but I think that may be just rephrasing your own question, but it seems to me we've gone to great lengths to try to make our domestic systems less vulnerable to those sorts of destabilizing patterns in finance, but we haven't really addressed the cross-border ones. And as I said at the very beginning in my observations, when you look at banking crises, sudden stops, currency crises, balance of payments crises, the preponderance of them are caused by large international capital flows. And therefore, this seems to be an area that is yet to be recognized fully, perhaps because, of course, there's no global institution that can address it.
Okay. Any other question? Yeah, in the back there.
Edgar Meister, former member of Deutsche Bundesbank. I would like to follow the advice of Jaime Caruana to look in the future concerning the capital markets. And as far as I know, it never happens in the past that one of the big worldwide central banks decided in favor of a negative interest rate. So this could happen today. Maybe it had happened, I'm not quite sure. They are 1 hour before us in Germany. And what I'm very much interested, what could be the consequences of a decision in favor of a negative interest rate for the capital markets, for the flow of capital, the negative and maybe the positive? Thank you.
It goes with the territory, if I may.
Frankly speaking, you know the tradition that just before a decision of a central bank, you should be very prudent in what you say. So I would leave this answer to the private sector, but I'm not in the central bank anymore, but I keep the good traditions.
Okay.
So perhaps we can talk afterwards, but I would not like to interfere or to say something.
We are lucky to have 3 private sector.
But the private sector can do that very well.
David. Jean?
Yeah, we've obviously spent a lot of time thinking about it. I think the psychological aspects are potentially quite powerful, but perhaps the real implications are relatively meaningless. Because I don't think we're facing a situation where they actually push Eonia into negative territory for any sustainable period of time. I mean, put it this way, the difference between minus 25 basis points and plus 25 basis points isn't that great. I don't think that there is a tipping point when you go negative that suddenly causes a destabilization in any way. I would say the broader problem is that we're stuck in an environment of extremely low interest rates, and that encourages bad behavior. I'm sure you know better than me the legal and technical complications in certain countries of going to negative interest rates. I think there's our perception is that the most important real effect that it has is a hot potato effect. It increases the velocity of money because no one wants to hold on to something that it has to earn negative interest rates on. Does that have real effects? Does it have financial effects? Is it price? Is it quantity? We'll see. But I would say that it's more likely to influence financial variables up than real variables.
I agree with that. So I think that the relevance of this is interest rates are 10 basis points higher or lower. Really, I don't think that matters too much. But combined with other measures, it's just a commitment from the ECB to really address the deflationary issue, which really the market is concerned about. And this may be the first step of others or just a step. So the rest is, I think that for me, is more about commitment and direction of the road rather than if interest rates are 10 positive or 10 negative.
I would also just pick up on that point too. I think that's very important that this is an important threshold step, but it isn't probably going to be a very big one, say minus 15 basis points in terms of the negative interest rate on deposits held at the ECB. But it probably will have a sense, perhaps in the press conference later on, of if this doesn't work, there's more to come. So I think that's actually a very important statement. The one thing, though, that I would say is this, is that around the world where central banks have seen their balance sheets swell and banks have held a lot of excess reserves in their banking, at the central bank, there's been no elasticity, if you like to use that term, of falling short-term interest rates and deposit rates and their willingness to hold, right? So they held at zero, and they held, obviously in the case of the United States, trillions of excess reserves at the Federal Reserve at zero. Once you begin to tax them, and you say, well, it's actually going to cost you something. Maybe it's only 10, 15, 25 basis points. That's a negative cash flow. That elasticity might actually change. So I might suggest there could be a little nonlinearity here. Now, what does that mean? Well, the banks then would take their money out of deposit at the ECB and park it, let's say, in short-dated, very liquid instruments that are available, of course, within the banking system and in certain securities. But it certainly would have maybe that effect. I'm not sure it has massive macroeconomic effects, but that's one thing to watch for.
Good. Any other questions at this point?
Yes, Jesper Berg, Nykredit. To what extent do you see a falling capacity of the banking system to take positions in various markets in light of recent regulatory initiatives, leverage ratio, LCR, etc.? And to what extent do you see that influencing the liquidity of markets, and what are the macroprudential implications of that?
Well, as I mentioned before, clearly banks today for unit of risk, they have to have more capital. So therefore, the size of their balance sheet is some way or the other defined by that. Leverage is another regulation into the same camp. But there also as instruments become more standardized, and some of the asset classes, so they go towards more standardization. So you will find that the mix between what we do on a principal basis and what we do on an agency basis over a period of time will tend to change. And probably the deployment of capital that is absolutely necessary, in my view, to facilitate intermediation in certain asset classes, it will be more devoted to those that really need it and less devoted to ones that it can be sorted in a different way. So when you look at the interest rate markets, for example, it was one of the markets that was less standardized. It's heading towards standardization, and probably is one of the products that is going to lend itself more to be traded in exchanges than it is traded today. So that portion of the liquidity will be not provided by banks, it will be provided by someone else. So altogether, the reality that you have a world that it has less leverage or more by having more capital and operates a higher level of liquidity, and with an overarching space of regulation, Volcker being one of them, that is going to some way or the other hurt liquidity, but there are other mechanisms creating around that is sort of probably balanced in certain way.
Jaime, the Basel Committee is not meeting today, so can you have some insight into this question?
Oh, I mean, I think the liquidity was one of the big issues that needed to be addressed in terms of the financial institutions. That was addressed, and I think it has been already, as far as the short-term liquidity is already there. You can have better ratios just by lengthening your liabilities, which is something that sometimes is not considered. You don't need really to buy too many assets. But in terms of your questions, I think I will come back to my previous answer. I think the previously to the crisis, it was not that there was that much liquidity. There was only liquidity in good times. So this false sense of liquidity, I don't think is helpful. So it is much better that you realize that some of these securities have low liquidity. And of course, only banks that are well capitalized will be able to hold these positions. So I think all in all, it will be more realistic, perhaps a little bit less booming in the good times, but probably if they manage it properly, there should be similar liquidity or perhaps lack of liquidity in stress times. So I think, yes, there is a little bit of an issue there, and we will be monitoring that. That's one of the things that we are doing, monitoring how this works. So we know that there has been a change, and we need to see what are the consequences. But in principle, I think we have moved in the right direction.
Well, we have time only for one last question. Who would like to ask the last question? Yes, please.
Thank you. If we look forward the dynamics of Basel III on the balance sheet of the banks, the overbanking of Europe being what it is, would the speakers believe that there is a serious chance that there would be a rebalancing act between financing through the balance sheet of the banks and the financing through capital markets in Europe?
I'll take that one. So the answer is, in my view, is yes. And I think that Europe is already moving, and probably even further, toward a similar system as there is in the US. So if I look at our own company and our US business, so we have a commercial bank that serves 23,500 clients, small and medium-sized companies, and then we have the corporate investment bank that I run that is sort of focusing the biggest companies. And you can see how the financing process works. For the commercial bank, it's mainly through credit. So it's bank lending, what we do, and the size of the portfolios will be a multiple, or is the size of the portfolio in my part of the business. And as soon as you see those companies becoming bigger, they get access to capital markets, and the portion of liquidity that they require for banks is contingent liquidity rather than pure lending. And that's how the system works, and constantly works in that transition. I think that Europe have no other chance other than doing that. And I think that it's already seen, the capital markets is growing, and I think that it will grow. This sort of 70-30 that the numbers have been turned around, that I suppose is relatively right, is exactly the other way around in the United States. So it will get there over a period of time. In the meantime, you need to make sure that there is enough capital around and there are enough mechanisms around to finance the small and medium-sized sector that is in this environment, the one that may suffer the most.
Yeah, I think that Daniel just gave a very excellent and concise answer. And I think that that is a good note to conclude our session. And please join me in thanking our panelists for an excellent performance today.
Thank you very much. If you could return for 2 o'clock for the afternoon sessions, lunch will be served in the library. Do enjoy.
1,000 people across 11 countries and is funded with a £10 million
together. And they put money into a central pot. They use some of it for social funds when somebody has a problem in the family. They use other bits for loans. A lady set up a very small little shop.
But our friend Juliana, on a Mediterranean, Yamana use was a loom morning in a scanana,
to help you. And she said, no, you have given me my dignity back.
The key word in this is change. It's a different way of doing banking, but the other part of the change is the people who participate in this usually undergo some sort of profound change.
Our business is dependent on communities, and if we don't invest back in those communities, we won't be a sustainable business in the long run.
Since 2009, we've created 25,000 village savings groups across 11 countries. That's 500,000 people held us. To deepen our impact and focus on our next generation, Barclays is committing another over the next 3 years.
This is the sort of thing that banking should be. People, real people, in real.
DIFC is celebrating 10 years of success, 10 years of partnership, 10 years of growth. It's how we've become a global financial hub. Home to over 1,000 leading companies, DIFC is the ideal platform to grow your business in the dynamic Middle East, Africa, and South Asian markets.
Welcome back, everybody. I hope you enjoyed lunch and are refreshed. You're certainly in for a treat this afternoon. We're going to turn to an issue that has seen much discussion recently, the internationalisation of the RMB. And I think we're going to get a taste of what you think when it comes to RMB. We'll get you to open the app again, the IIF app, and we'll ask you a question. Is your firm active in China? Is your firm active in China? Well, while those results are coming through, let me talk about the next panel. Of course, there has been progress on internationalising the RMB in recent years, including steps to allow offshore settlement, banking and capital market incentives, as well as the use, of course, of RMB in international trade with China. Indeed, the yuan now is the second most widely used currency in international trade finance after only the US dollar. This is ahead of the euro and the yen. So our panel discussion is going to take stock of these developments and assess how the internationalisation of RMB may progress, what the future holds for the role of offshore centres such as London. We have the results coming through. The majority of you have a firm or a part of a firm that's active in China, so no doubt this session is going to be of great interest. Please do continue to tweet as well using the hashtag IIF London. First, though, let's introduce our panel. In fact, Charles Roxburgh, Director General of Financial Services at Her Majesty's Treasury, is going to moderate. He will introduce the panel, but they will join him up on stage now. Do enjoy.
good afternoon, everyone. As our moderator said, my name is Charles Roxburgh. I'll be leading this discussion. My role is that I lead on all financial services matters at Her Majesty's Treasury, just across the road there. And as you heard from the Chancellor yesterday, this is a very important topic for him. So my first duty is to introduce our terrific panel, and we're very, very pleased to have a pretty great panel to discuss the internationalization of the RMB. I'll introduce them from right to left. First, we have Spencer Lake from HSBC, who has a long career in banking and is a key figure in leading the development of offshore RMB markets, particularly in London. We have then Ligang Liu from ANZ, who was named Economist of the Year in 2012 by China Business News, and who's also worked at the Hong Kong Monetary Authority. We have Manish Mahurkar from the International Finance Corporation, and he has extensive experience of local currency capital markets, and the IFC recently launched a major renminbi bond here in London. And then we have a former colleague of mine, although he now works at Standard Chartered, George Nast, and obviously he brings huge experience of Standard Chartered's experience in trade and renminbi flows in Asia. And then on the far left, my far left, Mr. Yong Yu, who's from the Ping An Bank, and he's also worked at the Chinese banking regulator. So we have a very diverse and extremely expert panel. I'll just say a few words of introduction just to reinforce the interest of the UK financial authorities in this market, and a few words about what we're doing, and then we'll get into the discussion. I want to make sure we leave plenty of time at the end for your questions of this great panel. As you, I think, heard from the Chancellor yesterday, he is personally extremely committed to ensuring that the UK and London in particular achieves real leadership in helping promote the RMB as an international currency and in getting London to extend its lead as a financial centre in it. The Chancellor is personally involved, and he keeps his officials' feet firmly to the fire to keep making sure we're doing what we can to help develop this market. I mean, the potential is huge. China's obviously the second largest economy already, and at some point soonish will be the largest in the world. And although the offshore market is still small, it's got clearly huge potential. And the UK authorities are determined that London should, as the leading global international financial centre, really make sure we retain and extend our leadership there. There are a number of projects where the government is working very closely with the private sector in areas like the City of London internationalisation effort around the renminbi. We also got a big push on a national strategy for investment management, which includes how do we make best advantage of the UK QFII quota, which was negotiated recently. And so there's a lot of push from the Treasury, working with the PRA, working with the bank to make sure we capture this opportunity. But we, like all of you, want to know what's going to happen next and what are the new developments, what are the new opportunities, and that's where our panel comes in. And so I will now ask our panelists to make sort of a brief opening statement as to where they see the opportunities, what their perspective is on the internationalization of the RMB. We'll hear sort of 3 or 4 minutes from each of them, and then we'll get into some questions from me and then questions from you. But Spencer, would you like to lead off with a few opening thoughts?
Sure. I guess one thing that I would say, I know the title of the panel is RMB internationalization, but I thought that, for my part anyway, because I suspect that my fellow panelists will focus on that as the title, I was going to put that in the context of China globalizing, which I think is even more comprehensive. And the reason to do that is because to us it's very logical for the currency to globalize. But it's also very logical to see that the capital flows of China also begin to globalize. And we've seen this going out and this integration theme become even more prevalent as China goes through the next phase of its development. We know of China as a trade partner, as the largest trading partner in the world, both inbound and outbound, and obviously the currency is a big manifestation of that. On the capital side, what is maybe less well known is that China is the third largest investor of capital around the world, behind the United States and Japan. It's moving its way into the second place, and our view is that it becomes, on a net basis, by 2017, a net exporter of capital, which is quite a unique position to be in addition to obviously being the world's largest trading partner. And that phenomena has grown quite significantly. Over the last 5 years, we've seen China capital exports grow by 35%, or triple rather. Over the last couple of years, it's grown by 35%. It's been done in 3 waves. The first wave, which has gotten quite a bit of notoriety, is around kind of raw materials, energy, and focused primarily on emerging market countries, where probably 75% of that capital has been invested to procure, if you will, the raw materials, primarily energy, but also to complement coal and to complement the other growth areas, as China, had a big export-driven dynamic. The second, and that continues, but it's supplementary as opposed to the core theme. The second wave has been infrastructure, which is logical to support the raw material push and the procurement push that they've had, and that obviously will also continue. Is also predominantly emerging markets oriented, because that's where infrastructure has been the weakest, although we've clearly seen inroads also into Western economies here in Europe and also in the United States. The third wave, which is becoming quite interesting and also more noticeable, is around goods and services, which is also logical, because China, as they become more consumption-oriented and as they build out their local domestic market, if you will, they need technology, they need brands, they have a focus on environmental issues, a focus on food-related issues, et cetera. Interestingly, because the EU or Europe is 14% of their overall ODI, generally speaking, it mirrors where their economy is going, but it's only half, really, of where their overall exports go currently. So we would expect to see that grow quite significantly. Here in the UK, we've seen investments in Weetabix, we've seen investments in Volvo, we've seen investments in the taxi cab company, we've seen investments in Malta, in Poland, everywhere you look, and it's not majority owned. It's in many cases minority owned, because the recognition is there that they need to get management expertise, et cetera. So I think the China outbound as an integration to fulfill their domestic strategy is quite important. On a going forward basis, as I said, ODI has tripled over the last 3 years. In 2013, it was 90 billion. Our expectation is that it grows to about 170, 180 billion in the next 3 years, which is quite significant.
Renminbi deposit in Hong Kong is now at around 1.2 trillion. This is not a small number. Keep in mind that in China's new loans before 2008 was around 1 to 2 trillion. Meanwhile, renminbi settlement has reached to 1.3 trillion in Hong Kong, and also in terms of capital market development, we have a vibrant dim sum market, and also renminbi has been used as a loan to lend to firms. And in addition to that, we have seen very rapid market development. Hong Kong being the largest renminbi offshore center. Now we see Singapore, Taiwan are doing a very big renminbi business. Increasingly, London is catching up, and in the not so distant future, even Sydney could become a renminbi offshore center. And indeed, we also have seen some milestones for renminbi as a trade invoicing currency. In the past, when we talk to mining firms, it's very difficult to persuade them to use renminbi as a trade invoicing currency. But not in the last, beginning of this year, we saw a major miners has been using renminbi, basically received the renminbi payment from a Chinese steelmaker. You can see that all these things has been progressing at a very fast pace. In the coming years, we think that the renminbi internationalization will only accelerate. As Spencer mentioned, that China will use Shanghai Free Trade Zone as the facility to accelerate renminbi's internationalization. Specifically, we have seen that multinational firms can set up their treasury operation in the free trade zone so that they can send their renminbi earnings easily out of the country. And so that will eventually make renminbi's pool larger in the overseas market. And with that, renminbi will also become a more sticky currency in offshore, and eventually with gradual capital account liberalization, asset managers, insurance companies will develop more products and use renminbi as some kind of asset class for their investment. Together, we have already seen that central banks globally have become very interested in putting some of their reserves in renminbi assets. So indeed, renminbi's internationalization is a very compelling story driven by China's economic size. China is the largest trader in the world. And this does not mean, renminbi will replace any other currency. I think renminbi's internationalization basically will give a lot of financial centers one extra currency for them to think about. For Chinese exporters, they could hedge their currency risk better. For others, they can enjoy the rising renminbi in value. And so it's a win-win situation. I would say that going forward, the biggest constraint has been that if renminbi would like to become an international currency, China's financial system will have to become international. But so far, we have been seeing some progress in Chinese banks' internationalization, expanding abroad, but the progress so far has been quite gradual. And I think until we see Chinese banks become more international, and renminbi will then truly become an internationalized currency.
Great, thank you very much. Manish, maybe some of your perspectives on where you sit in the IFC.
Sure, thank you, Charles. So clearly, I don't need to emphasize to this audience here how strategic this whole theme of RMB internationalization is. But just to add to what you heard from my colleagues on the panel, it's interesting to look at this whole development in a somewhat historical context. And looking at some of the studies and research on this, if you look at over the last 100 years, we've seen the decline and emergence cycle of about 4 or 5 major currencies over the 20th century. So the first half of the 20th century was about the rise of the US dollar and the gradual decline of the British pound as an international reserve currency. Subsequent to that, we also saw the emergence of the Deutsche Mark, which was eventually replaced by the euro. And somewhere in that, in the 70s and 80s, we saw the emergence of Japanese yen. Now, the reason I'm mentioning all these currencies as they became prominent as international currencies, because we can learn from each of these experiences as to what may or may not happen in the case of RMB. The one fundamental difference, though, which is interesting, is that this is probably the first time that there is a government-sponsored strategic focus on developing the currency as a potential international currency of trade, of investment, and potentially as a reserve currency. I'm not sure if this was ever done in a strategic, planned way in the past, because some of that probably happened more spontaneously, in line with economic growth of certain countries, in line with international trade, etc. So I think I just wanted to sort of place that for some attention from the panel as well as from the audience, because I think that's very important in terms of pointers of where things will go from here. From our perspective in IFC, our engagement is significantly with the capital markets aspect of it, the investment and the capital markets aspects of it. And that's truly been an exciting story, as you just heard from my colleagues, where almost within 3 or 4 years of activity starting in the offshore market with Hong Kong, we've actually now seen a series of capital markets and bond issuances, not just in Hong Kong, but as you probably heard, even in London with some Chinese banks. And IFC itself participated in this market by listing 2 of its benchmark RMB bonds in London as recently as a couple of months ago. So truly exciting developments. We're beginning to see a very broad-based investor participation in this market. I do agree with my colleague here that ultimately the growth of this market from here, while we're talking about the international aspects of this currency, in a way, and perhaps counterintuitively, significantly depends on what happens to the domestic capital markets in China. The two are very closely interlinked, and maybe we'll touch upon this a little later in the discussion. But I'll stop there with my opening observations.
Thank you very much, Manoj. George, maybe some of the perspectives you're seeing from the Standard Chartered network out there in Asia.
Sure, absolutely, Charles. So if you look at the development of RMB, it really is a story of overcoming inertia. The 100-year perspective is a very interesting one because in just 5 years, this currency has gone from what was primarily a domestic settlement currency, the launch of a low-scale trade pilot, to now, in the last quarter, 24% of Chinese trade effectively being settled in RMB. And if you roll back 5 years, if you were an American or a European company, what was the imperative? What was the impetus to start changing your ways when dollars and euros were doing perfectly fine? And it really is to overcome that inertia, you need a good, compelling reason, the why, and you need the means to do it, the how. And that's really how the RMB has developed. The compelling reason, I think we all know. China is the second largest economy. We expect it to be 24% of global GDP by 2030. So if you're a multinational, China better be in your strategy. And therefore, it's not an issue of if I should deal with China, it's how do I deal with it in an effective way. The how part is very important because in these 5 years, what we have seen is an enormous amount of liberalization going on. And as was mentioned, much of it a planned series of events from the Chinese government, creating the tools as to how you use the currency on the international stage. And I think that's very important because today, if you are a company that's operating in China, you have wide degrees of freedom. Traditionally, China's operations of a multinational will be quite ring-fenced and separate. And successful companies who would generate profits in China often had problems with trapped cash. Now they have the tools and means to sweep that out, integrate that into their global liquidity structures. They also have the means to deal in FX and hedge their exposures. It was very interesting, a client experience 2 years ago was they were looking at making a project investment in China, and they were able to hedge that investment without moving the market one bit. And that was when turnover in offshore RMB was about 5 billion a day. Today it's about 30 billion a day. So you've got the liquidity that backs that up as well. So today, if you're at a company, you can integrate your cash into global cash management structures. You can settle and invoice your transactions vis-a-vis China. You can raise increasing amounts of medium-term financing in RMB. So the tools available to you are as broad as ever. And that's why we've seen this rapid development for corporates. Essentially, their current account is open. The challenge going forward, as well as the opportunity, is around the capital account, and specifically how investors can participate. Yes, we've seen QFII and RQFII programs, we've seen initiatives to increase the opportunities for investing in China, but it's still relatively closed, and that's really where the opportunity is for growth. As I mentioned, the why, the importance of China, has already been told, but only 2% of China's capitalization has any sort of foreign exposure to it. So out of all proportion to China's relevance in the global economy. So if you're an investor, the why is I need to diversify, I need to get exposure to this. And the next wave of liberalization, we think, will increase that access. So certainly exciting opportunities. A few years from now, when we're talking about a G3 set of currencies, it'll probably be dollars, euros, and RMB. And I hope I don't get lynched for saying that and excluding sterling, in that mix. We'll have an effectively, basically open capital account, basically floating currency. We'll be referring to SHIBOR as much as a reference interest rates for global cost of funds as we will with LIBOR. So a lot of growth still to come.
Great, thank you, George. And then finally on this opening set of views, Yong, maybe your perspective from the Ping An Bank's point of view.
Okay, thank you, Charles. Just as George said, I think a lot of facts on the table. I just saw the survey print on the screen say 80% people has foreign activity in China. So you can see why renminbi internalization has been a hot topic recently. I'm pretty sure you can strike talk on this anytime with anybody in this room. It's quite amazing. About 5 years ago, the trading partner with China has to deal with dollar and all euros. But after 5 years, as George mentioned, almost 1/4 of trading settled in China are in renminbi. And also, as you know, renminbi has become the second largest trading currency by the data released from SWIFT. And also, I think it's top 10 payment currency according to data from BIS. And it has been well on the way to become internationalized. But as you can see in the process, the biggest challenge for us is how do you make people who do not directly involve in China try to use renminbi, which other places. Because although you can say Chinese economy is second largest in the world, it's going to be the largest one by estimation of 10 or 20 years. And it's number one trading nation. But those are just a volume. You will need a lot of infrastructure and a lot of conditions in place in order to meet the standard of internationalization of the currency. And I think number one is to be a global trading currency, which has been well in place, as my panelists have mentioned a couple of numbers. Number two is has to be global investment currency. I think we have been doing a lot of things in this area recently, and a couple of panelists mentioned RQFII, and which is for the foreign institutional investor. And also, there's going to be a new second stage of RQDII, which means for domestic investor. And also, it's going to be some talk about for individual invest in China to use renminbi outside China. And the other one, probably some you are very familiar with, is Tiansheng Bond, which has been a very great success in several offshore renminbi center, like in Hong Kong, which has about 70% of offshore renminbi deposits there. And I think London, Singapore are also on the way to become offshore center, or maybe already yes, with less volume than in Hong Kong. And there are a couple of more things we are doing, I think, is try to expand the pilot program in certain city or region in China. As you already know, we just opened a new free trade room in Shanghai, which is a pilot program, which gives new or more challenge for people to use their renminbi surplus outside China. And also there is inbound activity too. And the second special zone or area which is located in Shenzhen, which is where my bank is located. It's called Shanghai Pilot Zone Area, which also have very, very relaxed and pilot program for offshore renminbi to invest it in China, also for China renminbi onshore to offshore. The channel is opened. Of course, there are a lot of limits and quotas imposed by the authorities. And overall, I think it's well on the way to be a global investment currency. The last one is to be a global, or you can call international currency as a foreign reserve. This is going to be a very tough one because right now, probably you know, countries like Malaysia and Nigeria and a couple other African countries, as far as I know, are using renminbi as reserves. And, but it's still quite a long way to be international currency. As you know, for instance, dollar, almost half of dollar cash existent circulate outside America. And I think most of foreign reserves are in dollars. So in order to catch up with dollar or even euros, it's going to be a long process. But overall, as the panelists had mentioned, I think I'm also very optimistic because doesn't matter which word you use, accelerating or is well in the place. I think we're on the fast track because you look at the Chinese economy has been developed like this way annually with 8 or 10% GDP growth for the last 30 years. It's quite amazing, no matter who you talk to. And second is the trading volumes could be increased, as you see from the neighborhood trading partner in Asia to Europe and to Africa and to different continentals. The last one I think is there are a couple of real reform is going on in China, especially surrounding interest liberation, foreign exchange rate reform, and to deepen the reform financial market in China, especially bond markets, which is precondition to provide liquidity and the depth and the size for the renminbi to become a global investment currency and finally to the international currency.
Great. Thank you very much. Well, in the next stage, we're going to dig a bit deeper on a few areas, and I'll ask each of our panelists some questions in these 4 areas. First, thinking about the role of the RMB as a trade settlement currency. Second, the RMB in terms of a financing and investment currency. Third, as a reserve currency. And then finally, to pick up some of the themes you've already begun to hear about the link between the internationalization of the RMB and China's overall reform program. And then we'll come to your questions. Maybe starting with the RMB as a trade settlement currency, and I'll start with you, Spencer. Maybe what are some of the big trends there you're seeing in terms of the clients and the role of commodities, and how are you seeing some of the big trends on the trade settlement side?
Well, I think most of the activity that we've seen so far has been around the logical trade products that are moving between China and other countries in the world. And that's a logical place, and that has been where we're seeing the settlement in RMB be most active. That's clearly going to continue because that's the sweet spot of where they're going. You mentioned commodities. To us, it's also a very interesting space because China is the largest actually consumer and exporter of energy around the world. Actually, most of their exports have been around the coal space. Most of their imports have been around the oil space, the kind of liquid energy space. And that's also going to continue. It has massive needs on a going forward basis. The question is, when will that then get redenominated or be settled in yuan? The same is true for gold. China is the largest importer of gold around the world, and many would have seen yesterday's news that the central bank, that the PBOC is looking now to encourage people to settle gold transactions in yuan. I think that this is a topic maybe that's even more centered around China and the Middle East, just out of curiosity, I went back and looked at in Saudi Arabia, just as an example. In 1990, Saudi Arabia sold 27% of their exports, and the vast majority of their exports are oil, into the United States, and 0.1% of their exports to China. In 2000, the United States had gone from 27% to 18%, and China had gone from only 0.1% to 2.4%. In 2013, China had gone up to 13.9%, the US had dropped to 13.6%. So actually, when you look at them, and those numbers are growing at a very high compound annual rate just because of the consumption needs of China. I don't have the statistics on gold, but to us it would be then a logical exercise to move from the vanilla products that are the day-to-day trade flows, whether it's materials related or food related, et cetera, in China, to other more bespoke products. That's a game changer. I think that doesn't take that long to happen. I think that there's already discussions around exchanges getting set up in order to facilitate that. I think it's a game changer for the US dollar because that has been the purview of the dollar in the past. So maybe it has to be staggered and beta tested like the Shanghai Free Trade Zone. So those are the kinds of things that we find quite interesting.
Great. George, what are you seeing on the customer side here?
Yeah, I mentioned this in my opening remarks, where we're really seeing corporations that are operating in China really change their approach to how they manage their treasury. Traditionally, China has been pretty closed because of its various restrictions. Multinationals have been very successful selling their products in China and manufacturing in China, but it was hard to integrate that in any sort of global cash management system. Now they can do that. July of last year was a major liberalization that allowed first one-way sweeping out, then two-way sweeping back and forth. And with the creation of the Shanghai Pilot Free Trade Zone, there'll be even more opportunities to do that. And that really changes the way companies manage their treasuries. They can manage it out of Hong Kong and Singapore, integrate China into their normal treasury activities. It also gives them the confidence to double down yet again on re-invoicing into RMB, because they know they have the tools available in the offshore markets to hedge the currency, to integrate it into cash management pools. What's interesting is the same phenomenon is happening for Chinese companies as they grow abroad. They have exactly the same ability to do this. So they're setting up treasury centers in Hong Kong and Singapore with, and participating in the same freedoms that Western multinationals are. And it's really beginning to have an impact on the offshore market. So as we've seen, the renminbi has actually been somewhat weak over the past few months, and traditionally as deposits have built up offshore has been when the currency has been strong. Well, the growth continues, primarily because there's this big ocean of funding and deposits onshore that is slowly beginning to drain into some of the offshore markets. So we're not yet at the 50% of US dollars being outside of the US example, but these types of liberalizations is actually enabling that kind of trend.
Thanks, George. Maybe a final question in this area. Young, you mentioned the importance of from the domestic side. Maybe you will hear a bit more about, given now that the RMB, I think, is the second most used currency in trade finance transactions, overtaking the euro now. What are you seeing in terms of Chinese domestic demand, and what are you seeing your clients in China doing to really take advantage of these opportunities?
I think, just as George mentioned, I think it's going to be quite interesting, as you know, and starting the offshore market starting in 2004. When the first renminbi account was opened in Hong Kong. By this is going to be 10-year anniversary. And the volume, the deposit, as just mentioned, has been increased to, I think it's about 9 billion yuan in Hong Kong. Maybe the number has been updated very quickly. And as for the currency swap agreements, central bank has been doing with other countries has been increased to about 25 countries with total volume of about 2.3 or 5 trillion yuan. And there are other minor numbers and assessment program has been going in China in terms of the authorities designed, like I just mentioned, the variation of the variety of the QR, FDII, and some for the individual investor. And but you have to be seeing the progress has been gradual, and because it's very hard to gain consensus among different group or department. I still remember about 3 years ago when I was in a conference talking to a senior official from the central bank, the People's Bank of China, PBOC, and he frankly said it is in the interest of central bank and for the business to push forward, to promote hardly for the renminbi internalization, but the consensus is difficult because there are different interests involved. So what they are doing right now, I think is, in my view, there are a couple of them. One is try to push hard in terms of establishment of different large renminbi offshore center. Second is try to create more channels for the renminbi to flow in out of China. Third and lastly, I think is try to do more in the fundamental work in terms of renminbi usage and getting them more attractive for foreigners, like renminbi investment bond, and which you all know, Diansheng bond outside China or inside Panda bond. And we also, I think there are several new programs in pipe. I think it's going to be very interesting, very interesting one.
Great, thank you. Let's move on now to the experiences that some of you had in terms of the RMB as a financing and an investment currency. Maybe starting with you, Manish. You recently became the first benchmark RMB bond issued by a multilateral organization. We're very pleased you chose London for this. And it'd be great to hear a bit more about what was your thinking behind that issuance, what were some of your experiences, what were some of your lessons learned from that bond issue?
Sure. So, so clearly, I think the case for RMB from the perspective of trade has been well made, given the size of the Chinese economy and its presence, dominance as a trading partner. Coming to the capital market side of it, as Charles said, we've been actively engaged. We have our most recent experience of issuing benchmark RMB bonds, global RMB bonds out of London, working with our investment bank partners such as Spencer here from HSBC, has been a very positive experience, no doubt. One of the first things we thought about, this whole question of why London, because IFC itself and other multilaterals and multinationals, quite apart from Chinese companies and banks, have issued and have been issuing CNH, or the so-called dim sum bonds out of Hong Kong. So what was the rationale behind looking at London? And I think the proposition here for us, which we wanted to test, was by positioning the issuance of a benchmark bond listed and issued out of London, could we give the currency and give our bonds a level of visibility that would not be as feasible elsewhere? And it was something, it was a hypothesis which we wanted to try out. And I have to say that we were quite pleasantly surprised, because notwithstanding the liquidity out of Hong Kong or Asia or elsewhere, the fact remains that listing a bond out of London does attract a kind of global attention and visibility. And we did see investors across the US, Europe, and Asia participating in these bonds, which was sort of quite interesting to see. And also, the other thing I have to mention is the quality of the investors. Some of the investors who normally would not be seen in these issuances elsewhere. I can mention a couple of central banks, but even more generally, long-term stable investors. Those came into our issuance, and that was a very positive feature of this issuance. So as a multinational treasury, as I'm sure many of you are familiar with, you obviously want to see an alternate financing currency which is emerging and becoming a significant and viable vehicle for funding. So that's something I think we are very clear about. But I do want to kind of mention here a few important challenges, because I think those are the ones to really kind of pay some attention on. Today, even in Hong Kong, which is the most liquid offshore RMB market, I think we just heard from one of our colleagues that the size of the RMB offshore deposit base is about 1.2, 1.3 trillion yuan. As against that, the volume of outstanding bonds, dim sum bonds, is probably half or even less than half that. So you can see there's a clear evidence of a mismatch between the appetite and potential demand for assets and what's available right now in the market. And why is that, right? Because right now, if you think about it visually about Chinese capital control, it's a broad, almost you can think of it as a Great Wall of China. There is a blanket of capital control around, and then gradually some doors and windows are being opened. We heard about the RQ fee, Q fee, and various other schemes. As multilaterals, we have a couple of unique windows. We can participate in the interbank bond market. Within certain limits, we can repatriate a certain amount to lend to our projects. But these are all specific and limited windows. Largely, the market is still surrounded with capital controls. So therefore, where is the use for the offshore currency? So there is the appetite for global investors to be long the RMB, given its strategic importance in their portfolios. But the assets are not keeping pace, okay? And the second thing that does sort of come to my mind is that with this currency now being as visible, and as we just heard, has overtaken the euro as a currency of trade and settlement, you would think that there are now enough companies who are exporting back to China from wherever, Asia, Latin America, Europe, who should by now be looking at the Chinese yuan as a currency for denominating their trade, their exports. And with that, having a flow of receivables in yuan against which they should be willing to raise financing in yuan offshore, because they have an opportunity to do so. They can invoice their trade in yuan on this side, as allowed by the government, and they can raise yuan in the offshore market, given that there is enough appetite from investors. Why isn't that happening? I think those are important questions to ask. Mm-hmm. And I would submit, and there could be other views from the panel as well, I would submit, and I go back to my example of what happened to the emergence of the US dollar. And I recall reading somewhere that long after the US had become by far the most dominant economy in the early part of the 20th century, probably around the time between the two wars, they were larger. US GDP was larger than that of the UK, Germany, France, which were the big economies of that time, all put together. And yet the dollar was really nowhere still an international financing currency, let alone a reserve currency. And the British pound held out. And I think that has something to do with the fact that the emergence of deep, liquid, and vibrant domestic financial markets in the US dollar only really emerged well close to and after the war. And that's an important pointer to what needs to happen for the RMB to continue on its pace of internationalization. And that's a challenge I think I would love to hear more views from the panel as well as the audience.
I'll bring a couple of panels. But Manish, thank you. I'm glad you had such a good experience issuing in London. But maybe I'll bring Spencer and then Li Gang in to answer that points that Manish made about, the logic's clear, but it's just not happening yet. It's not quite getting off the ground. We haven't got the supply and demand quite in balance. Spencer, what's your perspective on that? And I'll bring you in again.
Yeah, I'll just give a couple data points. First, with Chairman Flynn's sponsorship, actually, HSBC was the first to access the UK market back in 2012 when Mark Bolliat's City of London initiative to create a R&B center here kicked off. And we had the same experience. I think it was very, very high demand. One of the interesting things is when you look at the offshore market, generally speaking, Hong Kong is actually the epicenter of it when it started in 2009, 2010. It began very unconventionally relative to other markets, which is a healthy sign. It began as effectively a place for Chinese high-yielding property companies to raise money as an arbitrage against what they could do onshore. And it's evolved very, very nicely, where today, 80-odd% of it is investment grade, most of it bank-related. When you look at most emerging markets around the world, they've evolved exactly the opposite. It's maybe started with an IFC or someone to come in and kickstart it with a AAA nomenclature, but then it's quickly moved, into the investment grade space and then into high yield. So that's number one. I think that that's quite interesting. Also, as of May of this year, the volume in dim sum has exceeded that of 2013, and 2013 was already a record by a long shot because the market's only beginning. So our view is that it's going to accelerate with the possible, not deterrent, but obviously the emergence of the onshore market being able to go offshore. And that brings in the free trade zone, which I'll mention in a minute. So I think the market is actually quite accelerated. I think the second thing I would say is one of the other impediments has been the ability to swap, to actually convert from one currency to the other, which in the spot market is becoming more and more liquid, but in the cross-currency market is now accelerating. And there are two examples within the last month. I won't share the names, but one is a UK corporate who's actually synthetically created the equivalent of a dim sum bond for 150 million pounds equivalent with a 5-year cross-currency swap. That is the sign of a very advanced market relative to where it's come from. And within the last 48 hours, we've seen a bank who's helping a Chinese corporate go offshore. There's been 8 acquisitions made in the UK in the first quarter of this year alone to provide sterling financing for them for an RMB-based entity, so that's going the other way. That it's extraordinary in the history of emerging markets around the world, and that's a good sign. I think the other thing, and this is anecdotal, but it's important, and maybe it gets to the central bank theme, but I think it's true for many, many asset managers' portfolios. In 1995, central banks had 67% of their reserves invested in emerged currencies. In 2013, 65% of it was invested in emerging currencies. And when you look at that dynamic shift, so that's just a data point around central banks, but if you look at the same kind of data point around asset managers, a little bit more complicated to collect, what you'd see is just a massive buildup. So I think, kind of the next big evolution is going to be the convergence of the onshore-offshore market from a financing perspective. And as the big municipal financing needs of China become more open, as our QFII schemes become more adopted, what you will see is that transference taking place. And as a result, any kind of mismatch between either currencies or interest rates or market dynamics will evolve, or rather erode over time. And that's quite significant. So we would agree. I think it's escalating at a pace that we wouldn't as a bank have thought of, but the frictional costs now are going down considerably. That's encouraging.
Ligan, maybe your perspective on how you're seeing the financing and investment side unfold.
Yeah, I think renminbi as an asset class is at its tipping point. As I mentioned that after 5 years on the trade financing side, infrastructure has been built, a lot of swap arrangement has been done, and the renminbi can flow more freely to the rest of the world. I think the key is to see the renminbi circulation abroad become bigger and bigger. And there, I think we need to see China will have to, encourage its SOEs to use its currency more, sending renminbi abroad. In the past, when you talk to Chinese state-owned enterprises, they tend to think that they can raise U.S. funding very cheaply. But now with the uncertainty of tapering and also potential QE exit in the U.S., I think a lot of Chinese SOEs are thinking about their dollar risk, the yield risk. So now I think they are more willing to use renminbi to import goods. So once that can be done, we probably, given China is a big resource importer in oil, in iron ore, in coal, copper, and others, and we will see large asset pool being built in international financial centers. So once the renminbi asset pool become large enough, it's very natural for renminbi to be used as a financing currency. And finally, I do agree with Mohoka that is the major impediment for renminbi's use in international financial market is China's capital control. And at this moment, there are still a lot of control measures that prevented renminbi's use, but we are not that far from a more open capital account in China. And there are various indications that, Shanghai would like to become a global renminbi trading and settlement center by 2015. That means by that time, perhaps most of the China's capital control item will be removed. And also, Shanghai Free Trade Zone has been used as a facility to accelerate that effort. So with that, I think, with less control, and the renminbi's use will be more natural. I would say, finally, it is also in China's own interest to see, more capital openness. We have seen that, because of, China's trade surplus, it has been creating some significant global imbalances. Some people even blame China for the problem during the global financial crisis. But the imbalance itself is affecting Chinese economy as well. That is, if you continue to accumulate a lot of foreign exchange reserves, your money base will expand. The asset bubble is a major risk. And with capital control, it's very difficult for Chinese citizens to diversify their portfolio. And so in that sense, I think given China has already had enough reserve, probably by end of this month, the reserve is more than 4 trillion. And so it's perhaps they could feel more comfortable to allow its capital account to liberalize. With more capital account liberalization, renminbi assets will have to go abroad.
Great, thank you. Let's spend just a few minutes on the outlook for the RMB as a reserve currency, and then we'll throw it open to the audience. George, what are you seeing with central banks at the moment? What are they interested in? What are you hearing from them about their plans for the RMB?
So there's a lot of interest in this, and we're seeing accounts being open with international banks such as ourselves. The Chinese government has established a special link to allow central banks to purchase government bonds directly. I think it's very clear that, and I think the numbers were highlighted as to the proportion of reserves in the central banking community, that this is an asset class that needs to have a bigger exposure in central bank portfolios. So the trend is definitely one where we will see more accumulation of Chinese assets, particularly government-related assets, in the portfolio of central bank reserves. And I think that's also, if I think a little bit on the forward view, probably one of the most critical things to address the challenge that was raised is lots of interest in going long RMB in deposits and getting exposure, but very little assets to deploy them. If you think of what makes the US dollar such a dominant currency, is the fact that you've got this massively liquid government bond market that you can instantly deploy your excess liquidity in and out of. And so one of the moves to really look forward to is the Chinese government bond market, which is actually a very large bond market. Making that accessible to a broader set of investors will actually alleviate some of the challenges that we'll highlight and give comfort to companies, to investors, to individuals as they accumulate RMB exposures offshore, that there is a means to deploy that liquidity into a safe asset that I can instantly gain liquidity from. That's the trend to really look out for.
Great, thank you very much. Well, we've got 10 minutes left on the clock, and I want to make sure we don't shortchange the audience questions. So we'll now throw it open to you. If you could maybe introduce very quickly yourself and your organization. If your question is directed to a particular member of the panel, that's fine. If not, I'll direct it to a lucky recipient. Yes, at the back there.
Thank you. I'm Johnson Ching from Edikani. I myself speaking on the topic for a couple of times, but what is interesting, I think, in the last couple of months is that, you know, in the past, I mean, the importance of RMB as a potential reserve currency, I think we all recognize the challenges we talked about. But in the past, I think most markets believe it is pretty much a one-way bet in terms of the safetiness of a positive return investing into RMB. And in the past, trade was good, but you know, since the crisis, I think using trade as a driver for RMB for internationalization is also being challenged. My question is, recently China has announced a deadline that it will fully liberalize its interest rates internally within China. And also recently it broadened the band of RMB versus US dollar, right? The first 1% took 9 years and the second 1% I think took a couple of months. So it is sending a signal to the market that it may not be a sure one-way bet. Thus, you know, with trade not doing very well in the near future and the volatility of the currency rates, my question to the panelists is, how would the market react if, you know, RMB starts to fluctuate more and therefore, you know, making money is not a sure thing? And how can the financial institutions, both the global players as well as the Chinese players in the offshore market, can play a role to make sure that the globalization of the currency can take place and take place in a healthy and normal way? Thank you.
Li Gan, would you like to go at that one?
Okay, as an economist in the panel, I answer that question. If renminbi can only appreciate, then people hold that as an asset. I would say that is a very forced internationalization process for renminbi. I think renminbi should be used as a trade invoicing first, and maybe eventually as a store of value. As what you mentioned, that we have not seen the dim sum market become less active after renminbi's depreciation since mid of January. And the reason is that in the Hong Kong market and eventually in other offshore renminbi market, there will be a lot of hedging instruments available. And the Hong Kong market, in terms of hedging instruments, derivative products based on renminbi, has become very vibrant, especially, you know, Hong Kong Treasury Market Association has started to announce HIBOR, you know, CNH HIBOR every day. So with that benchmark interest rate, that will allow derivative product to be established. And so I think I would say that going forward, you know, although if you look at renminbi's current depreciation, but we do observe that even with depreciation, China still faces significant capital inflow, suggesting that if you look at the fundamental indicators, you know, using PPP-based GDP calculation, you know, suggests that renminbi over the longer term still has a lot of potential to appreciate. But for the short term, I think the key risk is that whether China going forward can also encourage capital outflow. At this moment, we know that Chinese residents still can only exchange $50,000 per year per person. If that foreign exchange quota imposed on Chinese citizens were to liberalize to $250,000 or $500,000, then we may see large capital outflow. With large capital outflow, the renminbi will not necessarily appreciate, and also the renminbi exchange rate will become more flexible, and that will actually help the PBOC to regain its monetary policy consistency.
I mean, I would add to that I think that when you look at the 1%, then the 2%, the market was, quite benign to the move. We did not see major disruption because actually the broker-dealer, the intermediary community, if you will, much like the investor community on the other side, is extremely used to volatility within a currency. So, the mechanisms in place are pretty sound. Number two, I think, to Mr. Liu's point, at the end of the day, as hedging products and as, using options or forwards or, lightly structured, you can manage your risk much more sensibly than you could before. That's still at an early stage, but it's realistic. I think also directionally people would fully anticipate that it's going to continue. And so you're starting to see less of a one-way bet mindset with investors and a much more balanced bet. So when people are looking at their portfolios, they're now looking at China as an asset allocation play more and more than simply, I'm just going to take part in the appreciation. I need the diversification because I'm overweight dollars. I've been overweight euros because I don't have an alternative to dollars in a major currency. I'm overweight sterling maybe because I'm also taking the same view. So the balancing act that the RMB, as it becomes a more liquid currency, is, I think, positively perceived by the marketplace.
Thank you. Yes, Johan.
Yeah, I'll just add a little bit from a local bank's perspective. I think your question actually is quite broad. You mentioned first interest liberation has been going on in China for years. But recently, as you heard, the governor of central bank, Zhou Xiaochuan, mentioned it's going to be 1 or 2 years fully liberal interest rate. Frankly say, it might be the case because if you look at the interest rate in today's domestic market, actually for the deposit rate is still under control. But for the lending rate, it's quite flexible. You can, for instance, the bank can lend can do the lending from the base rate, which is regulated by the central bank, to 10% to 10%, 20%, 50% high. The base rate, pretty much marketable. Second issue you mentioned about the ban expanding for the foreign exchange rate. I think it has been the case for years. Officially, they claim to be market-driven, flexible, because it's a basket of currency, which is, how many currencies there. It's going to calculate it like that. I think to be internationalized, to be internationalization of the renminbi is like a double-edged sword. And one way you have to be make it attractive for investor, individual firms to get good returns. Like you mentioned, actually, I think in the short term, still going to get good return with the tools a couple of panelists mentioned to hedge risk. Secondly, in the long run, you have to take responsibility to be truly marketable, which means the renminbi has to be really reflect its true value. It doesn't have to be manually controlled, undervalued, or overvalued. And as far as I know, they still has a lot of opportunity for investor with renminbi, either onshore or offshore, to making very, very profitable collection there.
Great, thank you. Yes, a question at the front here.
Yes, thank you, George Long from Lim Advisors. I'd like to ask several structural questions. There's no question that trade in renminbi has gone up a lot, but as a foreign investor, there are several structural issues that we've encountered. One is taxation, especially, or at least if you use the example of the QFII system, there's still a great deal of uncertainty over how foreign investors are taxed on QFII. Now maybe offshore renminbi is not part of that, but still there is a great deal of uncertainty over taxation of renminbi denominated assets. The second is over bankruptcy rules and legal systems. There's still a great deal of uncertainty how creditor rights will be protected or enforced on Chinese bonds and debt instruments. So if you can try to address those issues, which are obviously very important for the renminbi to become further internationalized.
Any volunteers for those two? George?
I'll take a shot at that. Actually, our Q fee is one of the vehicles that our clients use to address some of the taxation issues, particularly legal structures out of Hong Kong. I agree with Q fee. There still is a lot of uncertainty depending on the tax jurisdiction that that you're in. We've seen Hong Kong investment vehicles actually being a popular route because there's a much more established tax framework around that. As for creditor rights in China, yeah, that's an issue. It's an issue across all emerging markets, candidly. I don't think China is that much different in that respect. I guess what's different is just the sheer size of what is the potential. So that's certainly an area of reform that needs to do, independent of internationalization of RMB. I mean, solidifying creditor rights and bankruptcy law in China is a good reform in general. And I think there is an issue, and I think that's an area that needs to be a focus. I will say is the more introduction of foreign investors with global standards that come into the market, there will be the increasing pressure to look at this and do something about it.
Any other additional points on that one?
Yeah, maybe I just a couple of sentences. Actually, for the dim sum bond, there's no tax issue because it's issued in Hong Kong. And also, in terms of bankruptcy law, Hong Kong law will be used. I think that's the reason I think a lot of international fund managers have been looking at offshore renminbi bond market rather than onshore at this stage.
Maybe the question is going to be, does a free trade zone or the Shanghai Free Trade Zone adopt international law as a mechanism to get around that? I think probably Hong Kong would argue that that's actually what they do already. So, but that's more of a
even on the bankruptcy law, I think in the free trade zone there's discussion that whether there's international arbitration court could be set up. It's very clear in Shanghai, another offshore free trade zone in Shenzhen, and it's very clear that Hong Kong's court of arbitration will be utilized. On taxation issue, from our discussion with authorities in China, there's this foreign bank association. We talk to Chinese authorities from time to time. This is an issue being discussed, not only related to bond tax issue, Q fee. It also, Shanghai would like to build up its offshore exchange trading center in Shanghai Free Trade Zone. There, the withholding tax is an issue. We hope that in the not-so-distant future, this can be settled. International practice could be utilized for that.
We have time for one more over here, and then we'll need to wrap. But yes.
Virgil Mendoza from Standard Bank. Very quick question, actually. When you talked about 24% of trade, China's trade, being settled in RMB, I just wonder if the panel, one or two of the members, can give a bit more color on that. What makes up that 24%? Which 24%? Is it a cluster of countries around Asia? Is it a cluster of countries around Africa? Is it countries to which China exports or countries from which China imports? Or is it fairly broad-based with a particular regional pattern?
I can answer that question. At this moment, the trade settlement is mainly done with Hong Kong. We know Hong Kong is an international trading center. There's a direct trade between Hong Kong and China, and there are also re-export trades between Hong Kong and China. If you now look at direct trade between Hong Kong and China, 90% of that trade is in renminbi. Probably over 60% of Hong Kong's re-export trade has been done in renminbi as well. The issue is going forward, this kind of distribution need to become more even, right? The more countries could use renminbi as a trade invoicing currency. We do think that countries with a very complementary trade pattern with China could more easily adopt renminbi as a trade invoicing currency. As I mentioned, that we're now at the tipping point, and the next stage, if Chinese state-owned enterprises are willing to use renminbi to import resources, I think that will be a major a sea change for renminbi's international use as a trade invoicing currency?
I mean, generally, the rule of thumb is the further, if you drew concentric circles from China out, the further away, the less likely the redenomination will occur. So Hong Kong, obviously, the next ring would be kind of Taiwan and Southeast Asia, where there's a very high degree of redenomination, and then it sort of diminishes thereafter. Good growth vis-a-vis Europe, what we've seen in terms of trade settlement. The U.S. still very low. Obviously, the dollar is still king there. Africa is the place to watch. I mean, there's been a lot of talk about heavy involvement of Chinese companies in Africa, but the actual trade settlement volumes in RMB are still relatively low. So that'd be the area to really watch for future growth.
Great. Well, I think at that point we need to wrap up because we're out of time. But thank you very much for your attention and your questions. And thank the panel in particular for giving us a terrific overview and some really good detailed insights into just this. I think the good insight is that we really are now at a tipping point. Many conferences are talking about the next big thing, and a few years later, the next big thing. But I think we've heard a lot from the panelists today about how we really are now at an inflection point, and we can expect to see some really exciting developments in this market over the next few years. So please join me in thanking our panel. Thank you very much.
Quick word while the panel is leaving the stage. Now's the chance for you to decide what panel discussion you want to attend. These are all on level 1. There's coffee on the way. The breakout sessions are beginning in 15 minutes. Breakfast tomorrow between 8 till 9 on level 1, and we'll see you here at 9 o'clock.
Nyama na me use was alum morning in a scanner na. Oba kanu so na ma assign me the aba bia nka no so na aba kejuma.
I said, is there anything else that Barclays and Plan and Care can do to help you? And she said, no, you have given me my dignity back.
The key word in this is change. It's a different way of doing banking, but the other part of the change is the people who participate in this usually undergo some sort of profound change.
Our business is dependent on communities, and if we don't invest back in those communities, we won't be a sustainable business in the long run.
Since 2009, we've created 25,000 village savings groups across 11 countries. That's 500,000 people helped by the program, 80% of them women. They've saved $6.5 million, and already 600 groups have been linked to formal banking products. To deepen our impact and focus on our next generation, Barclays is committing another £10 million over the next 3 years.
This is the sort of thing that banking should be. Real people get real loans to do real things. You've done a great thing.
So, good afternoon, ladies and gentlemen. I'm Andreas Streichel. I have the honor of moderating a very distinguished group of people. Let me quickly introduce them to you. To my far left, Ksenia Yudayeva, First Deputy Governor of the Central Bank of Russia. Then Mateusz Szturek, Minister of Finance of Poland. And then Lucio Viñas de Souza, the Chief Economist of Moody's. And right next to me, the Governor of the Turkish Central Bank, Erdem Bashi. The intellectual capacity of the four is a very high one. All of them are astute academics with a long career in that. They also represent 3 countries that play a hugely important role on Central and Eastern Europe, and with that, a hugely important role on the development of Europe overall. That should give rise to an interesting discussion. The situation of the 3 countries is very, very different, and probably a very good reflection of the fact that one should actually stop talking about Central and Eastern Europe as a region, because the situation of the countries in that region is so different that same as not talking about Western Europe anymore, because the situation in Sweden is very different from the situation in Portugal. So is the difference between Poland and Hungary, for example, or the Czech Republic and Romania, or Russia and Turkey. I would like to ask all 3 of them the same question. I would like to start with the lady, and the question is, give me 3 reasons why people in this room or outside of this room should invest in Russia, and then give me just 1 reason why you should not invest in Russia. And those questions I would like to ask to Russia, to Turkey, and to Poland, and then get the opinion of Moody's on what they see the main challenges for these 3 so incredibly important countries are. So, Ksenia, may you start?
Well, thank you very much. First of all, I see many familiar faces in this audience. So I guess there are quite a few people here who've been investing to Russia for years, maybe because they were making large enough returns, and they still expect to make them. This is why they're here. If they were our investors, direct investors, then we would have spoke about different reasons. Russia has been until now, and I think it will still continue to be a country with good consumer demand. At the end of the day, in terms of the population, it's the largest country of the region, and it's quite wealthy as well. And it's a country with unexploited comparative advantages. I am always telling that Russia has 3 comparative advantages. Comparative advantage, well, of course, in oil and gas, natural resources, in agriculture, in mathematical intensive services. I know lots of I know some direct investment funds who invest in the 3rd area, right, and they're quite successful. We know lots of big names who invest in the consumer demand who are quite successful. So there are many reasons to invest in Russia. Well, it doesn't mean that Russia doesn't face any challenges for now. Actually, well, you just spoke about the region being very different, and each country is different. Well, that may be so, particularly because the Eastern Europe and Eastern and Central Europe are on a different trend, right? Eastern and Central Europe, they had significant problems in 2007 to 2008, and they are really getting out of the difficulties right now. So this is a rising region, although many emerging markets were in a fairly good shape at the time, and now they start facing more problems. And in Russia, as in many other emerging markets, we see the problem of both slow growth and low unemployment. So this is a significant structural challenge which we face, and it means that we have to do through different structural reforms to improve the situation. Since I represent the central bank, for us, of course, and the Central Bank of Russia is a mega regulator, right? So we regulate not only we are not only doing monetary policy, we are regulating and supervising the banks and the financial system at large. So for us, of course, there are two big challenges. First of them are decreasing inflation further. Russian inflation, well, we speak about Russia as a fairly high inflation country. Our inflation rate now is 7.6%, which is of course a lot. For a country like Great Britain, for Russia, it's actually a relatively low number, right? We spoke about twice as high numbers 10 years ago, several times as high numbers 20 years ago. Right, but still we need to put inflation under control, and we need to control inflation expectations in order to give space for long-term investment and long-term sort of vision of domestic business, domestic consumers, domestic investors. And on the other hand, we need to build its institutions which allow to collect domestic long savings and channel them into financing domestic economy. I don't think it is news for anybody in this room that Russia's, actually it's common to many other emerging markets as well, Russians tend to invest long-term into foreign currency or foreign assets, and we get long-term investments from abroad. I think that what we need to work on in the next few years is on creating an environment where Russians themselves will find it interesting and profitable to invest long-term in the domestic economy. I'll stop here to give the floor to others. Thank you.
Minister, please.
Three factors. Growth based on very solid foundations of productivity increase, which has been going on for quite some time and will continue to go on. Extremely low inflation with rates that could still be cut, unlike some other places in the world. And we're not talking about 7% inflation, but, well, unfortunately less than 1% in case of Poland. Overall macroeconomic balance. This is something that that has changed in the past 5 years, be it external balance with very little reliance on external savings. There is an increased labor participation rate, no credit booms to speak of, and fiscal deficit on the way below 3% next year. So these will be the three factors: growth, low inflation, and macroeconomic balance. Argument against investing, it's actually boring and very low yields, so it's not for everyone, but well, I wish, I mean, hopefully hopefully this obstacle for investing, or this this factor against, is going to stay with us for longer.
Okay. Turkey.
Thank you, Andreas. In the case of Turkey, we can cite number one positive factor as growth. So growth is nowadays based on very strong job creation. The participation to the labor market, to the job market is increasing, especially for women, by 1 percentage points per year. We have also a demographic window of opportunity. So therefore, we do not have any shortage of labor, and there is enough job creation to absorb that labor supply. So nowadays, it's labor-driven growth. TFP also contributes, capital also contributes, but these are less than they could be. So provided that there is progress regarding the external balance, I will talk about that as the last factor, to the extent that the investments are financed more by domestic savings, we can invest more so that capital may contribute more to production. To the extent that the research and development spending, all the human capital development reform agenda makes progress, we can have more TFP contribution to growth. So growth potential in Turkey is huge. So this year probably the growth is going to surprise to the upside. We still see the trend at 4% actually, unlike many market and IFI forecasts. And so far we do not see a very serious reason to bring it down, bring that forecast down from 4%, which is the same as the medium-term program forecast. The second good factor in Turkey is fiscal prudence. So on that, Turkey has been very successful in keeping the government budget deficit below 3% of GDP for many years. And the debt to GDP ratio, as you know, is on a falling trend. We will probably be close to 34%, and in the coming years, the projection is to bring it down to 30% of GDP. So those are very positive. Regarding inflation, we are in a disinflation process, and that's in fact good news that we are in a disinflation process. The minimum inflation of the last 44 years has been 6.2%. That's the minimum of the last 44 years, 2012. So due to the tapering announcement and then the second round of depreciation during the political developments in December and January, we had a quite sharp depreciation of the currency. Because of that, we had basically an increase in headline inflation as well as the core, close to 10% now, 9.7 to be precise for the headline. And the good news on the inflation front, that's my third item actually, is that inflation will start falling, starting from this month. And we have checked all the factors behind this inflation, all the factors, demand factors, the exchange rate related factors, and most importantly, the credit growth. Credit growth has good news, not only for inflation, but also for the external deficit, which will be my fourth factor that Mr. Chairman, you asked. So far, why did not we have a huge investment appetite on the portfolio side in Turkey since the last year's May, has been mainly the external deficit. So the frequently cited 5 countries have proven that actually, in fact, they are resilient 5, rather than fragile 5. But it was quite painful to prove that. And all in all, the main reason has been the external deficit. So the credit growth slowing down, especially on the consumer side, to below our reference rate of 15% is very good news, both for inflation and for external deficits. So both are going to improve pretty visibly starting from now. That will eliminate the fourth factor, not to invest in Turkey factor, probably soon, as we have this quite stable but below 15% consumer loan growth. Thank you very much.
Okay, thank you very much. That was the opening round, and I would like now to turn to Lucio to give his view on sort of the main challenges of the 3 countries, taking into account also the way Moody's looked at the 3 countries during the last 10 years. You recall 2004 when the first major wave of countries in Central and Eastern Europe joined the EU. Russia had a Baa3 rating. It's now rated at Baa1. Turkey was, I think, B1 and made, I think, the biggest advance forward, is now a Baa3 country. And Poland, already in 2004, when some of its neighbors were a BBB rated or even lower, was already an A2 rated country and has remained an A2 rated country. All 3 countries definitely have one advantage vis-a-vis the rest of Europe, that they experience substantially stronger growth. And what do you see are the real challenges of the three countries over the next 5 years?
You made my job very easy. You apparently know Moody's ratings better than I do. Now, good afternoon to all of you. I would like to start by saying that it is useful to think in regional terms. At the same time that one has to recognize the heterogeneity between, say, Central Eastern European countries, it helps on your analysis to try to understand what are the similarities between countries in particular regions of the world. For instance, we do tend to allocate Poland to what we call a CE region, not on the sense of the CE region as a whole, but of a particular subset of Eastern European countries which are members of the European Union. Not gratuitously do this because they do share certain features. This said, and the moderator made a remark about the fact that this year we had the anniversary of 10 years of accession to the European Union, we start by the fact, as we reflect in our own analysis, I don't have personal views here, I have the views of the company, that it's clear to us that the Central European countries, as we define them, Central European countries that are members of the European Union, clearly significantly benefited from accession to the Union. The implication for this in terms of growth of the set of countries, including growth of the Polish Republic, they are apparent when you look at the aggregates. Poland, as the moderator has indicated, has had a very stable investment rating. This must be put in comparison to the dynamics of other ratings in the European Union and in the euro area. When you look at this in those terms, the stability of the Polish rating actually is a reflection of the underlying robustness of the Polish growth history. Poland famously was the single country in the European Union which avoided recession back in 2010. Correct me if I'm wrong on the date. This is an indication of the underlying strong dynamics that you have in Poland. It is the largest of the economies that you have in Central Eastern Europe, member of the European Union, that enable it to withstand certain external shocks due to the strength and dynamics of its own domestic demand. Those are clear factors of robustness for Poland as a sovereign credit. If there is one dynamics that we do observe, which is shared by Poland with other Central Eastern European countries, members of the European Union, is the level of stock of public debt. When you look across the region comparing to the stock of debt pre-crisis and the current one, it increased significantly for all of those countries. It is still significantly below of what you have in terms of the average for the euro area. It is still significantly below what you have for the average of the rating brackets of most of those countries, but it still implies that the fiscal load that you have now, that must be carried by those countries, is considerably above what you had by 2007. This aside, we do recognize the underlying robustness of the economic story of Poland, and of course the underlying robustness of the Polish rating itself. Earlier in the year, we put an analysis in which we attempted to identify countries that would be more vulnerable to a change on the policy stance of the US Federal Reserve. The true global setting in terms of financial liquidity, the emitter of the true global currency that you have on Earth. Now, when we look at the rating of countries of the more specific sensitivity to this liquidity shock coming out of the United States, and we were not trying to do an exercise of fragile 4, fragile 20, fragile 55, we're trying to look at the potential vulnerability. The Turkish Republic came out in terms of our own analysis as the most vulnerable amongst the countries that were facing pressures coming out of US tapering. That comes out from the fact, as recognized by the governor himself, that Turkey has a very significant external deficit, albeit notably half of it actually is related to energy imports. And more than that, it has very significant rollover needs in terms of share of GDP compared to other countries in the emerging markets universe and also on your rating brackets. We have an indicator that we try to encapsulate those rollover needs. We call it the External Vulnerability Index, in which we benchmark your expected rollover needs for current year, 2014, with the T-1 availability of hard currency reserves in your central bank. And we turn this into a ratio. We do that because this enables us to have a cursory indicator of external vulnerability for a country that is comparable among all rated sovereigns. When we do this exercise, Turkey comes out as the most vulnerable of the countries in the emerging market universe, truly one of the most vulnerable. This is likely the most significant underlying vulnerability that you have on the sovereign credit of Turkey. It's very significant level of external vulnerability. Now, the Russian Federation. As most of you likely know, we currently have the Russian credit on review for a potential downgrade. This analysis is ongoing and is just a review. There is no decision which is implied by the process itself. That's why we have a process to start with. We did perform analysis on the implications of current stresses of the ongoing situation between the European Union, Russia, and Ukraine. And before starting how we frame the sort of a situation in terms of the Russia credit, our own analysis indicates that most of the countries of the European Union and the Euro area as an aggregate are actually rather robust to a set of credible shocks emanating from the current situation that we have in Ukraine. The way that we frame our analysis of the Russia credit is related to the following. Russia has an underlying growth dynamics which has been trending downwards very significantly in the past few years. You likely all remember the average growth rates that Russia had between 7 and 8% before the crisis, and the current ones which are below 2%. Our own forecast for the country actually is a contraction of -1% this year. Our perceptions of the Russia credit are conditioned by our understanding that the growth model of the Russian Federation has been clearly showing signs of exhaustion regardless of whatever additional stresses may come out of the current situation related to the European Union, Russia, and Ukraine. So the key question for us in the way that we evaluate the future performance of the Russia credit is not the current level of stresses, but the underlying perception that we have that Russia has a downward perspective of growth, that the trend growth rate of the Russian Federation has diminished quite significantly, and we have embased that with research that we published, and that has significant implications for the sustainability of the Russian economy going forward. Of course, when we evaluate the situation of this particular sovereign, we look at this one side of the equation, so the significant downward trend growth that you observe in Russia, to two other factors which are on the plus side. First, Russia Federation has one of the lowest levels of stock of debt amongst our rated universe. It's around below 15% as far as I recall. That means that the balance sheet of the Russian government, regardless of potential credible stresses, is very resilient to those potential shocks because the balance sheet of the Russian government is very clean. Allied to that, and contrary to the situation that you have in a sovereign like Turkey, Russia has a much more robust external position, not only linked to the fact that they have still surpluses in terms of the current account, they have very significant reserves in their monetary authority. We all know that Kizhenia takes a very careful look at all of those things, it takes very good care of those things. Now, the implication of that is that you have vulnerabilities in Russia which are not linked to the current situation, reflect the underlying downward trends of the Russian growth model, but this is something that we take in consideration, looking at the strengths of the sovereign, namely the very clean balance sheet and the very strong external position. So I will stop here for the time being.
Thanks a lot. Xenia, would you like to reply?
Shall I reply on, well, I actually didn't mention this. I think it goes for granted that indeed we have one of the lowest debt volume, which is a big problem for me because we have no instruments to do monetary policy, right? We have to invent and be very inventive, go into and accept all kind of assets when we conduct refinance operations, right? So this is one thing, and we have budget role. Our Ministry of Finance keep putting more and more money into the National Welfare Fund and Reserve Fund, so it keeps accumulating additional government reserves. This year we did an innovation. We actually started to buy to invest this money directly into foreign currency. It used to be the rule that the government would just put this money onto the central bank account, and central bank will do some kind of accounting and consider whether, and as long as this sum of government money on the ruble account is smaller than the overall reserves, then the central bank will not do anything specific about accumulating or disaccumulating some additional reserves. Right now, we are purchasing reserves directly with the government funds. You know, this is what we are doing for the moment. Every day, we actually buy $100 million to the National Wellbeing Fund, and we've been doing it for several months already. We will finish in the middle of June, as far as I remember. So this is one thing. The budget is indeed quite stable. What else on the macro side? As I said, our exchange rate depreciated almost as everywhere else. And we have some increase in the inflation rate, and as a central bank, we are very concerned with this situation. So we are tightened our monetary policy to stabilize the situation. We have this problem still with currency substitution. Because we used to be a high inflation country, and sometimes when people cite a big capital outflow from Russia, they actually do not understand that big chunk of it is just currency substitution by domestic agents. So in March, for obvious reason, we had spike in this currency substitution and purchases of foreign currency by domestic agents. So we had to intervene in order to preserve financial stability. It's gone now. Our capital outflow declined quite significantly in April and in May and in early June. So I think that when we speak about all kind of usual macro parameters, Russia is looking quite good. I think that we do have some structural challenges, which I tried to speak at the very beginning, and we need to come up with our structural policies which would allow to change the situation. And there is a problem which Russia faces. I think Poland may face it as well. I think that Turkey is a lucky one in this case, is demographics, of course. Demographics is one of the challenge for Russia, for Eastern Europe, and for the Western Europe. And I think that we all together will have to come up with some new structural changes, right, in order to find a way how to grow with this kind of demographics.
Thanks a lot. How many years until Moody's will give an A rating to Russia? How many years left?
I cannot comment on that.
Xenia, you have a guess? 2016 or 17?
Well, we don't even know what the ratings of the United States will be in 2016, so I wouldn't guess on that.
Okay. Adam, on Turkey.
Yes, I mean, we have nice type of problems. Our problems are like too much of a good thing type of problem. So credit growth is obviously one main driver. We have on consumer loans excessively rapid credit growth, and in our view, this has been the main driver of both the external deficit, low savings, and also the inflation. So basically, there were two rounds of measures, which we call macro-prudential measures, which were taken against extremely rapid credit growth. The first round has started by the start of quantitative easing 2 towards the end of 2010 with our reserve requirement use. We have stopped remunerating reserve requirements. We have hiked the reserve requirements quite significantly. We have bankers in the room, they know it very well. We had a lot of complaints regarding that, but that started a process. The process was quite healthy. By summer of 2011, Turkey has established the Financial Stability Committee, where all the 5 agencies responsible from financial stability come together and discuss macroprudential measures. The bank regulator, the securities regulator, the savings deposit insurance fund, the treasury, the central bank, we are all coordinating macroprudential policies. And there, the first round measures were increasing the intermediation cost of the banking sector in Turkey, so that the wedge between the deposit rates and the cost of credit would widen. But that is not extremely efficient, as you know. So the second round of measures, which were in effect in February this year, were directly targeting excessive consumer borrowing. Those were loan-to-income type of measures. And those turned out to be extremely effective. So if you look at the measures on credit cards, your credit card balance cannot exceed your 4 months' income. And if you want to increase your limit, you have to prove your income. So now there is a database which is forming in the banking sector. Everybody's income will be reported to the banking sector, which was something missing, which is a pity. So if you want prudential policies, you have to know your customer's income. So that's a good start. And there were restrictions on the number of installments. For consumer loans other than mortgages, you cannot exceed 36 months on credit. You cannot exceed 48 months for auto loans, and so on and so forth. So these turned out to be very effective. Now we immediately see the momentum, the pace of consumer loan growth coming down very significantly, very visibly. And that's why we are pretty optimistic actually regarding the correction on the external account as well as the disinflation process.
What would be, in your view, the most important single economic issue that could advance the rating of Turkey?
I mean, that's mainly the same thing. I mean, we have basically prudent fiscal policy. The thing that we need is prudent private sector behavior, I should say. But in a free economy, in a free market economy, how do you induce prudent behavior on behalf of consumers? Well, basically, some macroprudential policies could help, and that's what we are doing, basically.
Okay. So I will. Okay, sure.
Just one small point on monetary policy formulation in Turkey. 2 different questions. Turkey was caught up in the earlier part of the year in a series of emerging market-wide reactions to monetary policy tightening in the United States. Right? You can think of that as the country being part of the same adjustment process that almost all other types of emerging markets around the planet, which capital importers were facing. In the particular case of Turkey, there were arguably components related to the clarity of communication of certain types of policy decisions, including, I should point out, monetary ones, that led to a necessity for a size of action which was absent in other types of emerging markets. practical terms. If you look at the situation of another emerging market like the Federal Republic of Brazil, because the tightening of the Fed policy was perfectly forecastable, the guys started doing exchange interest rate adjustment as far back as in the beginning of the tempered trade truce a full year ago, right? Because you had a more heterodox set of monetary policy actions, right? You had arguably a menu of interest rates, and the market didn't fully realize the degree of the monetary policy tightening that you were already committing in the past few months. You had to do a very significant tightening in a single step, right? That led to the situation that you had with the exchange rate, right? Now, you of course changed your monetary policy communication ever since, but this arguably unclarity that you had until the earlier part of the year was part of the reason why you had certain types of pressures that other emerging markets didn't really face in that particular situation.
Do you want to give a quick answer to that?
Well, I mean, obviously, one should not forget the elevated domestic political uncertainty during the December and January period. Up to that point, Turkish performance was pretty good, actually. I mean, if you look at throughout the taper process, if you compare the 5 countries, the volatilities were lower, the performance was not too bad, and we had done the tightening by liquidity policy. You are right, we have hiked more than 300 basis points by liquidity policy, but we were able to communicate that. But you are also right. I mean, we are not following an extremely standard set of policies, but the proof of the pudding will be in eating. So the bottom line is you should see how the domestic savings are doing after all these measures, and that's improving.
Okay. Now, while I'm going to phrase my question to the Minister about Poland, after that question, we'll open up for the public. Please ask questions, no statements, and don't get too political, please, if possible. Poland seemed to have been doing everything right during the last 10, 15 years. If you think about the importance of those 3 countries that basically encompass the eastern part of Europe, these 3 countries alone have 250 million consumers, 250 million investors, with a huge influence on probably another 120 million in between. Because if Turkey, Russia, and Poland prosper, so will the Baltics, so will the other countries in this region. If you think about what Poland did during since its accession to the EU, it had no recession, has been doing almost everything well. The only risk that we sometimes have is what happens if they turn the other way around. Now, if I ask you now the question, when will you join the Eurozone, or will you join the banking union? We know what your answer will be. Give us a little background, a little pep, and will Poland join the banking union before it will have a AAA rating, or afterwards?
I told you about boring. You don't even ask me to respond to Moody's opinion about Poland. And maybe because...
But if you do, you can mention the situation concerning the changes in your pension framework.
Oh, I can do that, yes. For example, I mean, you mentioned the public debt to GDP growth in the past 5 or 6 years. Well, last time I looked, in 2014, according to the European Commission forecast, Poland has the 2nd lowest growth of public debt. And that was happening after a period of probably above average fiscal deficits, which is an interesting lesson probably to some of the countries in Europe also. But you and excluding the pension fund changes and excluding 2014, that's the third or fourth lowest, so it's not that much different. The euro, I mean, the beauty of the Polish economy, and it does not have to be that way, is the amount of flexibility that it has. And I mean, you always have to remember that it is a two-edged sword, and this flexibility can be mishandled. But not only it has its own currency and ability to benefit from it, so FX debt to GDP is quite small. It also is not overly dependent on one particular sector or one particular country it exports to. It has some freedom in terms of public debt to GDP, etc. So many of these things, excluding exchange rate and interest rates, of course, would stay in place within the Eurozone. So from that point of view, I would risk saying it is maybe less dangerous for Poland to join the Eurozone than, as a result, the risk of it getting stuck with, say, low inflation, the need to adjust wages, and inability to do so because of high debt is not there, because debt is quite low, productivity growth allows to substitute for exchange rate movements, and as a result it is safer, but I would, before taking this making this decision, I would still prefer public debt to be lower and budget deficit to be lower, to allow for more flexibility when something when a shock hits the Eurozone again and influences differently Poland and the rest of it. So this is one thing. On top of that, there is a question of the future of the Eurozone itself and where it's heading. And I think here the answer is could be quite similar to the answer about the question about the banking union. Poland does support the creation of the banking union, and I wish it all the best. Not only because there is so much foreign capital in the Polish banking system. So when bad things happen to the Eurozone banking systems, it is bad for Poland, as we saw in 2009. It's also because at some stage we will be a member of the Eurozone, and then we will be automatically a member of the banking union. So this is why it will matter directly to us. But we do have a comfort, and I would say we're not going to be afraid to use this to see how this works out, because we do have a working and well-capitalized bank deposit guarantee scheme with enough money in it to actually work, and in a sense there is something we will be giving in exchange for joining. So we want to make sure that it does work and does operate in Europe, and asset quality review will be one test to see that. And to some degree, the future of the Eurozone is also a test of this kind, because I frankly don't believe it's quite over yet. Yes, it is over in terms of the stability and mere existence of the Eurozone. You know, it's not going to collapse over the next weekend, and we did fear that 2 years ago. But there is still a question of countries stuck in low growth mode, very high unemployment, bordering with deflation, and these things are more difficult to resolve within the Eurozone. So it is still another test for the Eurozone that we would like to see resolved. And on top of that, the popular support for the euro adoption is the lowest ever. We still have some quite way to go towards Britain.
So no date for the banking union.
Oh no, don't expect that. We did it once in 2008. It was a mistaken attempt, I believe. But again, we're not Britain. We are in this. I mean, we do treat this eventuality of entering the eurozone seriously, and we're not going to analyze the costs and benefits with the set conclusion in the back of our minds. No, it's certainly not the case. It's just the game is not as easy as it seemed in 2004, when it was a sure way of being promoted from developing to developed market status. We're already there, so there's a bit less to gain.
Thanks very much. Questions from the audience, please. Sorry.
Piotr Bednarski, PwC. 3 questions to Minister Szczurek. First question, how you respond to the challenge mentioned by Governor Judajeva regarding demographics in Poland. We've got one of the worst in Europe, and this combines with the massive immigration of young people, for example, to this country, with unemployment levels in provinces pretty high in Poland. So what are the measures to be taken by the government in that area? Second one, what would be your recommended 3 major structural reforms which should be continued or started in Poland? Because we haven't yet done our lesson in Poland. So what would be your recommended structural reforms to be done in Poland? And
2 is enough. 2 is enough.
Okay, thank you.
Not too much time left. Okay.
Actually, demographics and the structural reform, I think the 2 things are related. I mean, in the past 5-6 years, the focus was on employment, and keeping employment in place was crucial. And the way, say, the special economic zones were being used, for example, employment creation in high unemployment areas that was a prime factor. That is going to change. It has to change. As the economy goes back towards the potential, and you have to start worrying about other things, including demographics. And so I'll take the 2 questions together. One problem I have with the current tax and social security contribution system is that it actively promotes a labor market duality. It did help probably during the slump because it created a very large group of people employed on temporary contracts, on non-standard contracts which did not provide job security. It deterred in-job training and long-term attachment for the firms, which was all right if you just needed the employment numbers, and we got that because labor market participation grew actually in the past 6 years by 4%. So we were beaten only by Germany in that time. But in the long run, it is not the way, because you're not going to get enough human capital. You're not going to become a knowledge-based economy and be able to compete in a higher wage level environment. And above all, it is bad for demography, essentially. I mean, you can build as many preschools as you like, but if you're on temporary contracts, you'll not be able to use them. And I think removing this perverse incentive for labor market duality is one significant challenge that we need. And it is a difficult switch because an obvious challenge to this would be, well, what about jobs? I mean, you will create great economy and be problematic for job creation, but it is necessary and will be easier with the economy going back to normal. Just one more thing about migration. I mean, since 2008, there are less people out of Poland than there are now. So the positive growth compared to the rest of Europe did help. So yes, they're above 2 million, but it's less than in 2008.
Gentleman in the back. That's the one problem you do not have, demographics.
Andrea Lecci, EMSO Partners. So I have a question on your monetary policy framework for
I don't understand
Governor.
you. I guess
Can you?
so.
Yeah, sorry. Yeah. Andrea Lecci, EMSO Partners. I have a question for Governor Bassi on your monetary policy framework. Do you feel that macroprudential measures are more effective than interest rates? A second short question is, does your growth forecast for the year factor in a looser monetary policy already? Or, hadn't you cut interest rates last month, your growth forecast would have been different? Thank you.
Okay, so monetary policy interest rates is basically a blunt instrument. It fills all the cracks. So you hike the rates, and across the board, you have the cost of credit, cost of deposit, the returns from deposits, you have everything affected at the same time. So it is effective. But in Turkey, we had lived through this experience. I remember during the previous governor's time, Governor Yilmaz's time, when he was appointed, a few months after he was appointed, he hiked the rates by a significant amount, 400 basis points plus 200 extra for liquidity tightening, 600 basis points. And then he kept the rates at 17% or so for more than a year. So at such high interest rates, where the inflation was hovering at single-digit levels. So at such real interest rates, credit growth, consumer loan credit growth especially, was still hovering above 25%, 30%, 35% were the rates. That shows that there's immense amount of appetite for loans on the consumer side, and they basically look at maturity. So if they find the maturity, they disregard the cost of credits, because this is the first time they see such availability, actually, of loans. So that's why macroprudential measures really help. I mean, when you restrict the maturity, when you impose loan-to-income type of restrictions, these are direct measures which shift only the demand for consumer loans, but keep the business loans demand intact. So such targeted measures may be more useful, especially for the external account problem and also the inflation problem, because you help the production, but you reduce the consumption demand. So in that sense, you'll have to wait and see. But the early indicators are that this second round of macroprudential measures are going to work in a relatively lower real interest rate environment. So on growth, we are hopeful that European recovery is going to continue, because that's what makes us different this year. We had the first round of macroprudential measures, and growth came down to slightly above 2%, and thereby we have reduced the current account deficit to around 6% of GDP. But this time, European demand is there. We directly track the PMIs in Europe. UK has very strong recovery, very strong PMIs. Our exports to Europe grow very fast. Likewise to Germany. Our exports to Germany grow very fast. So European recovery is much more important for our growth now, and our exports really is showing it. So that's how there will be compensation for slow domestic demand from external demand from Europe. So that's how we are going to approach 4% this year, actually, rather than lower growth rates.
Thank you very much. We have time for one more question. Possible, last one. Here. You get the.
Hello, Aaron Segir from Bloomberg. I'd like to ask a question to Governor Bassi. Your colleagues from the ECB cut 3 rates today. Basically, what do you think about the implications of the Turkish economy, and in general, what do you think? Our other guests can also answer this from an emerging markets point of view. What do you think that ECB rate cut affect Turkey?
Very short answer. Okay. We typically do not comment on other central banks' actions. decisions. But I can just make a conditional statement. To the extent that it will be helpful for European recovery, it will be good for Turkey.
Okay. Unfortunately, that was it. An hour is very short for three big countries and Moody's. We could have talked much longer. I want to thank my colleagues here very, very much for making it interesting. I want to thank the audience for not asking the you question. Thank you.
not starting yet, are we? Let's start now.
You want a minute?
Give me 2 seconds. Turn these off and I'm done.
Okay. Why don't we get started here? Session on East Asia. I can see we have somewhat fewer people than in the previous session on emerging Europe. I sort of see this as a worry meter. Clearly people are pretty worried about some countries in emerging Europe, but on the other hand, here we are in East Asia and things are looking good. Well, maybe not. It's an interesting time to be looking at East Asia. We certainly focus on what's going on there a lot in the IIF. We have a great panel here this afternoon for the discussion. On my immediate left, Stephen King, Group Chief Economist at HSBC, also author of When the Money Runs Out, published last year, which is one of the FT's books of the year. He's just completed his FT column on the ECB decision, so if we have time, we can discuss that. But I think we'll spend the bulk of our time on further east. He began his career at Her Majesty's Treasury, and you're still a member of the UK government Asia Task Force, I think. So following developments in Asia closely. Next, Haizhou Huang, who is Managing Director at CICC since 2007, previously Head of Greater China Research at Barclays. We were colleagues together some years ago at the IMF, and before that he taught at the Chinese University of Hong Kong and at the LSE, not so far away from here. And then on my far left, Takashi Oyama, who is now Counselor on Global Strategy to the President and Board of Directors of Norinchukin Bank since 2007. Previously worked at the Bank of Japan, where he headed the team on the global regulatory framework, as well as serving on the Basel Committee of Bank Supervisors. So I think we have a great group, and certainly there are some interesting issues. I think indeed this is a time of a lot of uncertainty in East Asia. East Asia has, for many years, been one of the dynamos of the global economy. First Japan, and then more recently China, achieving very, very rapid growth. More recently, though, transitions in both countries. Maybe we'll start with China. In China, clearly the leadership understand the need for transforming the growth model. They unveiled a very ambitious set of reforms back in November after the third plenum. However, there are also short-term strains in the economy. The first quarter of this year was quite weak by Chinese standards. Concerns about a housing market downturn, concerns about the rapid growth of credit, in particular through the shadow banking system, and excess capacity. So the policymakers have quite a difficult task of balancing the need for policies to achieve long-term transformation of the economy, but at the same time to keep the economy going, because I think there's concern that if the economy slows too much, then it will exacerbate the problems of excessive credit growth, excessive capacity. So quite an interesting set of dilemmas facing China. So Haizhou, please give us your perspective on what's going on and what do you expect for the future in China?
Thanks, Charles. Also, thanks for inviting me to participate in this panel discussion. China is at a very interesting crossroad. China, for the short run, certainly is facing many challenges. Some of the challenges Charles already talked about, how the policymakers can balance, for example, short-term growth with credit expansion and so on and so forth. I'm a market economist, so actually for the last few years, at least for the last 3 summers, every summer there is a worry about the China hard landing. I guess that this summer that's kind of worry could come back. I would be surprised if it would not come back. But China still, I think, hold there. Okay, that's where China is. So I think that China is a large country, a developing country, a country in transition, and also is a country that has access insurance. I will call it China probably is overinsured. I probably will go this 4 dimension very quickly. As a larger economy, basically that typically for economies we think that the gravity model would apply. With GDP per capita, at $6,000, $7,000, they actually the income gap from the East Coast to interior to the West is huge. East Coast, some people say that is probably China's Western Europe. China's Western Europe. Okay, of course it's not Western Europe, even Shanghai or Beijing. Interior part is, in terms of income gap, probably, is China's Eastern Europe. The West, well, very, very low development, maybe even worse than some African countries. So in a way that that suggests that, for the long run, if you look at the medium and long run, I think that gravity model would apply. Some of the old formula, including investment, will continue to play some role, going forward. It's not like an investment will continue, will collapse, and China doesn't need an investment. I think that's the first point. Secondly, I think that China is a developing country. China is exactly in the middle of urbanization. The urban population ratio is 50%, exactly in the middle. With China's fast growth, I would say quite a spectacular growth over the last 35 years or so, from 1978, China was able to increase its urban population from about 20% of total population to 50% population. Added 30% of urban population, and that's basically is about 500 million. Okay, slightly over 500 million people. Okay, we know that the industrialization and urbanization started in this country, the first country to have industrialization. For the UK, Stephen, of course, read a lot of history. For the UK, I think that for the whole process of industrialization and urbanization to be complete, UK took over 200 years. Many Western European countries took 150 to close to 200 years. US took a slightly shorter time, but 150 years. Japan much shorter, 100 years. How soon could China complete that process? Of course, this is, the later comers will always learn from pioneers, wisdom and the mistake. So that's why that, Western European countries, probably other Western countries can do it in, a slightly shorter time than the UK. I think that for China to complete the urbanization and the industrialization process, China would need an additional 30 to 40 years. If China would be able to achieve that, China took roughly about 70 years, from the beginning to the end of the process, which is marvelous, will be marvelous achievement. So I think that the growth potential is there and will be there, if China doesn't make a huge mistake for the next 30 years or so. My third point is I think that China is a transition economy. Transition from a central planner economy, from very strong government towards a market economy. Compared with many other developing countries, China's government is very strong. China's government implementation skill or capability probably is among the best. If the government make right policy and really want to implement. That's basically the 1990s reform of the banking system, state-owned enterprise led by Premier Zhu Rongji and others. I think that that kind of capability of implementation is still there. And as Charles mentioned, that China, just elect new leaders. President Xi and Prime Minister Li are very capable leaders. Okay, so I think that in terms of implementation, I think that's something we need to keep in mind. The first point on China, in terms of medium and long run, actually apply to short run. China is overinsured. A lot of people worry about the China's systemic risk. Some economists in my group, my peer group, compute a Lehman moment that, when the Lehman moment would apply to China, or the Minsk moment that would hurt China. I guess they probably would be very disappointed to wait for that moment, okay? The reason is that the country is so much overinsured, at least in 3 dimensions. Number one, Savings ratio is over 50% of GDP by the state, local governments, corporates, households. Okay? Well, I'm not saying that with the 50% of GDP of savings rate, you don't necessarily get into crisis, but it's much less likely. Secondly, I think the central bank is sitting on a huge amount of excess reserves. The amount of excess reserve ratio that the central bank apply to all the banks is 20%. Okay, actually, banks' lending ratio is less than 75%. Okay, if needed, PBOC can print money. At the current economic situation, I think that probably China or PBOC would not need to worry too much about inflation. PBOC sitting on close to $4 trillion reserves would not be so concerned about renminbi devaluation if you would print money. Okay. Third dimension, of course, is the close to $4 trillion reserves. That can be used in positive way to basically, if needed, to address the systemic risk. So I think that if you take into consideration of the over-insurance, I think that I'm not so much worried about the systemic risk. Okay, I do worry about in a way that as economists, whether they can successfully implement or how soon they can deliver reform dividends. The Prime Minister said that going forward, the key for China, of course, would be we need to deliver reform dividend to the economy. For that, I think that in short run, China has a number of critical issues that it need to address. One of the issues I think that Charles already mentioned, which is to what extent the credit growth will continue, or to what extent the slowing in credit growth will trigger risk in the banking system, in non-performing loan, and relate to other sectors. Secondly, of course, China has a certain excess capacity in certain industries, and I think that will need to be addressed. Thirdly, I think that the property market certainly the price stabilized, which probably is a good thing. I think that had the property price continue to rise, I think it would probably be more risky. But to what extent the dynamics of property price would be a concern or would be something good to the economy? I think there's something probably we need to wait and see. Personally, as an economist, I would not be surprised to see some kind of default coming up. But there are two kinds of defaults. One is a default basically triggers systemic risk, which is very bad default. Okay, that's like a Lehman moment. Okay. The second kind of default is that the default will not really trigger systemic risk. Say the Shibor rate stabilize, then basically that those kind of default will be isolated. And basically that's good. You really want to address the moral hazard problem in the system, so you can best address the moral hazard problem when the problem is isolated, not systematic, and would let authority to really handle this issue. I think that in light of the Shibor instance last year, June 1920s, I'll be very surprised to see the Shibor towards the end of this quarter, the end of June, would spike again. So with that, I would say that even if China would have some default, I think that probably would be a good thing. Really, that in a way that we will start to see, the flush of the system really started to take place. I stop here.
Okay. Maybe as a follow-up question, I think you're making the case that it would be possible to achieve a soft landing, plenty of cushions out there. On the other hand, when you start talking about defaults, people start getting nervous. And how can if you're an investor and you have money in the shadow banking system, how can you distinguish between an isolated event of default and a systemic event of default, particularly when there's not much clarity on what the approach the government is taking to deal with the broader set of problems in the shadow banking system, and particularly when you clearly have deeper economic problems related to excessive capacity in a number of sectors, and a major housing correction going along, which seems to have structural roots as much as cyclical roots. So there seems to be plenty of potential for people to get very worried if they start seeing defaults starting to be applied.
Should I answer now?
Sure, why don't you?
Okay. Yeah. I think those are very good questions. As I said that, it will always be hard for the market to form a view when the market see a default. Typically, the market would, for emerging market, the market could easily become panic when market see default. Charles mentioned the lack of transparency, or also probably lack of clarity from the market perspective. So for me, I think as I just indicate, I think I would watch the SHIBOR rate very closely, okay, which is basically the China's interbank market lending rate. If the interbank market lending rate would be stabilized despite the default, I think that I would not be so worried about the systemic risk in the banking system. I would not be so worried about the systemic risk in the financial system. Also, certainly as a market economy, I will keep an eye on that. So in a way that in that case, basically that the banks' lending activity, including the interbank market activity, will continue, and that's basically to me is the key parameter to distinguish good default from bad default.
Okay, thank you. Takashi, let's move to Japan. I think everyone would agree that Abenomics had a tremendous first year, very aggressive action by the Bank of Japan, leading to a real sea change in expectations, boom in stock prices, weakening the exchange rate, increasing consumer confidence, strong gain in the economy in the first year, some pickup in inflation too. So the traction was being achieved. But I think this year looks like it to be much more challenging. The general sales tax was increased 3 percentage points, needed to be done from a medium-term perspective, although some people question the timing. And then there's the issue about the third arrow of Abenomics, the reforms. Some disappointment, at least on the outside, at the pace at which the third arrow is being delivered. Clear recognition by the government of the need to push through reforms in a broad range of areas, but so far we haven't seen very concrete steps, although later this month I think the government is going to announce its revised growth strategy. This quarter is going to be negative after the general sales tax increase. Do you see the economy picking up strength in the second half of the year? Do you see continued progress towards achieving the inflation objective of 2%? Do you see the reform being delivered with greater conviction? And what's the Bank of Japan going to do? At what point are they going to have to step in and provide a little bit more juice to support the recovery? So many questions. I'm not sure how many of those you can answer in 5 minutes, but why don't you?
Yeah, thank you, Charles. Well, Abenomics, I think it's a new type of policy coordination between different policy authorities, central government and the central bank. But as you said, the structural reform requires another counterpart in policy coordination. It's industrial sector and the trade unions and so forth. So there will be more hurdles to put structural reform through in the coming months. But however, I think I must emphasize, I think Abenomics has achieved a great change in expectations. That is a sea change for Japan's society. I mean, beforehand, there was sort of over-pessimism in the society, but Abenomics turned it into a sort of confidence. And I would like to say business community has regained sort of animal spirits. That is the great achievement. And there are, of course, 3 arrows. And as you said, the scores may differ from 1 arrow to first to third. And there is almost common understanding. If you score the 3 arrows in a school test, the first arrow is given A, and the second arrow will be given a B. It's a flexible fiscal policy. And third arrow, structural reform, is given E. So that means A, B, E, Abenomics. And this is almost a joke, but it is, I think this reflects reality very well. And let me touch upon the monetary, bold monetary policy initiated by a new governor, Kuroda. And I think this is, he says it's a QQE, qualitative and quantitative easing, QQE. And this is not new, actually, in Japan. The similar policy measures were taken before he came in. But his a new element of Mr. Kuroda's policy measures is he very strongly commits to the changes in inflation expectation, and also he ensures, Kuroda put, so he says, if something happens, Bank of Japan is behind you, with you. And that is the message we didn't hear from the central bank in Japan before Mr. Kuroda came in. So Kuroda put works very well to sustain sort of a confidence in the business community and the markets. And a couple of things I would like to say about the deflationary spiral, how to get to deflationary spiral. I think Mr. Kuroda, the bank BOJ, has been successful in sort of stopping deflation. There are mainly two reasons I must emphasize. That is the exchange rate. The exchange rate of the yen appreciated in 2009, started to appreciate 2008 and 9. Despite weak economy and despite Japan's economy hit by external shocks. So there was no warranted reason to have a strong yen at that time. But Japan did not respond to this spillover effect from Europe and the US that suffered from financial crisis. And this created a new domestic deflationary spiral. Yen's appreciation creates deflation, and deflation comes to lower wages, and then lower wages ensure the higher value of yen. So it's sort of a vicious cycle between the yen's appreciation and deflation. And second thing I must emphasize is Japan underestimated the downward flexibility of wages. And this flexibility was very strongly supported by changes in demography. I mean, old age people who earned high wages retired, and new younger generations come in with a lower income. So this ensured the downward flexibility of wages. And this augmented sort of a downward spiral of a price-wage deflation spiral. I think these two phenomena should be shared by other parts of the world who may be on the verge of a deflation. For example, Europe. If you have a flexibility downward flexibility in the wages, and if you have a higher value of currency, these two combined may create a new cycle of deflation. But the new bold monetary policy in Japan stopped this cycle, and this is a very good phenomenon. However, the question lies in whether Japan can create inflation. Inflation can be sustainable only if the wages increase above productivity growth. And if you look at the manufacturing sector in Japan, they are export-oriented. They are always aware of the competitiveness. And most of the companies, large companies in Japan, committed, very strongly committed to a wage increases. That is, the wage increases should be contained within the productivity growth. So how can we ignite inflation in the manufacturing sector? It's almost impossible. So what we expect, inflation and wage increases in the services sector, non-manufacturing sector, of course. So good sign is that non-regular employees, the wages of the non-regular employees are now increasing, on the increase, because of the narrowing GDP gap. That this is a very good sign. However, the composition of labor force in the services sector is also changing from older people to younger people. So the total wage bill are decreasing, unfortunately. So it's very hard to find inflationary mechanism between wages and inflation. So this is a weak point that we must be aware of that. And second, how many?
Maybe one minute more. I want to get Stephen into the conversation, and then we'll come back and you'll have plenty of more opportunities.
So coming to structural reform.
Okay.
Just one word. We are waiting for the new package this month, but we should not have excessive expectations on the content. Maybe the content of package will be limited to some measures about the labor market reform and measures to induce a sort of risk capital. For example, more utilization of a government pension fund and some measures to decrease corporate income tax if it is supported by increase in other tax revenues. But let me stop here. Okay. Thank you.
Thanks very much. Well, Stephen, I'd like you to comment on both China and Japan. You're a long-time watcher of East Asia. I know there was a comment this morning that Europe is becoming the new Japan. I wonder, is there a risk that China may become like Japan too if it doesn't follow the right path? And and how do you see the prospects that Japan may stop being Japan and may return to a more dynamic sense, or will Abenomics peter out if the reform agenda is not more aggressive? And I know Takashi wasn't very optimistic on that front.
Well, let me kick off with a couple of anecdotal stories. The first one is that I was in Tokyo in March of this year, and I spoke to a couple of Japanese pension fund managers who I'd spoken to a year ago. And a year ago, they had assured me that Abenomics really was the big story, that Japan was being transformed. This was the big moment that Japanese investors had been waiting for. And I have to admit, I was somewhat skeptical of this story. I saw them again March of this year, having spoken to them last year, and I asked them, are you still just as optimistic about Abenomics? And they said, no. They changed their minds. And I think one of the reasons for this goes back to the comments about wages. And it's a problem that exists in Japan, which I think we've already seen over the last 3 or 4 years in the UK, which is that QE has some quite weird effects on the economy. It clearly makes those who own financial assets quite a lot better off. That's a pretty obvious point. Secondly, it tends to lower the exchange rate, which might make exporters more competitive, although interestingly in Japan's case so far, that hasn't really worked out terribly well. But also the fall in the currency tends to push up import prices, raises headline inflation. But of course, if there's no wage response to that, you just end up squeezing real household incomes. And I think to an extent, partly because of this change in the age structure of the Japanese working population, there's been precisely that kind of squeeze coming through. So for all we talk about QE lifting domestic demand, actually it hasn't worked quite as well as people had originally hoped for last year. So I think that's the first issue I'd mention. On the third arrow in Japan, you think back over your economics career, and there's always a few embarrassing things that you've done. Actually, in my case, quite a lot of embarrassing things, I suspect. But I read the paper when I used to cover Japan back in, I think it was 1992, and the paper was based on structural reform on the so-called third arrow, and it was called Why Japan Will Keep Growing. And I wanted to argue that Japan could carry on growing at 3 or 4% a year. As I say, one of the more embarrassing things that I've done over the last few years. But my argument was that there really was the capacity for structural reform, and one thing I was focusing on was the opportunities for women in the workforce. And certainly the numbers back in the early 1990s suggested you get more women in the workforce doing more productive jobs than they had been doing in the past. There could be a very significant gain in overall labour force productivity. But unfortunately, over the last 20 years or so, that hasn't really quite materialized in the way that perhaps the opportunity suggested it might do. So these are areas where I think Japan's had the possibility of doing something, but hasn't necessarily actually achieved it. So my concern really is that I think, going back to the ABE comparison, I think QE certainly has been done. It's been very effective in lifting headline inflation. But I'm not sure if QE alone can really transform the Japanese economy. I'm not sure you can really explain 20 years of growth averaging about 1% a year purely as a consequence of a failure to deliver macroeconomic stimulus. And I think there are too many economists who think it's just a story about macroeconomic stimulus. I don't think it is. I think there's a much deeper story out there which I think takes much longer to resolve than we've seen so far with Abenomics. On China, there are a couple of things that do bother me about China. And I think it's fair to say, first of all, that I share your long-term view. I think that for all we talk about China collapsing or it's going to, every summer it's going to collapse, I think that's too pessimistic. And I also agree, I think that the opportunity for the government, for the authorities to bail people out if they have to, are much greater, probably politically easier to do than was the case in the US. So the idea that someone in the Chinese authorities would do the equivalent of Hank Paulson getting on bended knee to Nancy Pelosi asking for money, that's not going to happen in China's case. It's much easier to provide bailouts if they're required. But having said that, there are some issues that concern me, one of which I think is a kind of potential conflict between the aims of macroeconomic policy and the aims of microeconomic policy. Microeconomic policy aiming at structural reform of one sort or another, trying to get markets to work better, trying to get rid of certain levels of corruption, et cetera, which is all absolutely fine. But the experience of these kinds of structural reforms in countries in the past is that often in the very short term, they are quite negative for growth. They tend to hold back growth in the short term because you create both winners and losers. The losers resist the process, and that creates uncertainty, which eats away at growth. But if at the same time, on the macroeconomic side, there's an ambition to have growth of more than 7%, which is the common story we tend to hear, then the danger is that if the micro reforms drag you down below 7%, and the only way you can achieve 7% is to have more credit stimulus, then you end up in the macro story going in exactly the opposite direction from what you want to do at the micro level. I think that creates a potential tension in the years ahead. I think also, whereas it's easy from a supply side point of view to suggest that China can do lots and lots of catching up, from a demand side point of view, I think it's not quite as straightforward. And I'm thinking here about the pre-crisis world in China compared with the post-crisis world in China. Pre-crisis, China had a classic sort of mercantilist view of the world, and one way to express that is that China was seeing export growth year by year between 20 and 30%. I mean, staggering numbers, absolutely staggering. Since the onset of the global financial crisis, Chinese export growth has averaged between 5 and 10% a year. That clearly provides a considerable headwind, but wasn't there in earlier years. To deal with that headwind, to stop growth from really falling off a cliff, there was this tremendous move towards infrastructure investment, investment stimulus of one sort or another. But we know that the marginal returns on that are questionable at this stage. And what China hasn't yet achieved from a demand side point of view, I think, is two things. That the first is this move towards ultimately a more consumer-led society, and that may take a number of years, possibly even decades to come through. There's some uncertainties there. And the second is something we wrote about at HSBC 2 or 3 years ago, is the fact that China, I think, might lead the way in creating new trade linkages around the world, what I like to call the Southern Silk Road, so-called South-South trade linkages. And I think what matters here is not so much China investing domestically in infrastructure, or indeed China investing in, say, treasury bills, but rather China investing in infrastructure in other parts of, in particular, the emerging world. This means investing in ports and airports and railways and bridges and so on in Africa, in Latin America and so on. My guess is that if that happens, there is a reasonable chance that China's export story can be kind of rekindled, not so much to the US, not so much to Europe, by creating this new, almost like a third trade revolution going through into the first half of the 21st century. And that, I think, will be enormously helpful for China. But without that, and without the consumer, I think there is a kind of potential mismatch between the demand side and the supply side. One final issue for me on China is that you talked about this tremendous economic progress over the last few decades, and it is absolutely staggering. One way you can look at this is to say that back in 1980, per capita incomes in China were the equivalent of those in the US in around about 1790. And per capita incomes in China by 2010 were the equivalent of those in the US in around about 1930, 1940. So that's effectively saying that China is delivering every 10 years what it took the US every 50 years to achieve. So it's really quite an extraordinary story. But I think there is a political dimension here. And you cited the issue of the UK and how the UK changed in the 19th century with extraordinary industrial advances. But there are also significant political changes as well. At the beginning of the 19th century, a tiny handful of people had the vote. They were all men, they were all landowners. So although we think of the UK having a long history of democracy, at the beginning of the 19th century, there really wasn't much of a democracy at all. As a consequence of industrialization, there were significant changes. By the end of the 19th century, you had about 7 or 8 million people to vote. And by the 1920s, you had 14, 15 million, thanks to the vote going to women. I'm not suggesting that China has to go down that democratic path, but I do think there's an interesting question as to how China copes with a bigger and bigger, more educated middle class that may want to have choices associated not just with consumption and, particularly sort of visible consumption, but also choices in terms of how they engage with the rest of the world, what that means for opening up of capital markets and so on. I think that does create some interesting political questions for the years ahead.
Thanks, Stephen. Plenty of food for thought there. I know, Haijo, do you want to come back on the comments on China and then Takashi on Japan? And then I'll open it up to the floor.
Okay. I think Stephen certainly raised a lot of interesting questions about China. Let me try to provide comments on your 3 set of questions about China. Your first set of questions about China is you're worried about the conflict between macro and micro. Well, I think certainly as economists, we all worry about that. I think that I want to share with you some numbers so that hopefully would provide some comfort, even not fully satisfactory answer to that question. If we go back to the pre-crisis time, to 2007, China's current account surplus was 10.1% of GDP. You go back to last year, that current account surplus shrink so much to 2% of GDP. There were a lot of worries, discussions in Washington, IMF, IIF, in London, G20, other forums about, rebalance. Actually, in that dimension, China has been rebalanced very fast.
So can I just interrupt you there?
Yeah.
On the basis that what may be slightly worrying about that is that countries that rebalance extremely quickly can sometimes end up with tremendous domestic misallocations of capital. Because bear in mind that Japan did something similar in the late 1980s. It didn't end very well.
Yeah, I know. Let me go. That certainly is another point I want to discuss. Back to 2007, China's trade surplus was 7.6% of GDP. And last year, it's down to below 3%. Back in 2007, China's net export contribution to GDP growth, 2.6%. Last year, minus 0.3%. Okay, so in a way, to some extent, exactly, Stephen, you're right. This is like everything, rebalances itself too quickly. China's GDP growth rate came down from over 10%, over 11% to about 7%. All which is 3% decline came from exactly from the trade, from the export sector or export-related sector. So I think that's certainly that's the first point I will make. Whether that's too quick or not, I think again we will need to assess other growth engines in China. One, you mentioned fixed asset investment. To some extent, the government provide stimulus package in 2008, 2009. And that supported the investment growth, but the investment growth also came down from year on year. The peak was 50%, and now basically, 22%, and moving towards a single 10%, 15% or so. Another very important, growth supported China's growth, over the last few years, of course, consumption. Consumption growth over that cost did not really come down. If anything, consumption growth continued to inch up a little. Okay, not So basically, that in a way, the rebalance took place much faster than many economies had been thinking, myself included. Okay, I think that whether this is too quick, I think that this is really hinging on this very important question you raised, which is the conflict between micro and macro. In a way that, yes, over the course of this rapid rebalance, you create actually better incentive for consumption. Okay, then basically credit allocation associated with consumption instead of going all the way to export to finance investment. That's basically that. Then basically you think that is moving towards a better economy. So I think to some extent China still has a cushion to address that, macro and macro, and that's why that I believe that the government want to maintain a certain floor of growth level, say 7.5% or so that the two relationships would become too complicated or impossible or to address, or one will corner the other. Okay, I think that's my first point. Second point on this supply side reform was the demand side reform. I think that China will come a long way to focus on the supply side reform. That someone coined this word called economics. It's Abenomics, that's the new Prime Minister economics. I believe that the new Prime Minister's economics focus very much on the supply side. Reaganomics or such-economics, okay? So basically, that basically has been a key for China's success over the last 30 years or so. I share your view. Going forward, the demand will be very, very important, okay? And for that kind of demand, I think that there's a external demand through China's investing in infrastructure in Africa, Latin America, in Asia would probably play a very, very important role. I also share with you. There are two initiatives, of course, in that front, as you know. One is this idea of the BRIC banks, okay, which is BRIC country, 5 countries formed together, focus on investment, okay, in particular on infrastructure. Second is this new initiative called Asia Infrastructure Investment Bank, okay, AIIB. I think that is also actively under preparation. And the Chinese Prime Minister already announced it in March in Boao conference, and we would expect in the market, from market perspective, the President Xi will sign, important MOU with relevant, partners in the November APEC summit. If those would be implemented successfully, in particular, if the paid-in capital would be bigger than Asian Development Bank, that could generate a huge amount of demand through infrastructure investments. That's good for China. It's good for the world, indeed. I think that could also address it on the demand side issue. Your third point is related to, I think, on political change. Okay, I'm an economist. I'm not a political science, but let me make one quick comment in that front. China, even to today, has always been, one country, two systems. It's not like China, Hong Kong. Within China's 102 system, or at least we can call it 100 two citizens, two citizenship. That the rural residents don't really enjoy the same kind of right. Even they vote on paper would have the same right. They do not get much of a pension. They don't have the same kind of education privilege, or they don't have the same kind of Medicare. Even China's total Medicare expenses is a bit low. You know that's why that in the opening remarks, Charles gave in the third plenary session, the new government focused very much on this, unifying the two systems to give the more rights, more privilege to the farmers or the 50% population who live in the countryside, and if China will continue to do that, I think that would have equivalent, if not a more profound impact than whatever we saw in Britain in the 19th century. The political change is there.
Let me just keep going, because otherwise we're not going to have time for questions. And you'll have a chance to come back. But Takashi, any responses on Japan to what Stephen was saying earlier?
Well, yes, I agree with what Steve said. However, current administration has a very powerful political ground, and it has committed to execution of reform. And without this opportunity, Japan would not be able to do anything. So I believe some progress will be made, although if you have great expectations, you will be disappointed, but things will move. For example, structural reform, facilitating more female workers' participation, that will be definitely important part of agenda for the coming new proposal, and that will have a very sustained and growing effect on the whole economy. So don't underestimate the individual small items. Structural reforms are not a big policy. It's a policy. It's a combination of individual measures.
Okay, thanks so much. Let me go for a couple of questions from the audience and then come back to the panelists. Go ahead.
Thank you. I want to ask a question on the external influences. I'm not arguing with the ECB decision for today, but what is the effect of the election and possible changes after the election in India, especially on China, but possibly also on Japan? How do you see this situation?
Interesting new dimension there. Next, another question? Back there? The back.
Hello. Yes, on this alternative of carrying out infrastructure development works outside China, I'm from Latin America, Brazil. I cannot visualize all these works in Africa have been done with Chinese labor. The same in the USA in the 19th century. I just cannot visualize those works being carried out by Chinese labor in Latin America. That would be politically impossible. What would you have to say about that?
One more question? Yeah?
I'm really thinking more in terms of the influence of China on the rest of the world. I'm glad the issue of history came up and how long it took the US and the UK to develop. But I can't think of an analogy where we've had the world's second largest economy that far away on a relative basis in terms of development from the rest of the world. i.e., when Japan was the world's second largest economy, it was pretty cutting edge in terms of property rights, development of the legal system, etc. But now we have a situation which is a bit unusual. It could be a concern that may be misguided, but I'm wondering if that's really what makes the rest of the world really worry, rather than the ability of the Chinese policymakers to manage any potential hiccups.
Okay, thanks very much. I'm going to come back to the panelists. We have like 10 minutes left. Stephen, why don't you answer any of those questions you'd like to? I know you had a question to follow up on what Haijo was saying earlier. So,
well, let me deal with the question from the gentleman over there, which is that this is a shameless piece of advertising. You mentioned my last book, but the previous book was called Losing Control, The Emerging Threats to Western Prosperity. And the point of the book was precisely to talk about this issue of how the West would cope with the rise of China, the rise of India, and on the odd sort of result that these are countries which were absolutely enormous, but which were still relatively poor and had rather, in China's case, different political systems from what is the case in the West. And I would argue that a lot of the themes that we see in the West today are partly connected with the rise of China, where I think globalization was actually, in many ways, poorly understood. So people thought of globalization primarily as a story whereby capital is more efficiently allocated, therefore the overall cake is bigger, and in theory everyone can have a bigger slice of cake. But actually there are enormous distributional consequences of the rise of China, which I don't think were properly understood, which have a big impact on relative prices. So let's think of an obvious one, commodity prices, oil prices. Why are they so incredibly high compared with the forecasts of 15, 20 years ago? Largely because the bias in terms of global growth has shifted away from the States and Europe towards China, and China happens to have a relatively low per capita income level, and countries which have those low per capita income levels tend to have a very high proportionate demand for raw materials. So one consequence of China's success is that raw materials prices are much higher than would otherwise be the case, which is a distributional effect away from commodity consuming nations towards commodity producing nations. So effectively Europe, the US lose out, until recently perhaps with shale, and commodity producing nations potentially gained. Second big impact is capital moving around the world, changing the relative bargaining position of labor in different parts of the world. So one consequence is that Chinese labor rates, wage rates rise very, very quickly. At the same time, the bargaining position of workers in the US and Europe goes down quite significantly. I think what we're beginning to discover is that there are certain paradoxes associated with this new version of globalization. And one of those paradoxes is the fact that income inequality seems to narrow between nations because of the catch-up that we're seeing in China and elsewhere, but at the same time tends to widen within nations because of that mobility of capital. The thing I would note, though, is that in describing China being poor but big, it actually isn't quite so unusual from a historical sense. If you go back to 1850, which is not so long ago, China was the biggest economy in the world. It just happened to be also one of the poorest economies in the world because it just happened to have a very, very large population. But the difference between 1850 and 2014 is, of course, that the world wasn't quite so integrated. And where it was integrated primarily through force, through imperialism, rather than through the voluntary exchange of goods and services and labor across borders. On the India question, very, very briefly, and we'll have to see what happens in terms of whether Modi is really a significantly pro-business person, but there is a huge missing opportunity currently between India and China, which is that the volume of trade bilaterally between those two countries is remarkably low, given the size of their respective economies. I just wonder whether that might be something that could change in the years ahead.
Thank you. Haijo?
Okay. I think that on India, I would certainly there was a session on India, so you probably understand from that session far better than my comments on India. But I just want to make one comment on India. I think that India is also one of the largest developing country, like China. As Stephen pointed out, that I think that there should be more room for two countries to increase trade. But also I believe that the two countries, in a way that locked into a certain competition, friendly competition in a good way. China started its opening up reform in 1978. India's big reform package was pushed out by the government almost 10 years later. To some extent, there is a little relationship between India's reform. Maybe China played some role to trigger that. I hope that if India can do very well, India certainly would give a lot of pressure to China to push for successful reform in a good way. So I think that's about India. On the infrastructure investment, of course, that there was a comment about whether Latin America would like to see investment from China to Latin America for the infrastructure investment. Of course, this is a market economy. Okay, I'm not basically that if Latin America need infrastructure investment, China has the supply. Maybe there is a price. Maybe there are terms that they can work together. The two institutions I mentioned about. Okay, one of course is BRIC Bank. Okay, it's China, India, Brazil, Russia, and South Africa. It's a multinational organization. It's not just China going there alone. The AIIB initiative follows the same logic. I think that my company, my chairman, is taking is tasked to lead the proposition on Chinese side. He's traveled to UK a number of times. Try to invite UK to be a shareholder, even for the Asia Infrastructure Investment Bank, France, US. Of course, Japan will be there. Yeah. So I think that it's a multinational effort to basically to help countries that need infrastructure investment to get the money, get the infrastructure done. So I think that's a good thing for the really a good economy. From a historical perspective, I think that certainly that there is a lot of room for China to continue to grow. Part of that, of course, is mean reversion in terms of historical mean, and also in terms of the mean reversion on GDP per capita. There is no way for China to catch up. And to me, I think that if China would focus on the supply side, okay, get policy right, and there is no room for China, for many years, 3 decades or even more, for China continue to enjoy high growth. Not going back to 10%, but 7%, I think that probably can be sustainable for a number of years. 7% and above.
Thanks, Haijo. Takashi, you have the last word.
India, yes. I think there are many Japanese companies that try to get into Indian markets, but they found difficulties in terms of legal certainties and sustainability, continuity of inward investment policies in India. But a new government seems to be very promising for incoming investments. So I think this will unleash sort of potential investment opportunities from Japanese companies and other parts of the world. So this will contribute to a more growth in Asia.
Excellent. Thanks so much. We've run out of time. I know some of our panelists have planes to catch, so we'll have to end here. But it's been a very rich discussion. Thanks so much to our panelists. Thanks to all the audience. And clearly a lot is going to be happening in these countries in the years ahead, so we'll be continuing to follow very closely. Thanks very much indeed.
Yeah, you're right.
So we were waiting for some of the other panels to complete before we started. It's wonderful to be with you today. I'm Mary Ellen Iskandarian, President and CEO of Women's World Banking, and I'm just thrilled that the IIF has included financial inclusion amongst the topics to discuss today, and they've managed to attract a really tremendous panel of speakers. During the session today, I'm hoping we'll have a chance to look at a bunch of different perspectives on this subject, as well as some of the obstacles and the successes that our panelists have faced as they have tried to reach out to the 2.5 billion people around the world who have no access to financial services. So joining me today are, to my immediate left, Ms. Audrey Matupe, the Chief Executive Officer of Systemic Logic Group. And that's a global research and consulting company that works with a large number of financial institutions in South Africa. Audrey has experience in banking, insurance, group strategy, HR, and corporate affairs, and she was previously the Director of Inclusive Banking at Standard Bank and has some tremendous case study work to share with us about the time that she was at Standard Bank. To Audrey's left is Dr. Manuel Rybak, the Global Head of Corporate Citizenship and Foundations at Credit Suisse. He also has responsibility as the Head of International Relations and the Credit Suisse Research Institute. And then to Dr. Rybak's left, we have Mr. Dennis White, the President and CEO of the MetLife Foundation, which in the last year has announced a new commitment to financial inclusion in September of last year. And they're devoting a significant amount of resources to bringing vital financial knowledge, tools, and support to underserved communities around the world. But maybe I can start with just a few words about Women's World Banking and our perspective on financial inclusion. We are the global nonprofit that's dedicated to bringing financial tools, resources, education to low-income women and girls around the world. And we do that primarily through working with a network of microfinance institutions and mainstream commercial banks in 30 countries in the developing world. And we really see financial inclusion, you know, when we're talking about numbers like 2.5 billion people, over 1 billion of those as women, we're not really talking about a development objective anymore. We're talking about a tremendous market opportunity that I think the institutions represented on this panel will have a lot to say about. Because when we think about development, no country ever has been able to eradicate poverty without significant economic growth. And economic growth is impossible without access to finance and without a broad base of a country's population having access to the formal financial system. And so removing some of the structural and infrastructure barriers to the formal financial sector becomes really one of the principal growth objectives. We've started to see some amazing data linking access to the formal financial system and economic growth. In Africa, between 2004 and 2012, depositors per 1,000 adults increased by nearly 4-fold. At the same time, you had a 40% growth in real GDP. You had very similar numbers in the Asia-Pacific region. Depositors per 1,000 adults doubled over that same period, and you saw real GDP per capita simultaneously increasing by more than 70%. So the argument for increasing access is a business argument, it's an economic development argument, and there is also a fairness argument, and this is where the particular inequality for women comes into the picture. So globally, 47% of women are banked versus 55% of men. In developing countries, women are 20% less likely than men to be banked. And in the populations that I'm particularly focused on, those that are living on $2 a day and less, there's a 28% gap in the access to a formal banking account. But we've also seen other very, very powerful stories on the growth front. Goldman Sachs, just about on International Women's Day in March, published a research report called Giving Credit Where It's Due. And they did some really fantastic projected research that if the access gap just for credit alone, between men and women were closed by 2020, you would see income per capita on average increase by 12%, higher than what it's now projected to be in the BRIC countries and 11 other emerging markets. And these have all tended to be markets whose growth trajectory has disappointed a bit, has not been at the pace that we'd hoped and expected. And so closing the gap with women could really make the difference in the growth story for those countries. So I'd love to open the floor to our panelists and start with Manny. Credit Suisse has been one of the leaders in microfinance and the area of financial inclusion. I was honored to be at the 10th anniversary of Credit Suisse's involvement in the financial inclusion space, and that was 2 years ago. So I'd love to hear from you, a really pioneering institution in this space. Why did you choose this area? And now that you've had such a long period of experience, what were your objectives? What have been your successes against those objectives? And what are some of the obstacles that you've faced?
Great. Thank you very much, Mary Ellen. And let me maybe start by thanking the IIF for putting this important topic, financial inclusion, on the agenda. I know it's not a topic that traditionally the IIF focuses on, and thank you for your interest in this panel. Now, generally speaking, Credit Suisse, when we're trying to contribute, we aim to contribute to inclusive economic growth and social development in the regions that we're active in. And of course, access to financial services, access to capital is in a way the very basis of economic activity, of entrepreneurship, of prosperity. And microfinance, in turn, is obviously one of the most effective drivers of driving inclusive growth, or more specifically, of improving access to financial services. So in that sense, it's quite logical for a bank to be involved in this space from a CSR point of view. I stress this. I mean, there is a CSR component to this, clearly. But also there is a strong business component to this, as Mary Ellen has also mentioned. But maybe we can start with the CSR component first. Credit Suisse, we have defined 3 themes, or more specifically 2 themes and a tool in our corporate citizenship strategy. Microfinance, or more specifically microfinance capacity building, being the first, global education the second, and then the tool is more like employee engagement, in particular via skill-based volunteering, expertise sharing. So that's sort of the overarching corporate citizenship framework in which financial inclusion via our microfinance capacity building initiative that I'm going to talk about a bit more plays a crucial role in. The business link is also evident. We are active in private banking, wealth management, and we see increasing interest in the investor space in impact investment. We've been, as Mary Ellen kindly alluded to, been pretty active in this space already since over 10 years. 10 years ago, we were one of the co-founders of Responsibility, all small scale, capital A, a Zurich-based social investment firm, now one of the global leaders, dare I say it. They're offering microfinance, refinancing funds, and other impact investment products. So there's a clear opportunity for a bank with a private client base to sort of link the, as we like to call it, the bottom of the economic pyramid with the top of the pyramid. via impact investment and via the refinancing of microfinance institutions, which then in turn extend credit, and that leads to more financial inclusion. But we also see a business case in the institutional side, in investment banking. We were the investment bank that was fortunate enough to bring the first ever microfinance institution public. We did the IPO of Compartamos in Mexico in 2007. So there's business opportunities in that as well. So what we like to think of our involvement is that it's pretty holistic, pretty comprehensive. So there's a business rationale behind this, impact investment, institutional, but there's also a capacity building, corporate social responsibility component to this. I don't know whether I should go into the details of our program already, or whether we should leave that for a second round. Or
no, why don't we have Dennis tell us a little bit
Sure.
why the MetLife Foundation made such an important strategic shift last year, and then we'll bring us around for another set of questions. Dennis, tell us why this shift.
Sure, thank you, and thanks for having us here today. It's great to talk about our work and the impact that we're having. So, just briefly, MetLife and MetLife Foundation for many years had a traditional corporate citizenship, corporate giving activity, and we did a lot of different things across the arts, culture, economic development, affordable housing, health, education. And it was great work. It was impactful work. We started making, impact investments years ago to support our affordable housing activities. But as MetLife changed recently, becoming a much more global entity, we started to look at our corporate citizenship activities and wanted to go through a really thorough strategic review to see what we were doing, to see where we're doing it, and how we could be more impactful, and really how we could focus more. I think, with a very broad-based program, you're doing good work, but you're not able to measure the impact of your work. So we went through a process, and when we looked at the different issues out there, and when we looked at what MetLife was all about, going back to our history of in the late 1800s, it was really about providing financial, including people financially, providing financial services to build a better life. And so we went through this process. We were looking for something that aligned with our core mission as a company. We were looking at ways to engage employees too, which is an important. You see that in a lot of corporate activities right now, engaging employees, both their sweat equity and also their professional skills. So we landed on financial inclusion as a very important topic for us to focus on. And when we think about it, it's really in three different areas right now. We want to make sure that people have the knowledge and skills so they're ready, able, and willing to use financial services. There's really no purpose to providing financial literacy if there's not an ability for someone to act on that. And we see a lot of that in the world, and that's what we want to address. We want to make sure also that there are the financial products, the appropriate products, whether they're credit products, savings products, and insurance products, so they're there and ready for individuals to act on. And of course, we want to measure our activity. I mean, it's really important in this day and age with the resources that we're committing $200-300 million to this work to be able to measure the impact of our work. And then to share that with the field too. A lot of organizations try things, they don't work, but we really feel a need to make sure that that information is put back out there. And when you think about financial inclusion for us, it's important to have the tools, the skills, the access to the services. But really what it's about is opportunity and mobility, right? That's what this leads to. And for us, it's, that's where we're going. Families that are financially included are more likely to take care of their nutrition needs, are more likely to send their children to school, are better parents when all these things occur. So for us, it's not just the financial inclusion or the services, it's really moving on to a better quality of life.
That's a fantastic story, Dennis. Thank you. So Dennis and Manny have told us about what some large global organizations are doing in this space, and they're setting incredibly important infrastructure in place. But I was delighted that Audrey was able to join the panel because she's really looking and working in markets where financial inclusion is the market. And I'd love for you to tell us a little bit about the work that you were doing with Standard Bank in dealing with problems of financial exclusion.
Thanks, Mary Ellen. It's great to be here. It's interesting to listen. I've been listening all day yesterday and today, and reflecting on it, I realized that this is probably the only panel that's dealing with the 99%. And the reality is we can't ignore the 99%. If you look at financial inclusion, and the conversation that we need to be having is a conversation around the main market. And I was privileged to have been part of a bank that actually decided that that was part of the main market. So when I listen and I hear about social responsibility, that's fantastic. But the real challenge is it has to be core to the decisions we make. And at Standard Bank, what we did was the decision all the way from the board was a decision that said, that is the main market, which means it is part of the business. So within retail banking, there was an inclusive banking component, which by the time I left, end of last year, grew from 1.5 million customers to 7 million customers. That was 7 million of the 10 million Standard Bank customers. And the conversation there was easy, because it was saying, if you look at the market as the main market, you have to think everything that you do, you have to work backwards in understanding what are the needs of that customer. To be financially inclusive in any of the big banks, and most of you are sitting around the room, you have to start thinking about, from a customer point of view, what are we trying to do? In that market, the main market, which everybody talks about, all the barriers. So the conversations, we talk about the 2.5 billion people, we talk about the high costs of entry, we talk about the fact that you don't make money. Yes, you can make money. And it starts with basic things. It starts with creating access. In majority of the countries, and I was privileged to be part of a panel and a group that worked together, which is 5 banks, ICICI Bank, Equity Bank of Kenya, Bancolombia, and Bansefi of Mexico. And we had a peer review, and we shared information all the way from distribution networks to marketing to pricing, and really managing that market as you would any market. And I often say, the market at the bottom end, or the unbanked, the way you call it, I call it the main market. The needs of the main market are not different to the needs of your private clients or your wealthy clients. The reality is they require the same service. They require the basics. They want to know what you're providing. And out of that, we developed a strategy that said accessibility is key. Because one of the key cost drivers in any of these markets is the cost of distribution. So how did we solve the accessibility problem? You have to create an opportunity and innovate in terms of how you reach that market. So the innovation in creating accessibility was actually using technology. We realized, and it's not a challenge, 83% of the market in South Africa have a mobile cell phone. The reality is, if you take the technology of the mobile cell phone, you can very easily, and we did it, get rid of the branch network. So distribution accessibility is a challenge because branch network, first of all, we all know how expensive it is to set that up. So from an accessibility point of view, we took the bank to the communities, and we worked with the women, with the shops, with the mom and pop shops. They became our bankers. And we opened about 10,000 of those shops. And in addition to that, we created employment by hiring and employing agents, which are literally individuals in the communities who become our bank agents, who speak the language, who are in the community, who understand the community, and are operating using a mobile phone. And in less than 10 minutes, we were able to actually open a bank account, which was the first time ever done in the world, thanks to this SAP technology that we worked with. Now you're creating a sense of, wow, you can reach that market. But then there's the second part of the equation, which is, but what products are you putting out there? For the market, most of you know and probably have heard of credit products. It's always about credit. It's not only about credit in this market. We developed a savings product. We developed a transactional product. So it's also shifting the language and shifting the myths around understanding the needs of this market and moving away from a paradigm that assumes that there's only one product out there for the market. So the second thing that we did was to say, how do we then simplify the products that we've put out there? So you've created accessibility. You have to simplify, not dissimilar to any of the other complex capital market products that you talked about the whole day. If I don't understand what you're trying to sell me, if I don't understand what the benefits are to me, then I'm not going to participate. So we simplified the language, we simplified the way we took it to market, and I'll talk to the marketing later. The third thing we did was the transparency. So accessibility, simplicity, transparency. In this market, one of the confusions around participating in the main banking structures is, first and foremost, we have a lot of jargon. We have a lot of jargon in our marketing brochures. We have a lot of jargon in our pricing brochures. Most people don't understand if you were to stop and ask them what they're buying and what they're paying. In that transparency, we decided, let's go out and understand what is it that the market is looking for. There's an aspiration to bank and be included in the financial sector. So believe me, everybody aspires to participate in that formal space. The second thing that we heard was, you know what, I don't mind paying for something if I understood what I was paying for. The third thing was, actually, most of the banks steal my money because I put in $10 or 100 Rand, and when I come to check my bank balances, it's gone because they're high fees. We're charging them high fees. So out of the accessibility, out of the simplicity, out of the transparency, we developed a very simple product, which was a no-fee product. And in addition to that, we developed a savings product because we heard the conversation around saving. And out of that, we started engaging around the distribution model to say, how can we start unpacking the costs that drive our business, which is the main business, because we're a commercial bank. We're not doing this for charity. And we started unraveling the debate around the high cost to entry and the fact that actually you can't provide a product for this market. The product we developed was very simple. We did not run through tons and tons of product development committees, which most of you do. The credit product we put forward, we engaged from a regulatory point of view, and we were lucky, and I think one of our regulators is here. Well, I can see him over there. We're very lucky because part of, from a South African environment, it's probably the one side of the equation where we've been lucky to partner with the regulator because of the need, as I mentioned earlier, to include the main market. So I could go on, and I'll turn back to Mary to really direct us, but the point I want to make here is that where I come from, it's not a CSI issue. It's about the main market. It's about the 99%. And yes, we can do it, but it's about making those decisions all the way from the board to the group CEO and saying, are we taking this seriously, and are we prepared to invest in understanding the challenges?
Fantastic, Audrey. Thank you so much. Manny, let's hear about some of those very specific things that you've been doing, and what are some of the initiatives that have really succeeded in reaching your objectives?
Sure. So, I mean, just to be clear, we're not a microfinance organization ourselves, right? We're not a retail bank outside of our home market, Switzerland. And in many of the countries that we're active in the microfinance capacity building space, we're not even physically present. So what we've decided to do is to really work with a handful of carefully selected, globally active partner organizations, Women World Banking being one of them, and really support them through grant funding, clearly, but also, and we're quite proud of that, through the employee engagement, skill-based volunteering. I can tell you a little bit more about that. And there we can actually precisely leverage the skills of our employees to help microfinance organizations to develop savings products, for instance. So we had an employee who is involved in developing savings products in the Swiss market. She spent 3 months with Finca in Tanzania, one of our other partners, helped them to develop savings products. Of course, there's a lot of adaptation needed, but still, they were raving about the contribution that she could make there. And similarly, we have obviously expertise in areas such as risk management, IT, HR, you name it. So there's a lot of expertise that can be shared. We call them our global citizens. We sent over 50 of them to our partners over the years. And we actually view this as a leadership development tool. So it's not, for us, it's not necessarily just sort of doing good only. We actually view this sort of as a win-win-win thing. It's a win for our partners, we would hope, because, and here Mary Ellen could maybe attest to it if it doesn't violate your role as an objective moderator. So it's a win for our partners, we hope. It's definitely a win for the employees because, you know, they get to spend 3 months in Tanzania. It's a fascinating new environment. But it's also a win for the bank because that's precisely why we view this as a leadership development tool, and we carefully select these employees who get to go. because clearly they learn new skills in a difficult environment. So that's why we keep it actually relatively exclusive, vice president above only, for instance. So these are sort of the tools we work with these partner organizations, and the goal really is to strengthen the industry, the microfinance industry as a whole, improve processes, products, and the people. We've trained together with our partners over, I think, 15,000 microfinance institution staff and management. So again, the capacity building sort of at the core of this. We also have sort of a thought leadership research component to our engagement. We worked with the People's Bank of China, looking into the issue of how Chinese microfinance institutions can access local capital markets or cannot. We work with the World Economic Forum in the financial inclusion effort that the World Economic Forum is doing, and so on. Product development, I mentioned the savings product that our colleague was helping in Tanzania with. We are very successful in the development of so-called local currency notes. That's sort of one of the trends or one of the demands that we're seeing in microfinance organizations, that they currently are lacking in many cases the ability to refinance themselves in local currency, in Kyrgyzstan or wherever, and we can help them with that. We're again looping in our clients who are willing to gain exposure to a basket of local currency denominated loans. So that's some of the work that we're doing, really trying to go beyond CSR, as Audrey rightly said. I mean, you know, I'm not ashamed of the fact that there's a strong CSR component to this, but clearly, once we're able to sort of bring in private capital, once we're able to sort of link this effort with our client base, I think then we can make a tremendous progress.
No, and Dennis, I see you nodding, please.
I'll pick up on that. So it's this linkage between, or the cross-section of corporate social responsibility and business practice. So, and Audrey's project is really interesting because it's really supporting banks, because that's really where the action is, right? And that's where poor people will get their services, low-income people. And when we look at our work right now, that's really where what we're trying to promote. And you know, our work is not just with NGOs or nonprofit groups, because they'll never have the scale, they'll never have the sustainability. So we're looking to work with credit unions, which have large customer base. We're replicating a project that Audrey alluded to with the 5 banks, but we're looking at doing that with microfinance groups. So we're bringing in an organization called Bankable Frontiers to try to do that, so to try to develop products so the delivery system or the channels where low-income people might go to get those services are more receptive, have products, and understand that customer more. And so it's really all about scalability, right? Because I think for years and years, the work that's being done, you know, it's not going to solve the problem by making grants to nonprofit organizations. It's just not large enough of a community to do that. So that's where we're trying to make our mark. And it's a different approach. You know, we always made contributions, grants to nonprofit organizations, but now, you know, we are making them to double bottom line consulting firms like Bankable Frontiers and like others. So it's a different type of grant making approach in order to have impact and sustainability, because when you get a group that comes in and they talk about an activity that they want to do and it's only sustainable with a subsidy for the next 2 or 3 years, you know, that's not where we want to be. We want something that eventually will tip and will be self-sustaining and providing the services to the low-income clientele that we want to make sure receive the services they need.
No, I'm not only incredibly grateful to you for that sort of eloquent distinction, but I am going to violate my moderator's privilege here, I suppose. We're working with the 4th largest corporate bank in Nigeria right now, and they were very interested in our help developing a savings product for the unbanked. And yet, they were very, very clear with us that they had a 3-year payback for any product introduction, and the research and development that it would have taken for them to get comfortable with this market that they had never approached before would never reach that payback period. So the fact that we as a nonprofit were able to mobilize corporate CSR support from actually from Visa in this case, which also has a very strong financial inclusion CSR mandate, we were able to subsidize that R&D period, get them within their 3-year payback. They have now totally embraced this deposit product. We're now introducing a youth savings product with them, and at the end of the year, we're going to start on a credit product that they would never have considered credit if they hadn't gotten comfortable with the fact that this population really does save and that they could use those savings potentially as collateral. So I think the role in the sort of symbiotic relationship between the CSR and the business as more banks approach this space is absolutely absolutely key. You had promised us you were going to tell us something about marketing, Audrey. I'd love to hear a little bit about that work.
No, I did, but just to add to that as well, I think the CSR component and the business component makes sense. The reality is, if you look at even what we did at Standard Bank, as a combination of with the work from the Gates Foundation saying, let's challenge the idea that this part of the market doesn't save by getting the banks to develop a sustainable savings product. So all the 5 banks that participated, one of the returns after the 3 years was to develop a sustainable savings product. We did it, and Standard Bank, I remember being shocked at the numbers because we at first I thought actually we're getting it wrong because the numbers were much higher and exceeded the target in terms of the number of new savers that we ended up with from a bank point of view. But the reality, again, is in this market, and you'll actually understand that fully, Mary Ellen, is the strategic partnerships work, whether it's the strategic partnerships with the different donors, with the strategic partnerships with the banks themselves. And funny enough, you've mentioned Visa, but Visa and MasterCard are out there from a technology point of view. You can't actually deliver to this market without the technology. So the payments technology, the biometrics technology, earlier on we had about M-Pesa. So that whole end-to-end value chain for me is critical long-term for the success of financial inclusion. And if you come back then to how you manage business, which is the example of marketing, in our own businesses, the banks, the questions then need to be around all the different divisions. So you almost need to take the strategic partnership that I've talked about, which is on the outside, and bring it back on the inside. And sometimes to be effective, you have to break the rules. So one of the things I did was to break the rules around marketing, because in marketing, you've got a very particular way that you drive your CSI. And if you look at this market, at least some of the marketing that we put out, we found that you had to speak differently. You have to engage differently to get the same message out that you're trying to do in your normal brand marketing, which is fantastic. There's nothing wrong with that. What we did, which worked for us, is we did 2 things. One, in the communities where we took the banking, we broke the rules around the proper CI and the proper brochures, and we painted the walls, we painted the houses. So we painted our logo. So suddenly a bank that's 150 years old was bold enough to go out there and challenge how we communicate by being relevant in the community, not necessarily saying we're going to come in with our X size font branding and print it with a particular right color font. So we broke that rule. The second thing we also began doing was to say, let's start having conversations in places that our market, which is the main market, is spending a lot of time. So we designed a whole lot of mini radio dramas. I'm not sure that you're familiar with it, but in South Africa, there was a time we had radio soap operas, because radio was a big thing. So we designed and partnered with the radio stations and created radio soap operas, but it was mainly embedded with financial literacy around how to save, around issues around pricing, issues around basic how to manage your money, how to don't save your money under a mattress, open a bank account. But it was done with humor, and we've used and continue to use well-known actors, both in radio, and we then moved to television, very famous soap opera shows, 8 o'clock in the evening. Now that taught us something different as a big bank, which was you can actually serve this market effectively without destroying the value of the brand by engaging and communicating in a way that is relevant. So the part about relevance became critical, and we found that in so doing, you had to also ask the same question, through art, whether it's in the IT process and how you manage it, the technology develops. So from marketing to compliance to IT, suddenly all the silos within the organization, you have to ask the question, how can we do this differently within the required regulation but become relevant to the market?
That's great. I know we're going to need to open things up to the room, but maybe as in closing words from each of you, I've been very impressed by all of the successes, but I do think we need to say a word about things that you maybe anticipated would be different than they were, or more difficult than they were, or challenges that you faced, because I'd love to come back here next year and see a lot more banks having embraced this as a CSR or as a business initiative. Manny, what has your experience been?
Well, I mean, first of all, I think there's, and we alluded to this already, I think there's so much more to do also in the area of product development. There's a big differentiation going on, I think, not just in the savings, into the savings products, but also sort of in terms of what these products are used for. So, for instance, agriculture, should there be an insurance, a crop insurance component to it, and all that. So there's a lot to be done, I think, just in the area of product development. And what I also find quite evident is it really is an effort that needs all the different stakeholders. So again, we shouldn't pitch sort of CSR against a core business. We also work with partners in the public sector, public-private partnership with the Asian Development Bank. That has its own challenges, public-private partnerships, of course, but still. So basically, I think we're all in this together. And that's probably one of the challenges we see, multi-stakeholders, but definitely that's one of the areas that I've seen.
Yeah, absolutely.
Other challenges are more technical, as I mentioned, local currency, refinancing. I think that's a big issue, a big area of development. Help these microfinance organizations get the ability to refinance themselves in local currency, being less dependent on the fluctuations of the US dollar. So these are more sort of the technical areas that I see.
Absolutely. Great. Dennis, any thoughts on that?
Yeah, I think in the field, the measurement has probably not been that great, right? So we don't really know, where the successes are. And one of the things that we're committed to is really making sure that we track the impact of our work. And I think just in general, where we're seeing, some of the weaknesses are in when you see financial literacy materials, right? And as we got more engaged in financial inclusion, a lot of organizations would come and say, you've got to fund this financial education, financial literacy. And we would, say, well, what are you trying to solve? What's the problem? Is that information not out there? And I think, that piece really, the link between knowledge and action really needs to be strengthened. You can get someone to open a bank account. We've been talking about bank accounts a lot, but if they open it and never use it, well, that's a real loser for the banks and for the individual and for the organization that promoted that. So I think, the measurement, evaluation, and tracking is an area that really needs a lot more work.
Yeah, that's a great point. We've had some experience in the soap opera business as well, and one of the most exciting things is the impact on dormancy with the soap operas and the radio novellas and telenovelas that we've been involved in. It's not just the people opening the account, but then re-engaging, and we've seen extraordinary increases in dormant accounts. Challenges, things that would maybe make you a little daunted about doing this business.
I think the reality, the first one that we missed is the trust factor on the other side. So there's one of the big challenges to address is how do you actually get that market to trust and believe that we are working on a process of including them. The measurement component is big, and opposite to the trust factor from a corporate and a business point of view is the fear of never making money. So there's a fear of the commerciality and the sustainability of that going forward.
Yeah. Very good. So I've already seen a couple of hands going up, so I'm going to definitely open the floor to this gentleman here who's eager to ask a question.
Yeah, I wanted to make a comment and then ask some questions. My name's Sherrod Cooper-Coles. I'm a former British diplomat, and I'm leading a study for the HSBC group on financial exclusion, and I've spent the last 6 months immersing myself in this. And the observations I would make were, first of all, to salute what the three groups represented here, or the four, if we count you, Mary Ellen, are doing. But I'd go on to say that, you know, as we all know, CSR isn't enough. And this has got to be sustainable. It's got to be commercially sustainable. So we're talking not just about the quantity of financial inclusion, but also the quality, making sure that people have bank accounts that actually use them. And we're talking about actors other than individuals. We're also talking about firms. And in the case of HSBC, we're talking about countries. In one of the sad things, I think, has been the chilling effect of regulation and of a shrinking risk appetite for groups like mine. And what we've seen is us withdrawing from territories, from geographies, from countries, from market sectors, because the risk is perceived to be too great. So the point I really wanted you to comment on was the public policy side of this. We can do a lot as banks, as NGOs, in pushing from the ground up, but there's also a responsibility on the regulators and those who regulate the regulators to create an environment in which a bank like mine is prepared to take the risk of financing cotton exports from a sub-Saharan country without being frightened of being accused of financing Al-Qaeda in the Islamic Maghreb, to take a particularly lurid example. And it's getting an understanding of risk and the public good, that it isn't just binary. There are shades of grey, and there is a wider public good which will prevent terrorism, reduce drug laundering if economies grow, development is done, and that's done by not reversing globalization, balkanizing the global economy, but continuing the progress that's been made. And I think there's a very important conversation to be had on the Hill, here in Westminster, around the world, getting the legislators to understand that they need to create the environment in which financial inclusion can be driven forward by banks, by commercial entities, if it's to be sustainable.
Thank you very much for that. I think I saw a hand here as well.
I am Carlos Gustavo Cano from the Central Bank of Colombia. For central bankers, this issue is not very known. We used to be apart from that. But we have two mandates. Number one, monetary policy, low inflation, and financial stability. And one of the problems in emerging countries like my country is that the financial exclusion is very big, is huge, especially in the rural areas, and especially among women. How to reach the poor people has been the puzzle of all international organizations trying to overcome poverty. My question is that is it necessary to find out a special and a specific regulation for microfinance institutions? Because microfinance institutions are quite different from the conventional banks. I've been a banker, a commercial banker, and if my aim, my objective, which is legitimate, is to maximize profits in behalf of my shareholders, I perform as a banker in a different way from the institutions that are devoted to overcome poverty, and especially in the rural areas. So we have been discussing with our superintendents of finance in Colombia how to fine-tune a special regulatory body. The case of the women's banks, no organization in Colombia, banking, which is not conventional banks. Two of the organizations in Colombia, maybe you know, merged together and created the bank. I wonder if this bank has a different aim than a conventional bank, how can compete and how can survive in a scenario that is not devoted or not is designed to overcome poverty. So that's a conflict I have. I would appreciate very much if you have some comments in that respect. And let me congratulate IIF for including this very important area within the agenda, which I hope that will remain for the rest of the agendas in the future, in the next assemblies of IIF. Thank you.
So we've had two really very, very interesting viewpoints and questions around regulation. Any thoughts, Manny? You seem to have some thoughts on public-private partnerships in particular.
Well, yeah, I mean, I think these are spot on. I mean, regulation is something we didn't talk about, but that obviously is hugely important. Coincidentally, with the colleague from Standard & Chartered just prior to this panel, we had a quick conversation about this too, and I do think maybe the IIF can play a role in this. So it is good that we placed it on the agenda. But of course, there's no one-size-fits-all. I guess the regulatory issues will have to be looked at from market to market. But I think the IIF as a whole can probably play a role in this.
Audrey, did you have some thoughts on this as well?
I guess on the regulation, again, it's a factor of, and you're right, the different environment, and it's an important one. I'm privileged because in South Africa, one of the things that happened, in post-1994, was the creation of the Financial Sector Charter. And it was all the different banks that came together, and accessibility and creating access to finance was one of the key drivers of that charter. And the support from the regulation has been critical around that. So the conversation in South Africa, and I can say as an example, is a conversation where, funny enough, the regulators are challenging us to come up with ways constantly and opportunities to support the financial inclusion. If I use the example of the savings product, which in Bancolombia was part of that as well in creating it, in our side, we had to share best practice with Bancolombia because from a regulatory point of view, one of the things we got support on was to create a Section 1, a product that allowed us to have a 7-day notice period. And that came out of the idea that you talked about the pool, where the money goes in and the money comes out in this market. I've got 1,000 rand, I put it in and I withdraw it, all because of lack of trust. So to encourage savings, we had to find a way using regulation to encourage that, while at the same time building sustainability. And we worked very closely with the regulator, and the 7-day period means that if you want your money out, you'll have to wait for 7 days. And the 7 days came out of the research that we conducted, where the customers themselves would say things like, if I had an opportunity to not withdraw that money, if it's an emergency, then I'll need it and I can hold back and I can find out how to solve the problem. But if I'm really desperate, then a week is about the right time. And I would congratulate our regulators because it was an ongoing conversation, but the starting point was a charter coming out of an industry collaboration acknowledging the need to create accessibility.
That's fantastic. That's great. Yes, I think the front row is being very well represented in the Q&A.
Vasuki Shastri from Standard Chartered Bank. Could the panel comment on the role that remittances is playing in driving financial inclusion in countries? And linked with what my colleague from HSBC just said, a lot of international banks are withdrawing the relationship with remittance houses, and this is likely to have a material impact on economies in Africa and elsewhere.
Any thoughts?
Follow-up question. Could you repeat that, just the gist of it?
Yeah.
Remittances that people who are living overseas remit to their home economies, and this is several $100 billion every year. I mean, the Indian diaspora remits back to India through the financial system, $30 or $40 billion every year, and that anchors financial inclusion because they're remitting that money to families living often in rural areas. And most of the time, that's the first bank account that families have opened. So this is countries like Philippines and India, and many countries certainly in Africa, this is the single biggest source of foreign exchange for countries. And that is somewhat under threat because a lot of the international banks are withdrawing relationship with remittance houses like Western Union and others. And this is likely to have a threat on the very the driver that is helping low-income families in many of these countries.
I am going to jump into this one because this is one of my biggest soapbox issues. I know you're all dying to hear about it now. But my take on remittances and financial inclusion is that it is an enormous wasted opportunity on the parts of banks in the receiving countries. We've done some work now with a couple of banks. Our first project was in Sri Lanka. Women who had left Sri Lanka to be into domestic service in the Gulf, sending money back, being very clear that they wanted a portion of that money saved for a down payment on a house for when they returned. The banks paid no attention to that desire, allowed the family member to take the whole amount out in cash, and the money was spent on consumption. We put in a program where, as you say, we created bank accounts for the receivers, we provided financial education for the receivers, we made that savings that the woman remitting wanted, we held that sacrosanct for her. And it's very much what you were saying, Audrey, it's completely changed the behavior of the receivers. They are leaving money in the account, they are investing in investment products that the bank is now offering. So I think there's an enormous opportunity. There was a great experiment the Inter-American Development Bank did in Mexico a few years ago with remittances from the US, allowing them to a portion of the remittances to pay a premium on a health insurance policy. Tremendously successful, but it was a development experiment. Nobody picked it up as a business, but I couldn't agree more that there's a wasted opportunity and a potential real risk not to take advantage of that opportunity.
I think the commitment savings movement too, that the savings is earmarked for something very specific, is very key too. That it's it may be time bound, it may be an objective that the person is trying to reach, and that money can't be touched. And there's been a lot of success with that type of approach too.
We have time for one more question. Yeah. Okay, I've acknowledged this gentleman here.
I hope I didn't create that impression. No, we just started our partnership with the Asian Development Bank. In the case of the Swiss government, we've been working with them for a while, and so no problems there. But it just creates its own set of challenges. That's what I'm saying. But no, on the contrary, I think public-private partnership can be very helpful if you have sort of the more, patient capital from the government that can actually be very helpful. So please don't read into my facial expression or whatever that we're not happy with our ADB partnership. Not at all. Yeah.
Thank you very much. My name is Daniel Minele. I'm from South Africa. Audrey has been heaping lots of praise on her regulator, which doesn't hurt at all. I don't have a question, but more just a couple of comments to add. I think the point that was just made about the role of regulation is exceedingly important, and Audrey has given some kind of examples how, with some of the constraints that, for instance, central banks that would have the regulatory functions under them, as indicated by my colleague, you can try and strike a balance between facilitating these processes, but at the same time not neglecting your duties as far as they pertain to financial stability, to making sure that your payment systems are robust and stable. And one of the ways of doing that is creating different tiers of banks, whether you've got community banks or cooperative banks that may have a slightly different structure than a normal sort of commercial bank, and for which you would be able to then look at a slightly different type of regulation, which takes still risks into account in almost like a proportional type of things. Even when it comes to things like KYC, that you say, depending on the size of account and all of that, you may need a slightly different regime. I can give you a little bit of comfort. I know things may not be moving at the speed that you may wish, but at the international level, this is increasingly been discussed and talked about, certainly at the G20, when all these new regulatory standards and the financial regulatory reform has been discussed. A critical component of it increasingly, particularly driven by emerging market countries, to say, look, what are the potential unintended consequences for countries that haven't got oversized or overgrown financial systems, where the financial sector is still very much part and parcel of developing those countries. So those things are registering, as I say, maybe not at the speed that one would hope for. And a final comment around financial inclusion, I'd very much share what you said. I think it's a very, very important component and would be a missed opportunity for development, for growth. And the key issue, again, there is striking sort of balances. I mean, the thing that regulators mostly are worried about is, of course, is payment systems in the process, that they stay safe and robust and efficient. And certainly our region, with all the successes that we may have registered in other places, that's an area where we still have work to do in Southern Africa. I think the cost of remittances is still very high, and we are working with bodies such as the World Bank to try and see what improvements can be made there. Thanks.
I'm afraid something terrible is going to happen with this flashing red light here. So I'm afraid we're going to have to draw the panel to a close. I think the message to the IIF is that this was a terrific inclusion in the agenda, and maybe we need a regulation around financial inclusion panel for next year. Thank you all very, very much, and enjoy the rest of the conference.